Good morning. So my name is Jonah Lupton. I'm one of the hosts of this conference, the FinTwit conference, our second annual one. Welcome everybody. Thank you for coming. Great to see so many familiar faces. We did one of these in October. Went very well, so we decided to do another and bring it to Vegas, of course. So we have 2 full days of content and social gatherings. So there is a program there's programs out on the registration table. So if you haven't grabbed one yet, feel free to go grab one. This shows you all of the speakers, panels, and presentations that are happening in this room. So this is track A, and then track B is on the other side of the main ballroom. And you're allowed to go back and forth. So if you want to, hang out in here and listen to Peter speak, and then bounce into the other room for the next speaker at 11:25, feel free to do that. So feel free to move around. So we're gonna do about 3.5 hours of content after breakfast, and then we'll do lunch. Same thing, full buffet. Another 3 or 3.5 hours of content after lunch, and then we'll take about a 90-minute break, and then we'll come back down here from 6 to 9 for the cocktail party. We have a ton of food, and it's open bar, so enjoy that. And then tomorrow, basically the same thing as today. We'll start off open the doors at 7:45. Breakfast 8 to 9, opening remarks, 3 hours of content, lunch, etc. And then we'll wrap up tomorrow around 4:30. So if you have any questions, come find me. But I just wanted to thank everyone for coming. Benzinga has offered 2 months of free Benzinga Pro to all the attendees today. I'm not exactly sure how they're going to do that, but they told me to mention that in my remarks. And with that, I will introduce our first speaker, Peter Offringa, who's become a very close friend of mine. I'm sure you'll enjoy what he has to say. So let's give him a quick round of applause and get this thing started.
All right. Hi, everybody. Hope you're having fun. Okay. I'm going to get started. So I'm Peter Offringa. I'm the founder of Software Stack Investing, which focuses primarily on companies that are in the software infrastructure space. The reason that I focus on that, it really ties to my background. So I spent 20 years leading software development activities at a number of consumer internet properties out in San Francisco, usually in a role like Chief Technology Officer or VP of Engineering. And as part of that, I really got a lot of insight into what it takes to build a modern software application at scale across a number of different properties. I learned a lot about software architecture, developer tooling, processes, observability, big data, all of those things. And I, through that experience, worked with a lot of the companies that I talk about or that I cover as part of my analysis. So I think I bring a unique voice as an analyst, as a customer and an operator versus purely a financial analyst. And so a couple of years ago, I decided to pivot that experience into creating a blog where essentially I write about companies and trends in the technology industry, again, from the perspective of an operator, really focusing on product development, competitive positioning, industry trends, other factors like that I think really will distinguish one company from another, and that's the voice that I bring to the blog. And if you want to get in contact with me, of course, I'm pretty active on Twitter. The blog is at Software Stack Investing, and there's an email address on that as well. So a lot has changed in the last 6 months. If you were at Orlando, you see that the dynamic is a little bit different. Well, exactly, and that's the point of this slide. Exactly, Orlando was the top, and here we are now. But as with anything, there are cycles, and so there will be another cycle, and I don't know when the recovery will be, but I'm sure there will be one. But I think the key is that companies that demonstrate consistent growth over time will work through any kind of changes in the macro environment or a view of valuation multiples. And my goal is to, through this presentation, provide you with a framework so that you can assess in the space of software infrastructure, which companies will exhibit that consistent growth. And as I go through this presentation, you can also think about applying that framework to any other sector. So while I'll talk about software companies like Snowflake or Datadog or Cloudflare, that could as easily be applied to Tesla or your favorite financial services company or others. So certainly keep that in mind as I go through this. So as I talk about, when I mention durable growth, and you hear this often with analysts and others using this term, you wonder, well, what does that mean? So durability, of course, just means being able to exist for a long time without a significant deterioration in quality or value. And applied to durable growth companies, that really, to me, elicits two things. One, the ability to generate consistent growth in revenue over time, where each year the company is putting up almost the same level of revenue growth. In a good example would be like Cloudflare over the last 5 years has delivered about 50% year-over-year revenue growth each of those years. And in some ways you could extrapolate that forward and assume that that's going to continue. Tesla's a good example as well. Elon Musk just said, I expect to have 50% year-over-year growth for the next several years. So the benefit of that, of course, is that compounding starts to take place. And then an important secondary trait, which is becoming even more factored into valuations these days, is the ability to demonstrate generating free cash flow or profitability as that growth continues. And why is it that durable growth is so important? Well, that's because most people expect growth to marginalize over time. And we see this with a lot of the sell-side analysts. If you look at their forward projections for revenue and other factors over the next couple of years, they almost automatically apply a 10% discount each year. So you see maybe they're a 50% grower the next year. They expect 40%, 30%, 20% fairly consistently. And the reason that it's important for us to try and find the companies that can exceed that is because that's, of course, where the alpha is going to be. If you have a company that is delivering 50% growth year over year, whereas the analysts are expecting that to drop to 30, 20% in the next couple of years, then of course that's where gains are. And there are reasons, why they expect that growth to marginalize, and most companies actually exhibit that trait. The law of large numbers comes into here, saturation in a single product category. We can look at examples like maybe Zoom during the 2020, 2021 period. Everyone was excited about the growth of that. We thought they were going to break out into other categories. They really haven't, whether you look at like Zoom phones or some of their new video processing products, new competition, loss of talent and innovation. There are a lot of companies that have been around for a while, let's say like Splunk, where a lot of their leadership is already turned over. They're not really innovating anymore. And then, of course, heavy capital requirements. There are a lot of companies that require a lot of capital in order to grow. But there are also some companies that are special. And I think that the hyperscalers provide a good example of this. This shows growth of AWS since 2014. And you just see this very consistent line of high revenue growth over the last 8 years. Amazon was rewarded with about a 10x increase in valuation over this time period. And that CAGR of 42% has been very consistent. And even at large scale, that's Amazon and Azure and GCP, they're putting up crazy numbers in terms of revenue, a run rate of approaching $80 billion a year, and yet they're still growing near 40 to 45% a year, depending on which one you're looking at. So I think it is possible for these companies to reach that that threshold of durable growth over time, and that, of course, it's that compounding that we're trying to realize as we look at these companies and identify them over many years. So one model I like to think about as it relates to trying to identify those companies that may exhibit durable growth versus those that won't, and applied to the software space, this can be relevant, but it can apply to others as well, as this notion of the pick and shovel play. So you're probably familiar with it, but this came out of the gold rush. And the idea was that it's not necessarily critical that you figure out which gold miner is going to find the gold, but the companies that made the most money during the gold rush were those companies that sold them the tools that they used to find the gold. So, Levi's being a good example, sold them blue jeans, companies that sold tents, picks, axes, etc. Those are the ones that made all of the money versus the the end companies that we're trying to actually mine the gold. And applied to software infrastructure, we can kind of use a similar way of thinking. So pick and shovel software companies are the ones who provide the building blocks upon which popular consumer experiences are built. So it's less critical that you figure out which consumer experience is going to be durable over time, whether you look at Peloton or Pinterest or Stitch Fix or any of these companies that are good companies in their element, but what you're having to bet on is the vagaries of consumer preferences, which can change very quickly over time. However, if we focus our attention on those companies that are providing the building blocks to enable those experiences, then it's less critical that we anticipate what consumer behavior is going to be. Datadog, for example, is a big provider of services for Peloton. Peloton's one of their largest customers. Peloton, of course, has had their challenges over the last year. That hasn't affected Datadog because the next set of consumer experiences are utilizing their services. So I think that provides us with a reasonable tactic. I think it's also worth stepping back a little bit and especially since valuation multiples have been very much in the news lately, to review why software companies usually enjoy very high valuation multiples. And if you're familiar with Bill Gurley of Benchmark, he put out an article in 2011 where he talked about why software companies generally have higher multiples. And he retweeted that recently to remind us that a 10 price to sales ratio was considered high back then. Of course, that seems a little low to me, but everything is in perspective. But the key is that software companies enjoy several factors that allow them to realize higher multiples wherever that stands. So, of course, they have predictable and recurring revenue. Each quarter, particularly in SaaS, the majority of the revenue for that quarter has already been booked. They enjoy high gross margins, often at 80% or more. They have low capital expenditures, which means they don't have to usually invest a lot of incremental capital in order to enable the next user. And then, of course, they realize operating leverage as well. And what you usually see is the amount of revenue per employee generated increases significantly over time. So what I'm going to try and do is identify for you a framework that I use to think about, well, what are the criteria that I can look for to help identify companies that will probably enjoy this benefit of durable growth. And really, to simplify it down, I think there are three main criteria. You look for a large addressable market. That's, of course, the foundation upon which growth is built. You then look for a company that's rapidly innovating. They're launching new products almost quarterly, monthly, and they're expanding into adjacent categories so that while their addressable market is large, they're continuing to expand into that addressable market. And then third, they have a very robust and well-refined customer, what I call a customer flywheel, which really at its core is about land and expand, the ability to land new customers and then expand their spend over time in order to capture more of that market share. But at the core of this, of course, is a competitive moat. It's critical that any of these companies, any company you look at, has a defensible moat. And why is that important? Because it keeps new entrants out of the market. Because the worst thing that can happen is a company can be very successful for a year or two, and then all these other lookalikes emerge, and they try and copy the same procedures, processes in order to launch a lookalike business. So having a deep moat, it becomes a really critical factor in order to enable durable growth. So operating leverage as well. It's funny because I injected a couple of these slides in the last month as I was preparing this related to kind of the current market. So as a lot of our focus 6 months ago was on revenue growth, and we were scrutinizing incremental revenue growth year over year, quarter over quarter, and often ignoring profitability. Of course, the market has reminded us that these companies need to also show that at some point they can be profitable. So Datadog gave us a good example in the last quarter where they are demonstrating that not only could they grow revenue by 83% year over year, but in parallel, they increased their gross margins by 3% year over year. They quadrupled their operating income, and they tripled their free cash flow. So they're addressing kind of the question of where should their valuation multiple land in a market environment like this. They're addressing that from both sides, which I think really provides them with a strong foundation as it relates to how their stock price is evaluated. So I'm going to go through the three criteria that I talked about related to identifying durable growth. And the first is finding a large and expanding addressable market. And for us who invest in software, well, of course, the easiest is digital transformation, and really looking at this concept. And I think that's a little bit of an overused word, but if you think about it, it's really about every enterprise in the world moving their business processes with both their customers, with their business partners, how they operate within their ecosystem, from manual offline processes to digital processes. And IDC put out a metric where they said that basically half of the global economy within the next year is going to be driven by products and services that are from digital channels or digitally transformed businesses. So that provides us with a very strong tailwind as we think about investing in a particular market and the growth potential there. And of course, you can pick other addressable markets besides software. Certainly, electric vehicles would probably be a good choice if you were considering Tesla, or energy, or financial services. You could really think about the same kind of dynamic there. So as it relates to my space, software infrastructure, in the addressable market of digital transformation, what's really a big factor or force that's coming out of that is the creation of data. And this is a slide from Applied Materials, who is a semiconductor manufacturing company, where they have identified the fact that the rate of data generation is growing almost exponentially. And the driver of that is the fact that now a lot of the data being created is not just based on human activity, humans doing things, which of course is always going to be gated by population growth, but rather by devices. So when we think about devices, it's not just our mobile devices, but more importantly, it's what was called the Internet of Things, or putting sensors and autonomous devices inside factories, hospitals. We're all familiar with the farming example of like gather the temperature and the humidity and the wind and all that data to determine when is the best time to grow crops and harvest them. That's creating this explosion of data, which over the next couple of years is going to become such a factor that that all of that data, it needs to be processed and mined, and insights need to be gleaned from it. And besides industrial IoT and digital transformation, I mean, there are other tailwinds that are driving this notion of creating more data to be processed. There's this move to first-party data. Probably familiar with third-party cookies are going away. So every enterprise that wants to sell something to customers or interact with them now is responsible for collecting their own data. So that's creating all of this extra data, all of these processes where each company is trying to collect as much data as they can about their customers, mine that, generate personalization, insights about trends and such. Business optimization, of course, with challenges with supply chain and costs. Every company in the world is trying to figure out how to use data to optimize their processes, to reduce costs, to become more efficient. And mining all of that data represents a big opportunity. And of course, there's the emergence of data marketplaces, where in order to facilitate that optimization, there's actually a lot of new data that's being made available through marketplaces so that the data can be harvested. And these all represent opportunities that then drive the overall creation of data. And as an example beneficiary, there's Snowflake. So if you're not familiar with Snowflake, they provide at the beginning, they provided a data warehouse solution, which allows these enterprises to process and collect and mine all this data, but they quickly expanded into the larger addressable market over time. And you can see this expansion of their platform and their product set that then aligns with the expansion of their addressable market. So at first they were focused as a data warehouse solution just for each enterprise. Then they realized, well, they could do more than just data warehousing for each individual enterprise by getting into other services to allow those enterprises to exchange data between different departments and make their operations more efficient. And now they've basically extrapolated that out further and call themselves the data cloud, which is really about creating an ecosystem of data across different industries, allowing all participants within those ecosystems to exchange data whether it's with their customers, with their business partners, with workflows of data as they move through either financial services, media, advertising, healthcare, et cetera. And it's gotten to the point now where Snowflake hasn't even tried to quantify their addressable market. They simply have that big circle to the right that says data cloud, whereas previously they had capped it at 90 billion. And there are other addressable markets as well. Of course, we're familiar with probably observability. Companies like Datadog are leaders in that space. Databases like MongoDB, cybersecurity, CrowdStrike, SentinelOne, Zscaler. There's a whole bunch of those, Palo Alto networks. And then application development, which is just this basket of all kinds of services, GitLab being an example of a provider there. What's important about interpreting these addressable market data is that you will often see from an analyst like IDC or Gartner, an estimate of the current addressable market and then the future addressable market, and they'll usually attribute a CAGR to that or the anticipated growth. And sometimes that may not sound that exciting, like 12%, 15%, 20%. I mean, you could probably do the math on some of these, and you might say, oh, observability or databases, that's not really that exciting because it's only growing at 14% a year. But what's important to remember about these is that each year, a large amount of spend is being created, and that spend is usually allocated to the leaders or to the more modern providers. So while databases may only be growing by 12 to 15% a year, that is still creating $7 to $8 billion a year of new spend, and that new spend is generally being associated with the more modern providers. So a MongoDB is more likely to get a bigger share of that than an Oracle or a DB2 from IBM. And then to further support that, there's usually an upgrade cycle that's going on as well. So the legacy providers are getting phased out. The newer incumbents are not incumbents, the newer providers are then winning the lion's share of that. So you could easily see new, in the case of databases, maybe like $10 billion a year of new spend being created that then the leaders in that particular category have the opportunity to take advantage of. So the next factor I'm going to talk about is an extreme product delivery cadence, and my favorite company for this, of course, is Cloudflare. And what I like about Cloudflare is that they are launching new products at a very rapid rate that's even accelerating, and I'll show you here in a little bit, but they each year launch more new products than even the year before, and we just are wrapping up what they call one of their innovation weeks called Platform Week just this week, and they've launched more new products in the past week than almost in the last year alone, and they have several more of these innovation weeks coming up. So when you see a pace of product development that fast, you have confidence that that company is going to be expanding into their addressable market very quickly. So with Cloudflare, their mission statement is to help build a better internet. That's very broad. They provide the tooling to allow both end users and developers to offer services or enjoy the use of the internet more securely, more efficiently, more productively. So that offers a lot of different directions that they can go. And then they rapidly expand their product offerings so that they can expand their reach within different product categories in that large addressable market. And what we then see is that as they continue to expand their product set, their addressable market gets larger and larger, where we see on the left, in 2018, they were just addressing a core set of application services, and they felt like the TAM at that point was 32 billion. Then they layered on some zero trust services and some network services, which kind of started in 2020, and you see incrementally are growing their TAM from there. And then they even have identified some other services in the serverless space, Internet of Things, that they haven't even tried to quantify yet, but they feel like will continue to expand that addressable market. And just for comparison, the zero trust services that they created in 2020, that's essentially the market of like a Zscaler. Palo Alto plays with that a little bit. But what's really exciting about Cloudflare, I think, is the fact that they created essentially a Zscaler in the last 2 years. And now if you listen to the most recent earnings call, the CEO talked about how now they are competing head to head with Zscaler. That wasn't even a product that they had 2 years ago. So it's really I think, exciting to hear about a company that's innovating that quickly. And you can just, this shows the product releases by year, and it also, to emphasize that point of just as each year goes by, they're launching more and more products, bringing more and more products to market. And these aren't just throwing spaghetti on the wall. With Cloudflare and with other companies that I like, the new product introductions are thoughtful, and they're based on feedback from customers. It isn't, and so that as these products get launched, you actually see them starting to get traction. Not all of them do, and it's important that a company launches enough so that for those that don't stick, they actually, will have some that do. But I think by having this rapid pace of innovation, they're almost guaranteed to have some win in the market and to continue to benefit from this increasing size of scope. And another related aspect is those products that they launch should somehow be related. And so in Cloudflare's case, they initially launched in application services up there in the upper left quadrant, but they used the feedback that they got from those services to then expand into other adjacent product categories, whether you're then looking at developer services, network services, the zero trust as I talked about, and all of those build on or have synergies with each other, particularly because the customer set is often the same. It's the same set of operations personnel, leaders of developer teams and security teams that are thinking about these products. And so those adjacencies help them to continue to grow, not just their addressable market, but then their customer spend. And so there's an important metric that emerges from this, which is often called dollar-based net retention or net expansion rate, which measures the amount that a customer increases their spend year over year. Of course, anything over 100% is great because that means that each year their customer is spending more money. Cloudflare has, over the last 2 years, increased their net retention rate from 117% to 127%. We would expect that to continue to go up. What's nice about that is that, again, as they come into each year, they can almost expect that their customers will increase their spend. Of course, that drives incremental revenue growth, and the sales effort is much less. They don't have to go find a new customer each quarter in order to drive their revenue. They actually can realize most of their revenue for a quarter from existing customers. So there are some things that enable Cloudflare's rapid innovation. They have a culture of innovation wrapped around small teams, very much embracing the Amazon like two pizza team model. They're very good at reusing technologies as they launch each new product. These are called as composability and primitives, but the idea is that a product that they launched previously then provides building blocks for the next product, which really feeds into this accelerating cycle of product launches. If you're familiar with their new R2 release, which is like Amazon's S3, they used a prior product called Durable Objects in order to basically provide half of that functionality. So that really helps with this acceleration. They also have a very large free user tier, which provides them with free testing, awareness, getting new network peering relationships, and observing what customers are doing so that the next product release is thoughtful. Of course, leadership focus is really important, and the fact that they have uniform services across their network. And I think the leadership component is really something to hone in on. So I like to see CEOs of companies that are very involved in the product development process. They're aware of what products are being launched. They're excited about them. They're pushing them. You see this with Matthew Prince of Cloudflare. You see this with Elon Musk of Tesla. But what's important is that CEO can articulate the benefits of the product. They aren't just reading from a script. They actually live the product. They understand those benefits. And the reason that that's important is it, of course, has knock-on effects for the company itself. Their ability to maintain a high product release cadence, the ability to attract top talent. Cloudflare in the last earnings report said that they got 133,000 applications for what was about, I think, 1,000 open positions. So their acceptance rate was less than 1%, and they still have very robust hiring. And they also reported that they had record high retention rate of employees during a period of the Great Resignation, when we know that a lot of other companies are struggling to retain talent. So I think that these factors are really important in terms of maintaining a culture of durable growth. So the third factor is really about customer spend expansion. I think Datadog provides us with kind of the poster child for this. Even in their 10Q reported how a lot of their revenue growth is driven by expansion of usage from existing customers. They, in terms of the 3 steps, they identified a large TAM. Observability, which really is a generic term that can be applied to a lot of different things. And they started with application monitoring. Then they've been expanding more recently into security, business operations, developer pipelines. And in those different areas of observability, they've been rapidly expanding their product offerings. They increased the number of product modules for sale by 50% since early 2021. And then they're able to get customers to adopt these. They reported in the latest 10Q that 80% of new revenue in Q1 was attributable to growth from existing customers. And they provide this really useful data to represent this expansion across products. So they report each quarter on the number of customers who use 2 or more, 4 or more, and now 6 or more products, which they have a total of 15 monetized products. And even they've given customer examples where some customers use like 10, 13 different products. But this reinforces this high dollar-based net retention rate, in their case of just over 130%. They don't even bother to report the number, but that's best in class. And it's really driven by this expansion motion of customers adopting, starting with like application performance monitor infrastructure, then adding logging, then adding user monitoring, adding synthetics, and then the 5 new security products. So it's just this gradual expansion of product adoption, which of course then drives their net expansion rate. And what's really cool about Datadog is that not only are they increasing the number of customers that are using their products, getting those customers to spend more, but they're then adding more products to the catalog. So as I mentioned, they increased the number of products that they sold from 10 to 15 within the last year and a half. And so what this creates is, if you're familiar with the land and expand model, I call this land and expand, because now they've got the combination of these 3 different factors really driving this increase in spend from existing customers. And that's what enables them to achieve this extraordinary metric where 80% of their new revenue growth is coming from existing customers in a quarter. And they have this, this is a metric almost I use, which is, this is a grid from their pricing page where they display the number of products that they have that are monetized or that have pricing attributable to them. And I almost use this as a guide to judge their progress. The number of little cells that get added to this honeycomb each year, to me, is like a KPI. And of course, in their case, they added 50% more over the last year and a half. And a lot of that expansion is in the security space, which of course I think is very relevant for observability and what we call DevOps. So those are the 3 criteria that I look for around durable growth in terms of addressable market, rapidly innovating and launching new products, and then expanding spend with existing customers. But I think underlying all of that is the ability to maintain a robust competitive moat. And there's a number of different ways you can do that, which I'm going to talk about. But of course, this is a quote from Bill Gurley where he really reinforces that ability. And he attributes it to maintaining a high revenue multiple or a high valuation multiple, which I think ties to the notion of durable growth as well. So some of the factors that establish a competitive moat: lower cost through scale, network effects, benefits of architecture, high switching costs, and more. And I'll talk about these each individually and provide an example. So certainly AWS, I think you may be familiar, but as they scale, they've been very good about investing in reducing costs for their services and for their customers. They have reduced pricing 107 times in a 15-year period, which is just amazing. And that's just really their ability to take their scale and then try and drive new efficiencies and pass those savings on to their customers so that they continue to increase their market share. And what effect this has had is it really drives out or prevents new entrants from entering the market because that threshold is so high. So it really maintains this competitive set among only the companies that are in the position to actually, invest the capital that's necessary to build a business. And that's why the $200 billion a year business of infrastructure as a service is really captured by 3 companies. AWS has the lion's share, and Azure and GCP kind of carve up a little bit of the remainder. And then beyond that, there's this long tail of small providers. And that's because of this moat of lower costs through scale. So the second is network effects. So the idea behind network effects is that as the number of participants in the network increases, the value to each incremental participant goes up. Or said another way, it starts to bring new participants into the network because they see that participating in the network has value for them. So Snowflake has a very interesting strategy around building network effects. And this has to do with their data sharing. So they allow companies who store data within Snowflake to very easily and securely share data with one another. Although they have this clean rooms capability where 2 companies can share data, but in a private way, so they can run processes against it, not sharing the private data with each participant, but the summary of that, or the intersection that's not private. So that also provides a benefit as it relates to sharing. But what this does is, as new participants join the Snowflake Data Cloud and participate in the network, it actually then encourages new participants to join the network. And we see a lot of anecdotal evidence around this. I listened to a podcast from where they were interviewing the chief data officer of ADP, where he was talking about their use of the Snowflake Data Cloud and how they're distributing data to lots of their partners, and they actually have their partners now say to one another, to a new partner really, hey, you want to consume our data, we could talk about integration points, but if you're on Snowflake, we can make it really easy for you. So you should just get on Snowflake. So what that has this effect of just bringing in new participants into the Snowflake data ecosystem and realizing this benefit of network effects, which a lot of their competitors don't necessarily have. And they measure this notion of network effects through what they call stable edges, which is defined as 2 companies having an active data sharing relationship. In the last quarter, they reported that over the last year, the percentage of customers who had a active data sharing relationship went from 13% to 18%. Which I think is significant, particularly if you layer on the number of customers or the increase in total customers over that time, which was about 60%. So effectively, they doubled the number of customers who had a data sharing relationship in 1 year, and we would expect that to increase. And we see here, this is from their healthcare data cloud, and you see all the different participants in that, and we would just expect that network to become more robust over time. The little blue lines represent connections in terms of data sharing, and we can expect that that's going to be, each time we see a graph like that, it's fuller and fuller each year. So another competitive moat is an architecture advantage. So I think that Cloudflare provides a good example here. And what an architecture advantage represents is investment in a new way of doing things that isn't easily reproducible by other entrants in the market and creates an advantage over other players. So as I talked about, AWS and Azure and Google Cloud Platform investing all this money into their cloud infrastructure products, the architecture associated with those is very much associated with what we call centralized, meaning that they have these big data centers in specific locations across the globe, and those are great for enabling a certain type of application workload. But there's a whole nother set of use cases that benefit from having a more distributed architecture. And in Cloudflare's case, every one of their data centers can run all of the services that they offer in parallel. So as a developer or as a chief technology officer, I don't necessarily have to say, hey, I want all my stuff to be in AWS East, which is in Virginia. I essentially put my applications or my security services on Cloudflare, and they run all across the globe in parallel. And this creates advantages in terms of performance, in terms of security, in terms of enabling certain types of application use cases, but it's that architectural difference that creates this large moat for Cloudflare that is distinct from the hyperscalers, and I think is going to allow them to continue to compete in terms of the services that they offer that are different from what the hyperscalers are doing. Another moat is high switching costs. So this one's pretty easy. It basically means once you get a customer or set of customers to adopt your solution, if it's hard for them to get off of it, then that creates a high switching cost. So a good example of this is a network migration. So Zscaler brings customers onto their security enabled network, which allows their employees to securely communicate with one another, with their data centers, with their offices and such. While it takes a lot of effort for an organization to move their network services onto Zscaler, once they're on Zscaler, it's very hard to get off. So I think that another competitive moat can be looking for high switching costs, where once somebody is on a particular network or uses a particular system, if it's hard to get off of that, then that almost has like this lock-in effect. Cloudflare benefits from this. Snowflake benefits from it as well in terms of data gravity. Once you get customers, particularly with data using your database solution, it's often hard to back out of that. We see that particularly with Snowflake, as a lot of the legacy data warehouses are still waiting to do some sort of upgrade, and Snowflake's enabling those, but there's a lot of data gravity there. Another mode is what I call frictionless expansion. So this has a little bit to do with switching costs, but it more is around the idea of once you, with the proper approach, once you have a presence within a company's infrastructure, if you have a way for customers to easily expand from that initial starting point, then that becomes a moat in itself. And Datadog's a good example of this, where in order for a customer to start with Datadog, they simply need to install the Datadog agent on their infrastructure servers. And that can be, it's fairly straightforward, but that is a process that takes some time to roll out and get tested and make sure that it doesn't have any adverse effects. But once that agent is on the infrastructure for any one of their 15 products, then every other product activation is simply a button click. So maybe you start with infrastructure monitoring, get the agent on all your servers. Well, then if I want to add application performance monitoring, logging, all the security use cases, the developer tools, etc., just a button click within the admin interface. So that seamless expansion then provides, in some ways, a moat by itself, because it starts to squeeze out all of those point solutions. It's very easy for a CTO to say, hey, I just want to consolidate all of these functions onto Datadog's platform, consolidate all of that spend. I can just do that very easily. So that creates kind of a competitive dynamic in itself. And then the last moat is around what I call ingrained user preferences. So if you have a set of users, and in this case, developers who are very familiar with your tool set, then it almost creates this bias as they're thinking about selecting the building blocks for their software applications. They kind of pull from their bag of tools that they're familiar with and say, hey, I am very familiar with this particular database, in this case, MongoDB. I'm just going to suggest that my team uses that, whether I'm part of my startup or part of this new service that my corporation wants to launch. And some of the drivers of that is that MongoDB has been downloaded over 200 million times worldwide, the community version. And it's a very popular database to bootstrap college programs and computer programming boot camps. So you have a lot of developers who are already familiar with it. And DB Engines is a kind of a site that measures popularity of different databases. And you see what happens here is that MongoDB's popularity score is 6 times higher than any of their competitors. So that's kind of the net effect of that familiarity, which by itself creates a moat. You see that their biggest commercial competitor is Couchbase, and if you look at the Stack Overflow survey, Couchbase is down there at second to the bottom. So that creates this huge competitive advantage that MongoDB has over companies like Couchbase. So hopefully this has helped you kind of create or envision a framework for identifying companies that are going to have durable growth. Like I said, you can take this framework and these principles and apply it to other sectors outside of software infrastructure. As I mentioned, I think Tesla is a really good example of a company that embraces a lot of these similar principles, large addressable market, entering all kinds of new product categories, whether you think about not just cars themselves, but transportation in general, energy, and AI and these other things, robotics, that appear like they're launching pads for whole new adjacent categories of growth. And of course, they have a CEO who embraces product innovation, and they have the ability to create network effects and capture this audience that's very kind of excited about their product offerings. So certainly you can use these same principles to evaluate your other companies or sectors that you think are exciting. Again, whether it's financial services, energy, or other categories. So that's what I have for you. I think we have a little bit of time for questions. If anybody wants to, yes, just stand up and ask me a question. Yes.
Yeah. So I think cybersecurity and you and Ray is pretty strong tailwind in the markets today. This area that you're speaking about. How do you look at the most effective way to look at cybersecurity? It's kind of like network based with like a Zscaler or a Cloudflare versus we talked about Datadog. How do you think about different ways to approach investing in cybersecurity?
Yeah, no, I think that's a great question. So first, obviously, you start with the TAM. The addressable market is big. There's huge tailwinds behind cybersecurity currently. I think we're all familiar with those. So that's the first checkbox. And I think the second is looking for a company that has a good foundation in one of the categories of cybersecurity, and you covered three of them, in terms of network services, endpoint, and then security monitoring in terms of the data. So I think that first identifying the leaders in those three categories are important, but then I think I think that gives each of those companies like nice tailwinds for now. So if I were to pick, I'd say, okay, well, in endpoint, CrowdStrike, I think is clearly the leader. There's strong tailwinds, and they're continuing to expand the number of customers who use the different products that they offer. I think Zscaler on the network services side, and then a Datadog or maybe Splunk, you could say, on the SIM side. But I think what's interesting for me is thinking out then over the next 3 to 5 years, what is going to be the shape of cybersecurity, and what are then the opportunities for any one of those players to expand beyond the categories that they're in. So that's where I think it becomes interesting. So you see CrowdStrike starting to get into the security monitoring side, or they call it observability. It's not really observability, but it's observability for security with their Humio acquisition. So I think that's very interesting because you see them bridging over into kind of the data side of security monitoring beyond just the endpoint protection. Of course, you have Datadog that's doing the security data monitoring, and then they're moving into application security. They made it clear they aren't going to move into endpoint, so they've kind of capped that off. And then on the network side, of course, I'd say the incumbent is Zscaler, but now you've got Cloudflare coming at network security from the same model as Zscaler, but now they're kind of have the potential to, I think, do some interesting things as it relates to really endpoint security. If you think about the network as being the way to reach any endpoint, if network security becomes good enough, do you really need endpoint security? You probably do, but it may not be as important. I've used this analogy before. It's like, well, like if you have a house, you could spend a lot of money securing your house, put cameras all over and locks and monitoring systems, but people have to get to your house, whether they walk to it or they take a road. And if the monitoring on all the roads is good enough, you probably don't need that much security on your house because, somebody knows that the criminal's coming down your road. They'll call the police before they even try and break into your house. So I think there are some interesting dynamics going on in security. And that's kind of how I'm thinking about it right now in terms of really, I think right now you'd probably be safe investing in any category of security, honestly, but I think that over time it's going to be interesting how that space evolves, particularly the influence of the network providers. Sure. Yes.
I guess in the last decade or so, we've seen a lot of evolution of large cap companies going cloud. I just want to get your thoughts on smaller, medium companies going cloud, such as DigitalOcean. Your thoughts on that versus smaller.
Yeah, that's really interesting. And, DigitalOcean, I think in their case, it's about the customer that they're trying to appeal to. So instead of necessarily going to the big enterprises, they're going after the small and medium-sized companies. And we've seen this in other categories. You could take CRM as a good example, right? So you have Salesforce who went and kind of dominated this space, went after all the big enterprises. And then here comes little HubSpot who says, hey, we're going to go after the small to medium-sized players. And that's actually, and for a long time, analysts poo-pooed HubSpot's potential by saying, well, they're not going to capture enterprise spend, but they've actually created a very robust business out of going after small to medium size and in some cases expanding into enterprise. You could argue DigitalOcean has the same potential. I think it's going to be a steeper hill for them to climb, probably going back to some of the things I was talking about as it relates to not just network effects, but then the scaling and costs. But it is an example of how a company can be successful in a space that seems to be dominated by other incumbents by focusing on a particular customer category and making a solution that appeals to that segment. And I think that's where DigitalOcean will probably be successful. I don't think they're going to be a hyper growth company per se, but I think they'll consistently deliver 30-40% of revenue growth year over year, just because there's such a huge addressable market, 200 billion. While AWS and Azure and GCP have, like 60% of that, there's a long tail of of spend that I think is available for the smaller players. Yes. Right. Yeah, no, I think that's fair. I think there's some, I don't know, not trickery, but certainly it's easy to inflate the TAM. I think what's important as it relates to TAM and how you think about it is, deciding whether there really is tangible spend associated with that. And I think focusing on enterprise spend becomes important versus like consumer spend, because to your point, if you think about like consumer offerings, it's necessarily, I think, hard to like figure out, okay, what share of wallet you can get from each person, each human, and is that going to change over time or be durable? I think enterprise spend is probably a little safer bet. And I think we'll have a little more, lasting power, because it's, enterprises come up with budgets that they have to stick to every year. And as we talk about software infrastructure companies, they'll figure out their budget of, hey, I want to spend $10 million this year on observability. I'm probably going to spend that. Whereas, a consumer, you may decide you're going to spend a certain amount on your vacation and you change your mind 2 months later. So that might be a way to think about it. But I agree. I mean, addressable market, I don't put as much weight in that as I'm evaluating companies. In some ways, it's just a quick checkbox, like, okay, are they addressing, something that's large versus, accounting software, something that's small. And I'm more interested in the large addressable market, but I don't necessarily try to get too nuanced in terms of one versus the other. All right, I think we're at time. So thank you, everyone. Hope that was useful, and come find me afterwards.
new Benzinga Pro. After the event, you're going to get an email. It's going to have a link, and you're going to have the fastest, most accurate, real-time stock market news, alerts, etc. in the world. So it's only $200 a month. You're getting it for basically that's the cost of the ticket. So there you go. The second thing that I have, you guys are going to hate me for, but I've done this at every event that we do, and I'm telling you, just trust me, it does help with the learning, is a quick little stretch session, okay? We did it in the other room earlier. You guys got another hour to wake up, but let's all stand up. 2 minutes, all right? I'm telling you guys, it's going to wake the brain cells up. It's going to get the blood flowing. Be aware of your surroundings, all right? So we'll do a little bit of arm windmill, okay? There we go. Now we're getting loose up, all right? Our arms overhead, over to the right. Okay, 2 people got the right mixed up. That's okay. Arms to the left. A couple people still off. That's all right too. Next one, arm across. A little bounce. Bounce is critical. All right, there's the bounce. Let's bounce over to the other side. Okay, a little more bounce. All right, and now we're ready to keep going. Woo! All right. Thank you guys. And again, my name is Luke with the Benzinga team. Anything you need, around all day, let me know. Awesome. I don't know about y'all, but I'm feeling limber. Thank you, Luke. Awesome guy. All right, with that, we are going to roll right into our next one. Next up, we are going to have Gary Black. When I saw Gary on the schedule, I was super excited to hear a presentation. We've interacted on Twitter. Gary is one of the managing partners at the Future Fund LLC. He's also actually a registered SEC investment advisor, although none of this is financial advice. I'll put that disclaimer out there. But yeah, without further ado, Gary Black, excited to hear from you.
So I have a ritual when I come to Vegas. I usually, like to start with a couple drinks, take the edge off, so I'm thinking clear before I drop $20 on the blackjack table. And everybody's got rituals. People, they get on planes, they pat the plane before they go. LeBron throws chalk up in the air. I drink, and so I did that last night. I got here about midnight, and went to the Alibi, and I had 2 or 3 drinks. Went to bed, and I woke up, and the world's back the way it's supposed to be. It's S&P's up 2%, Nasdaq's up 4%. All my shit growth stocks are up 10-20% today. Even Bitcoin's up 5%. So the world is good again. So what I'm going to do today is try to talk about the new environment we're in. Everything changed about 6 months ago when the Fed realized that inflation was not transitory and it was going to be lasting. And they started embarking on this. It's the most aggressive tightening campaign in 40 years, since those of you old enough to remember Paul Volcker. And so as a result of that, you have to change your portfolios. You can't, just invest in things that, have good subscriber growth or good revenue growth. And I'm going to talk a lot about this. There has to be a path to profitability, or the portfolios aren't going to work. And so I'm going to try to give you a couple tools to think about today, talk about the environment we're in, and see where we go. And I'm trying to leave some time for questions. So just some key thoughts. We know that the Fed is willing to risk recession. Powell said as much the other day. He says, look, I may not be able to engineer a soft landing. And for those of you trying to figure out why the market's up today, Powell made some comments yesterday that he still thinks more than 50 basis point rate increases are off the table. And that reassured everybody. I don't know why, because he has said that in the past, but market was willing to root for anything after the last couple of days. But be aware that usually when Fed chairman, they want to navigate employment and price stability. And what he's basically saying is, if we have to go into recession to get inflation down, we're going to do it. And I have some thoughts about that in a minute, but I'll just give you the punchline. I believe that because of COVID, and I'm going to show a couple charts, you had all these cost-driven price increases and constraints. And as COVID goes away and as the economy reopens, a lot of those will go away anyway. But the Fed is going to fight it. And look, there's an old rule in finance: you don't fight the Fed. If the Fed's going to take rates up, you got to be willing to deal with the pain that comes with that. And in my world, as a growth stock investor, when rates go up, long duration assets get crushed. You see it with Bitcoin, you see it with Tesla, you see it with all the stocks that we talked about in the last session. That a lot of them don't have a lot of profit. They're long duration assets. They're going to get hurt. So you have to understand that as long as the Fed is willing to raise rates to put us into recession, if you want to make money investing, you really have to change your portfolio a little bit without losing your style. Since point number two, since this pivot back in November, was the first day of November, was their Fed meeting, value stocks have crushed growth stocks. You'll see that if you just invested in a basket of large cap value, you're only down about 8%. Those of us who like growth stocks and invest in growth stocks for a living, down 25, 30%. So again, you can't change your stripes. It's your personality and what you like to invest in doesn't change. And I would say don't try to change that. Just try to move it a little bit along to recognize you're in a different environment. One of the things that's very hard for me is a lot of the previous hot sectors are being abandoned. You've seen that with EVs, which I like. Tesla is our largest position at the Future Fund, and I'm going to talk a little bit about Tesla. But when Rivian goes down or Canoe says, look, we're going to have trouble even staying in business, it drives everything down. And you've seen that if anybody follows any of Kathy Wood's ARK portfolio, and I worked with Kathy years ago, she's down 40, 50%. I think it's 50% this year because she refuses to just, give up on some of the stay-at-home stocks that she's had. He was talking about Zoom, Coinbase. There are other stocks that she has that she just keeps buying more of. And I think that's a mistake because you have to recognize that some sectors that work really well when interest rates were going down are not going to work as interest rates go up. I think the best advice to have in one of this environment of rising rates is you got to concentrate your highest conviction names. So if you're used to running with 40 or 50 stocks in the portfolio, run with 20, run with 30. Run with the ones that you think are going to work best and shorten the duration. So again, if you've got stocks, and again, I'm not going to pick on stocks that don't make money, but if you have a stock like Rivian or Snowflake or CrowdStrike or Shopify, these are all great growth names. They don't make money yet, and so they're not going to work very well in an environment like this. So the way to shorten the duration is you pick something that does make money. Bless you. Pick something that has, short duration. Now Tesla is a good example. Tesla is actually a more moderate duration stock. It makes a lot of money, and it's generating a lot of free cash flow. And when I tell people, hey, look, Tesla's only trading about 60 times. That's a low number for me. And only 40 times for next year. That's a pretty moderate duration type stock. It's not GE. It's not General Motors or Ford, which I could never own. But it's why it's our biggest position. Google's our second largest position. People are making fun of Celsius. Celsius is up 40% in the last 3 days. That's a long duration stock. It's a very high multiple stock, but it's gotten absolutely trashed in the last 6 months. And that's our number 3 stock. And this theme about profitability, make sure that you can see a path to profitability. Even if it doesn't make profits today, you should be able to say, okay, within a year, based on revenues increasing, costs not increasing as fast, margin expansion, you should be able to see that it's got cash flows and profitability within a year, or it's going to be a hard stock to own in this environment. And then last thing I try to convince people of is you got to hedge. You just can't own a Tesla or a CrowdStrike or a Shopify and forget about it. You've got to figure out ways to hedge the portfolio. And I'm going to talk a little bit about some of the tools we use. We use options. You can short the calls, use the proceeds to buy a put. It's a cheap way to go. Or you can just identify names that offset it. A great way to short, to hedge against Tesla is you short Rivian or Nikola or something that isn't going to do as well in the future environment. Okay, so since the pivot, which was in November, value stocks have crushed growth stocks. And again, I wouldn't say you should just go out and buy GM or Ford or GE. For a growth manager like myself, I couldn't do it. I'm just not equipped, from a personality wise, to buy stuff that's beaten up, that's losing share just because it's cheap. With growth stocks, I look for innovation, I look for disruption, I look for stocks that can capitalize on the mega trends that we've identified that act as tailwinds to build good revenue growth that can be sustainable over time. So I had a boss once who explained the difference when I was at Alliance Bernstein. He explained the difference between value and growth. He said to me, and it's always been a good thing for me to remember, that value managers bank on reversion to the mean, and growth managers pray for no reversion to the mean. And so value managers, when they buy a stock, they're assuming that the pricing, the margin structure, the PEs will all revert to the mean over time. Their view is that if a growth company has a first mover advantage and gets into a business, the competitors will come in and will whittle down the margins. So they believe in reversion to the mean, and their whole investment philosophy depends on reversion to the mean. Growth managers such as myself, we think we can get out before the party's over. We think that we can, build our quarterly models and figure out when somebody's going to disappoint. And the reality is we can't, but we pray for no reversion to the mean. We hope that the growth can continue at Tesla for 50% forever, because the first quarter they miss it, for a reason that's not explainable, the stock's going to get crushed. And that's the challenge with growth investing. So just some basics about growth investing. We look for top line growth of at least 15% a year. I like to look for unit growth of at least 15% a year because I don't want to depend on pricing. So again, if you've got a company that's got subs growth of 15% a year and not getting ARPU growth, that'll qualify. Because that means every 5 years, if you do your math real quick, you're going to get a doubling in the top line. I look for positive revisions, meaning I don't want to see companies cutting estimates or missing estimates. We try to find companies where, if you look at the beginning of the year and you look where you are now, the analysts are taking estimates up, because that's the quickest way you can get appreciation when you own a stock. You get positive revisions. As I mentioned before, we look for a megatrend tailwind. I'm going to go through the megatrends we've identified, not just in software and technology, but we've got some megatrends that we look for across, we'll say, the world. We look for expanding TAM. And TAM to me is if I have a hot product in the US, I bring it to China or I bring it to Europe. Or if I'm in one category, like sedans for Tesla, and I bring out an SUV, that's expanding your TAM. And that's the quickest way I found to make money. You look for unlevered brands, where you have a brand that means something to one segment, you could take it to another segment, and the consumer says, okay, that makes sense to me and I'll buy it. We look for a first mover advantage, and we look for moats, and we look for a management team that's credible, experienced, that can deal with the ups and downs of growth investing. Sometimes it's hard to find companies that have really deep management depth. And so you use Tesla as an example. You've got Elon, but people have a hard time identifying if Elon were to get hit by a bus, who would take over from him. And that's one of the reasons why a lot of institutional managers don't own Tesla, because they don't like the key man risk. And again, as I've tried to make clear, you got to have a clear path to profitability now, where, again, 6 months ago, before the pivot, we didn't worry so much about that as growth managers. Okay, so megatrends. We have 10 that we've identified. These are the trends that we think are changing the world over time. They're long-term trends. So we think about social networking. A lot of advertisers are saying, I don't want to advertise anymore on the traditional media. The money is better spent if I go on social media, track the users, try to figure out, why people are buying my product or paying attention to my product. Mobility is a huge trend. People don't need to be chained at their desks. They can use their phones. Or they can use their iPads. They don't have to sit behind a computer anymore. E-commerce replacing bricks and mortar. That's been a trend for many, many years. And again, these trends don't mean that you just go out and you buy something like Amazon. In fact, we're actually short Amazon, and I can go into that in a minute. But it's just a trend you have to think about. Climate sustainability is a huge trend. That's not going to change, and it's true all over the world. Automation, big data, and security. People living longer is a trend, and it applies in lots of ways, that the average age keeps getting older. And what's also interesting about that one is you don't have kids today deciding to get married when they're 25 and having children right away. People are living at their parents longer. And so that's a big trend that you have to consider. FinTech, big data as it relates to financial investing is a trend that we've put a lot of money behind. Lifestyle betterment is just what you're seeing as people get more money. They go on trips, they spend it. Luxury goods are huge right now. You see people willing to spend money for, if you're a woman, a very expensive bag, expensive shoes, going on Airbnb, going on trips. That's a trend that we think is going to continue. And there's a cyclical part of that is as COVID goes away, people are much more willing to travel. And then 24/7 information entertainment. You can get anything you want now, research, info, entertainment on your phone 24/7. That is very different from where we were, again, even just 10 years ago. So those are the mega trends that we've identified. I said up front, I'm not that concerned about inflation, and I'll tell you why. Because, and I'm going to show you a chart in a minute, when you look at what happened in 2020, you actually had deflation because of COVID. Everything shut down. You're seeing that again in China. Not that they have deflation, but when things shut down, there's a lot of pressure taken off the system, and you don't have a lot of cost increases. And when the economy reopens, there's shortages. And what we saw as the economy reopened last year, things like car rentals, airline flights, hotel rooms, all went through the roof. And so I like to look at this and say, okay, as the economy continues to reopen, assuming we don't have another bout of COVID, what's going to happen to inflation? Inflation will retreat. And so I take that, plus there are these 4 secular deflationary forces that have been in place for years. And the 4 are automation, so substituting machines for labor, price transparency. You can get on your phone and you can find out what the right price for anything is. Global sourcing, you can go anywhere you want in the world to try to manufacture something. And then demographics. Elon Musk has talked a lot about this one, but a declining birth rate around the world. And when people are retiring at the age of 65 or 70, or whenever they retire, they don't consume as much. And the baby boom generation, which I'm part of, we're all going into retirement age. We're going to consume less. So demographics is a huge deflationary force from a secular standpoint. As I mentioned up front, you got to balance that against, COVID spiked inflation up. The Fed is trying to bring it down, but I would argue the Fed's, fighting last year's battle. And the one thing about the Fed, Jay Powell's a very smart guy. He will, and his Fed will see the data as it comes in. First quarter GDP was negative. If you start seeing employment trends head down, and if you start seeing, maybe a second quarter GDP number that's negative, they will adjust. They won't. Right now, the market's thinking they're going to raise rates 7 times this year. I think as data comes in, they say they're data dependent. They could adjust it. And the thing you have to know about Powell, he is a dove, meaning he's much more inclined to go with very aggressive, we'll call it monetary policy, if things start to look bad. He's not one to really worry so much about inflation. And as I mentioned, as the economy reopens, the supply constraints will ease. Okay, so this is the chart I use, CPI, X food and energy, because they result in wild peaks. And this is over time. And what you could see that month over month rate was about 0.2 for a long time. Then you had COVID and everything shut down, and you had the deflationary spike in 2020. And then things reopened again. And again, you had huge inflation in airlines, hotels, car rentals, used car prices that really pushed inflation up to about 0.8, 0.9 on a month over month basis. That number has come down, and it's been coming down. That number peaked in April of last year. So what happened this week, or was it last week? It was this week. The inflation reading came in at 0.6 for a month over month, core, ex food and energy, and people were thinking 0.4. And that's why the market fell on Wednesday, because people were thinking, okay, well, inflation is actually getting worse again, even though the trend over the last 6-12 months had been coming down. And so Powell coming out yesterday and saying, look, we see it, but we're still keeping anything more than 50 basis points, as he says, under the table. It's not on the table right now. That's what's caused the market to go up today, because people were assured that the Fed wasn't going to suddenly just change its stripes just because inflation was a little bit hot in April. And I would think over time, as the economy continues to reopen, as people go back to work, as a lot of these supply constraints ease, you're going to see inflation come down naturally. Plus, we have the Fed raising rates at the quickest pace in 40 years. So I'm not that worried about inflation, but once you see inflation come down, you're going to see the market take off again, even though it's felt miserable this year. And so inflation expectations are what everybody's worried about. You can look at the 10-year Treasury compared to the 10-year TIPS, and that gives you a measure of inflation expectations. They're the highest they've been in about 15 years. And so you could go back to 2020, you can see the inflation expectations were extremely low. But again, look at the bottom, the far right of this, you could see that they have been coming down. They probably continue to come down. But we're off to the worst start we've had in 90 years. 1932, while we were in the middle of the Great Depression, was the only year that we've gotten off to a worse start. And this was as of last week. So year to date, S&P is off 16%. So look at the first 88 trading days of every other year. The only year that was worse than this was 1932. And so I look at this and say, does that really make a lot of sense, given that the economy is still okay? It's still pretty vibrant, and inflation's coming down. And inflation is the big boogeyman. And one of the challenges, you have China, which they had the first bout of COVID, and now they have another bout of COVID. There's a lot of debate. It doesn't make sense to lock everything down when there's COVID. I'm hopeful that as people take off their masks, as people get together again, you don't see another bout of COVID, because if COVID comes in, plus you have inflation, that's stagflation. That's the worst of both worlds. But for me, being down 16%, things look pretty cheap. And I have a couple charts just to show that. So you could look at the big growers. The big growers are like the top 500 growth stocks that we look at. You take the universe, it's really Russell, large cap growth, and some medium cap growth. And you look at enterprise value to sales. And you could see that, basically it got very, very high. Now it's about 2.2 times. That's very cheap. The low of the last 40 years is about 2 times. On average, it's been about 3 times. So I think about enterprise value to sales as being a good barometer for how to think about growth stocks, because not all of them make money. We're pretty low right now compared to where we've been in history. So you're buying stocks cheaply. And then here's the other thing I tend to look at. I try to look at, people say, well, stocks are still expensive, aren't they? So if you take the PE ratio on the S&P, right now it's about 17 times, a little bit below 17 times. Flip that over, that's an E over P yield, or an earnings yield, okay? So you flip that over, that's about 6%. So 17, 1 divided by 17 is about 6%. The 10-year Treasury is 2.9 today. The difference between an earnings yield on the S&P versus 10-year Treasury is about 3.1. You rank that versus the last, where those numbers were over the last 50 years, that's this chart. And you can see that equities are offering a very high earnings yield relative to 10-year Treasury. And so that's one of the reasons when people say, well, stocks are so expensive still, they really aren't. When you look at the average over time, is about a 2.5 basis point premium. Today we're at about 3. And so I think stocks are very cheap right now if we can somehow stay out of recession. And then this is a regression chart. You can look at over the last same period, you look at where the 10-year Treasury is and where the S&P is. And there's a formula if you can read it, but it's basically 21.9 times, and then you subtract out the 10-year Treasury times 0.9. So if you do that and you say, okay, where should regression-wise the S&P PE be? It's about 19 times today, and we're at about 17. But one of the other things people ask me about is why do you have this kink in the curve? At very, very low rates, you see PEs go down, because that usually means you're in recession. And people don't want to be buying equities when you're in recession. So where we are right now at about a 3% 10-year, we should be at about a 19 PE if you just look at the last 50 years. Now, if you start getting out to 5, 6, 7, 8% 10-year Treasury, because we can't control inflation, then the PEs are going to drop and the market's going to continue to take on water. Okay, so when I own a stock, and I'm going to talk a little bit about Tesla because I spend a lot of time on it. It's our largest position. I really almost use it as a kind of a way to kind of bring together some of these concepts. I always want to have an investment thesis. And the reason I want to have an investment thesis is when you have partners or you have people who work for you, you have to have an articulated reason why you own something, so that if that changes, somebody can say to you, well, that's not the reason we own the stock anymore. Because it's very easy as an analyst, if they miss numbers, to say, well, here's the reason I own it really, even though that the original reason you owned it doesn't apply anymore. So my thesis on Tesla is EV adoption is about 6.5% last year. That's it. So you look around the world, the percentage of cars that are battery EVs as opposed to hybrids. It was about 6.5% last year. That will continue to go higher. In fact, in the first quarter, it was 9%. And we think by 2026, so going out 5 years, it'll be about 36%. And Tesla is the EV share leader. They have about 20% of that business, okay? So they're the only scale manufacturer in EV space, which is really important. Elon Musk has said many times, prototypes are easy, scale manufacturing is hard. He's right. That's one of their moats because they have scale manufacturing. And as long as they keep expanding capacity, and as long as they keep expanding their TAM to markets they're not in, which they've been doing, we believe their volumes can grow by 50% per year, which as long as margins stay where they are, that means earnings can grow at 50% per year. And so by 2026, we have almost $60 in earnings at Tesla. This year it'll be about $12.40, give or take. And then you have to figure, okay, in 2026, because you're using 26 earnings, what will the PE of Tesla be? And again, Tesla's PE has been as high as 100. Today it's about 60 on 2022 earnings. We think by then it'll fall to about 40 times because the growth rate has to slow as it gets bigger and bigger. But we still think at a 40 PE, it's worth about $2,300. We then discount it back, which is what we do with all of our names to come up with, oops. Let me see if I can get back to where we are. Is there an easy way to do this, guys? Peter had a lot of charts. Let's see. There we go. Okay. So take 40 times 58, you get 2320. We discount that back. Oh, it says it up here. I don't know, guys. We got a little technical. Oh, there we go. Hold on. Okay, good. Thanks. We discount that back. What we do is we take a risk-free rate. So as the 10-year treasury goes up, we raise that discount rate. We use right now at about 12.6% discount rate on earnings to come up with our price today, which is about $1,500. So Tesla's having a nice day today because Elon Musk decided he's maybe not going to buy Twitter. We can talk about that if you want. But the stock's rallying very strongly. It's up 7% today. But it really has gotten crushed over the last 6 weeks or so since he started thinking about Twitter. And the reason is because he sold some shares to buy it. And people worry he's going to have to sell more shares to finance this thing. So that's one of the reasons why the stock's up a lot today. So let me just show you this. We try to do everything from the bottom up. So as I said before, our thesis is driven by global EV adoption expanding. It was about 6.5% last year. But you can see that we're in this spot where this is really accelerating. And if you look at around the world, it's all over. It's being driven by Europe. Europe has been the leader at adopting EVs. You go to Norway, it's about 70% today. Netherlands is up about 30%. But every European country is embracing EVs. China, because the government has been sponsoring it, and there's about 3 or 4 players that are driving this in China, there's also a very high percentage of EVs. The U.S. is very low. And even though Biden has made EV adoption one of his big initiatives, we really haven't seen much EV adoption in the U.S. He has said that we're going to have an EV credit as part of the Build Back Better plan. But because the Senate and because Manchin has said he's not really fond of doing anything for EVs, this thing seems to be kind of dead right now with getting more credits to get people to buy EVs. So that's why the U.S. is still very low. And then the other thing that I always look for is, as I said up front, positive revisions. This is a Bloomberg chart. If anybody always asks, well, where do you get your charts? If you want charts like this, you got to spend about $2,000 a month for Bloomberg, which immediately people say, I don't want to do that. But I look for positive revisions. So this orange chart shows that the analysts have taken their estimates up, and you can look at by when. You can see over different periods, about 37% this year. So if you look at the beginning of the year where Tesla earnings were started, and you look at where they are today, they're up about 37%. I look for charts like that. You can do this for revenue, you can look for earnings, but that's one of the great reasons why Tesla has done very well over the last couple of years. We got involved with Tesla back about $40 a share in the middle of 2019. And there was no earnings. It was basically just about to turn positive. And the reason we got involved, again, just from learning standpoint, is because they were basically expanding their TAM from sedans to SUVs. They were bringing out a cheap SUV, the Model Y. How many people have a Tesla in here? Anybody? Wow, that's a lot. The Model Y was just coming out. It's now become the best-selling EV in the world. And they were going into China. And they had always previously just exported from the US to China, but now they're going to actually build in China. And those two things are what caused the stock to go up 740% in 2020. And it was up another 50% last year. And I think by the time we get to the end of the year, Tesla will take off again because they keep beating the estimates, and the analysts keep raising their earnings. They're going to earn about $12 this year, about $20 next year. And again, if you do the math with the stock, in the sevens, it's a pretty cheap stock at this point relative to its growth rate. And so one of the other things that Tesla's doing, and I'm a big believer in this, is stock splits. They have told people they will split their stock. You've seen Google announce, Amazon's announced. I'm a big believer in stock splits, not because you could take a pizza pie, you split it into 8 slices and make it worth more. It's the companies that split their stocks, managements are usually very confident about the future, right? You're not going to split your stock if you think that things are going to get worse and your stock's going to go down. And so one of the reasons that you see that 12 months from now after a stock split, this is a Bank of America study, companies that split their stock outperformed those that didn't split their stock by 16 percentage points. That's a big number. And I believe, now Tesla hasn't announced the exact terms of their stock split, but they will probably do it mid-June. They've told people at their August annual meeting they will get that approved. And I'm a big believer that when you see companies split their stock, whether it be Google, Amazon, Tesla, Shopify, they're all splitting their stocks. The stocks do well once they go down by, if it's 10 to 1, it'll go down 90%. And so that's going to happen this summer. And you might want to think about that. Okay, when do we sell stocks? We sell them when they hit the price target. So if we have a $1,500 price target on Tesla, we will get out of it at $1,500 unless we raise our price target because we're more optimistic about future earnings. We like to buy stocks when they have at least 2 times upside to downside, and we usually probability weight it. So if we come up with different scenarios, we put probabilities on them. If it's got 2 times upside, we'll buy it. We usually start selling a stock if it gets to 0.5 upside downside. So again, if you're a Tesla and it seven, let's say it's an $800 stock, and we think the upside is 200, but the downside is 400, we will start selling it. Okay. Second, the investment thesis. We talked about that before. If it changes, and the worst thing I have as a portfolio manager is when an analyst comes in and says, "Hey, I know they missed the numbers, and here's why we should still own it," but the investment thesis has changed from where it was before. So, for instance, if it was global EV adoption was growing, and EV adoption suddenly stops, that would be a change in the investment thesis, and that would be a reason I might sell the stock. Third, as a growth manager, you worry about this. If near-term expectations get too high. So you may like a stock, but if the estimates get too high and they're going to miss a quarter, we would trim it back. We would hedge it, or we might even sell it. And you said it all the time. You've got great growth stocks that miss a quarter or they guide lower. It's usually temporary, but if you miss a quarter and you've got 100 PE stock's going to go down 20%. We've seen that repeatedly. And if fourth thing is if they change their strategy or they change their CEO, like if Elon Musk were to suddenly say, "Hey, I don't want to work at Tesla anymore. I'm going to go be CEO of Twitter, and I'm going to let somebody else run Tesla," we would probably be out of the stock. So that's 4 reasons why we would sell a stock. Okay, how do you hedge? What we like to do the most is we like to find stocks, especially for big positions, that offset the risk. So it's something like Tesla, Rivian or Nikola or Ride or any of the other EV companies that aren't making any money, don't have any scale, are great hedges against it. So this way, if you're right on Tesla, but the market goes down because interest rates go up, at least you're hedged. And we try to do that with a lot of our positions. That's something I would recommend, but some people just don't like shorts. Some people are glasses half full type people. They don't like looking at the glass being half empty. It's a personality thing, you know, and you don't usually see people that like thinking about longs and shorts. Usually you're good at one or the other. Second is what we call covered call strategies. You could sell calls on Tesla. So if the stock's at 800 and you want to go out a couple of weeks, say it's not going to get to 1,000, you could collect a premium on that. That gives you some premium to offset if it goes down. But what I like to do then is take those proceeds and buy a put. Some people call them risk reversals. Sometimes people call them covered puts, but I like to actually take the premium and buy a put with it. The problem with that is it still tends to be expensive. And then the third way you can do this is you can find ETFs that really mirror your portfolio. And it's hard to do this to find an ETF that, you know, if you take all the names in a portfolio and use that to hedge your long positions. But over my years, I've become a fan of long-short portfolios. I think once you try them, you tend not to go back to long only because like in an environment like this, when the market seems to go down every day, other than today, it just feels good to know that you've got some things that are offsetting your longs. The only thing I would say when you're going to try something like this is just avoid situations where you just have a clear bias, where you're long growth and you're short value, for instance. If you're going to be long growth, you should be short growth as well. So long Tesla, short Rivian. Okay. And then just in terms of how we value stocks, we tend to use price earnings to growth. It's kind of shorthand. It's kind of cheating. You could do a DCF, which I'll talk about in a minute, discounted cash flow on every stock portfolio, but it's hard. And a lot of people just don't have the time or inclination to do that much work. Price earnings to growth is probably the most common thing. I like to buy a stock that's trading at a PEG, price earnings to growth multiple, of less than 2. I always look forward. So I look at forward PEs versus forward growth. It doesn't do anybody any good to look backward at PEs. So I would look at 22 PEs versus 22 to say 26 growth. And that'll get me a PEG ratio. And again, I like to be at less than 2 times. Another thing people like to do, because a lot of high growth companies don't produce earnings, there is no PE. They look at enterprise value to EBITDA versus revenue growth. And it's another thing, again, less than 2 times. People will use that as a good valuation metric. The last one is the easiest and its cleanest way is to calculate a discounted cash flow on every company. And there's really 2 ways to do it. You can forecast free cash flows and discount it back at the cost of capital, or you can forecast earnings, which is easier, and discount it back at the cost of equity. They both usually result in the same thing, but here's the point. When interest rates go up by 150 basis points, and when I mean interest rates, I'm talking about long-term interest rates, because that's what you would use to discount a cash flow. You wouldn't use short-term rates. The 10-year treasury has gone from 1.5 to 3. Your cost of equity or your cost of capital has gone up by a lot. So any long duration asset has to be worth less. Last 2 points on this. Terminal value is the most important input. And so what I do is I try to come up with a PE at the end of my investment horizon compared to the growth rate. So again, with Tesla, we use a 40 PE because we think growth will slow to about 20%. That's 20 times. And then, as Peter said before, the hardest thing to figure out is what's the sustainability of the growth rate. It's probably not the most important variable, but it's the hardest thing to estimate, that if a company's growing at 50% today, what's it going to grow at over the next 5 or 10 years? Because as you get bigger, competitors come in, and it wears down the growth rate. Okay, so to summarize, we're in a period because interest rates are rising, growth multiples are being re-rated down. That's a term you hear a lot. The Fed is likely to push us into recession, even though we think a lot of the inflationary forces are already retreating as the economies open and as COVID goes away. You want to concentrate your best ideas in an environment of rising rates. You want to shorten the duration of portfolios. So I love Shopify as a name, but I can't own it because it doesn't make money. And in this environment, I know it's going to get squashed until interest rates go the other way. So we don't own Shopify today. You want to identify, you don't have to take my mega trends, but you want to identify mega trends that act as tailwinds. And a lot of mine are very common sensey when you think about it. But we use those to say, look, and I do this with my partner, does it fit one of the mega trends or 2 or 3 of the mega trends? Because we want to make sure there's a mega trend tailwind. Make sure you have an investment thesis for every name in the portfolio so you can keep yourself honest to say it's changed. And make sure you have a clear sell discipline that says, okay, when it gets to a certain point, I'm going to sell it. And I would say, look, I have a lot of respect for Kathy Wood at ARK, but I haven't seen much sell discipline that when a stock gets to a certain point that she should be selling it. And then the last point I'd make, and it's flipped off at the bottom, valuation support matters a lot in a rising rate environment. There has to be a clear path to profitability as rates are going up, because you've got to protect yourself when rates go higher. And they're going to go higher. No question in my mind. Okay, we have time for questions. Yep.
In your Tesla thesis, it looks like you're basically sold out of
So that's a good point. So with Tesla, we made the decision a long time ago that you can only value what you can see. And so Tesla they have a solar business today, which doesn't make money. And we can forecast out where it's going to be in 2026. They have a services business, so they have all the EV charging stations that they charge. They have an insurance business, which they've really gotten approval in about 5 or 6 states so far. And they've talked about, robo-taxi. Elon's talked about he wants to have a fleet of robo-taxis. And he's talked about robots. And again, as a growth investor, I try to be very conservative. I want to value what I can see. I can see where they are with EVs. I can see where they are with solar, and I can see where they are with services. That all fits. But you start talking to me about robo-taxis, and I struggle with it because everybody's trying to come up with full self-driving. And while Tesla has probably the biggest head start, I just know from other innovations in the auto industry, whether it be automatic transmission, seat belts, anything you can look back to, it's usually a year or two later, and everybody adopts it. So it's hard for me to say that if Tesla can get a car to drive itself, that GM and Ford and Mercedes and everybody else won't be able to do the same thing. So therefore, I struggle with the whole robo-taxi concept that, Tesla's suddenly going to have its own fleet of self-driving cars and others won't. So we put zero value on that. Where I probably should put some value is insurance, because Tesla is getting mandates, and because they can see how a driver drives, they can actually figure out if the person's safe or not. And this is all new, and it's a very small market for them. But I do think at some point they will gain some traction there. With robots, I have no idea. It's pie in the sky. I haven't seen one. There's no prototype yet, but I have a lot of there are a lot of competitors to us out there to put all kinds of value on robots and ride hailing and robo-taxis, and I just can't do that. So my $1,500 number, which is the present value of where I think the stock will be in 2026, is pretty conservative compared to some other numbers out there. Yeah. Yeah. Sure. Question is, what type of timing do we consider for options if we're trying to protect? It's a balance. I mean, the problem is the more duration you put into it, the more you're going to pay. So it depends what I'm trying to hedge. If I think they're going to miss a quarter, and look, Tesla's a great example. Their second quarter is going to suck, and it's going to suck because Shanghai's been shut down. And we saw the April numbers out of China. They only sold like 1,500 cars, and so, but the analysts have brought their numbers down. And that's one of the reasons Tesla stock hasn't done well. So with something like that, you might buy a put or sell a call and buy a put just until the July numbers, second quarter numbers come out. And so I try to go as short as I can. So if I'm using options, I don't want to over hedge because I'm going to overpay. And buying puts with growth stocks is very expensive, as you guys all know, because the vol is very high. And so usually I'll sell a call and buy a put, and that's a cheaper way to go. Sometimes I'll do a put spread. So if I think this, like Tesla, will never get back below 500, I might, buy a put and then short a put at a much lower level to cut the cost. The easier way I find is just to find another stock that behaves like Tesla. And to me, like a Rivian or a Lucid. The problem in the EV space is there's no more market cap. Everything's crashed. If you look at a lot of these EV stocks, they're close to zero now. And Lucid and Rivian and the 3 Chinese companies, you got XPEV, Li, and NIO, they're the only ones that have any market cap that you can actually short against it. But I favor that approach, to find something you can short against it. That to me is just a better way to go. And again, I'm trying to, if I'm long growth, I want to be short growth. I don't want to be, people say, why don't you short GM? Because then I'm long growth, short value. And that doesn't make sense to me. You want to be long growth, you want to be short growth. Other questions? Okay. Thanks, everybody. Thanks.
Thank you.
All right, here we go. All right, let's give Gary one more round of applause. Gary Black, everyone. We got one more presentation real quick before we're going to take a quick coffee break. So let's pivot for a second, and we're going to talk about real estate. So joining me to do that is Ian Selig from Safehold. He's from their investor relations team. So let's get Ian here on stage, and everyone give a big round of applause for Ian Selig from Safehold.
You got it? Yep. That's the clicker. All good.
So there, whoa, now it's on. Again, my name is Ian Selig. I am the AVP of Investor Relations for Safehold, as well as iStar. So I have about 20 minutes or so of prepared remarks, so it's going to take up most of our time, I would imagine. If we have some Q&A, we'll try to get it in. If not, we can take it over to our table in the exhibit hall. So to begin, Safehold is the first and only publicly traded company that's focused on owning a portfolio of ground leases. We're traded on the New York Stock Exchange. Our ticker is SAFE. Now, many of you here may be familiar with ground leases, but for those of you who are not, let's do just a brief kind of 101, a primer on ground leases. It's really easy to understand. So what's a ground lease? Any piece of commercial real estate, like the one we're in right now, is literally just two components. It's the land and it's the building that sits on top of that land. And in a ground lease structure, we separate those components. And one of those owners owns the land, and that would be us at Safehold. And another party leases that land for a long duration, typically 99 years. The tenants of that building are, in effect, the owners of that building. They're responsible for all expenses. They're under a triple net lease, meaning that they pay the taxes, the maintenance, the insurance, as well as any capital expenditures. Any net operating income or profits that building produces is theirs to keep. However, at the termination of lease, at the end of that 99 years, not only does SAFE get its land back, but it gets the building and all its improvements back as well. I'd like to stop there because that's where someone's head usually explodes when I say that. Because you have to ask yourself, why would a real estate investor think about an ownership structure like that? We're all kind of somewhat hardwired to believe that you have to own the land and the building together. Well, a simple way to understand Safehold's business is every time that somebody buys a property, they're really buying those two things. They're buying the building and they're buying the land. But they are very, very different investments. The building is the high return operating part of the business where all the leasing, managing, designing, marketing needs exist, making it a very active investment. The land, conversely, is the quiet, passive, lower return part. And it's much more like a high grade bond, in fact. And the truth of the matter is there's no other place in the investment universe where those two types of investments are forced to be together. Think about it for a moment. In the corporate world, you do not have to buy the bonds of a company to buy its stock, right? That would be considered senseless, entirely inefficient. But that's what's been happening in real estate because there's never been a nationally scaled institution to acquire that land component and do it in a way that actually enhances the value of the building. And that's our value proposition at Safehold. And the math is really compelling for building owners. By acquiring that land component and by structuring, a properly structured ground lease, owners earn a much higher return on their buildings, and they do it with less risk. And as you'll soon see, it's really a win-win for all of us. So Safehold has created really three very important efficiencies for building owners. So let me just kind of peel away from the slide for a second and just let's do a real live example of how a ground lease works. Let's say Spencer is a hotel operator, a big hotel magnate. I just made him very wealthy. And he wants to buy this hotel, and he comes up to me and he says, "Hey, Ian, I'd like to buy this hotel." And I say, "Spencer, fine, it's a $100 million hotel. What would you typically make on your hotels?" And he would say 15% ROEs or 15% returns. I'm like, that makes sense. That's what most folks make on their properties. What if I was to tell you, Spencer, you could buy this exact same $100 million hotel and purchase it for $65 million and turn your 15% return into a 20% return? And he would look at me and say, "Okay, Mr. Wizard, how did we do that?" And I would say, "Okay, this is how we do it. Let me buy the land underneath the hotel for $35 million, and that's typically what the land value is in the combined property value. It's 35%. $100 million hotel. I buy the land for $35 million. I pair it with Spencer's $65 million. We give it to the seller. He doesn't care how he gets his $100 million. Boom, and we just created a ground lease. All right, let's take a full stop and just understand what happened in that moment there. A few really important things. First of all, number one, Spencer just put $35 million in his pocket. Number two, because Spencer is spending $65 million and the net operating income or the profits of that building didn't change one penny in that little transaction that we had, his returns go from a 15 to a 20. Does that make sense? And lastly, and probably most importantly, he does not have to take out a $100 million mortgage. He now only has to take out a $65 million mortgage. And by the way, that's how most folks in the real estate world go out of business, is that when that bullet comes due, let me tell you, $65 million less whatever equity you put in is a lot easier to handle than $100 million. So we've created these, capital efficiencies by saving upfront capital needs, cost efficiencies, because every time a building sells, and the typical holding time on any piece of institutional quality commercial real estate is about 10 years. It would be 7 years if it was a private equity firm or fund that was managing that building. And then, like I said, most importantly, we've created this structure where we have really lessened the maturity risk. So those are the real three very important things that we've done for our building owners, and obviously offering them higher returns. So look, this whole idea of separating the land from a building via a ground lease has been around for centuries. We didn't invent these things. And during the course of that time, it's really been one of the greatest wealth creators for a very select group of folks. In New York, where I live, if I didn't give that away already, the Chrysler building today sits on a ground lease. Cooper Union owns the land underneath the Chrysler building. Trinity Church owns much of downtown Manhattan, and most of Wall Street is actually built on ground leases. Some of the richest families in New York today have attained their wealth because some patriarch 100 years ago realized that land was going to be worth a lot of money and was able to pass that wealth on from generation to generation. London, another great example. The Duke of Westminster bought West London 150 years ago, and at that time it was primarily swampland and apple orchards. Today, the royal family collects over £1 billion of ground rent every year. And probably one of the best examples of ground leases is that picture on the lower left-hand part of the slide, and that's Hong Kong. The British leased that land from the Chinese, built this megapolis on top of this tiny little island, and literally handed the keys back to the Chinese in 1997. These things have been around for a long time, but quite candidly, these ground leases of the past have had less than a stellar reputation because they were written to be very one-sided toward the landowner, and they would make these leases would make the buildings value destroying, not value enhancing. And they contained all of these odd provisions like fair market value resets, which means the rent would reset at some point in time for what they call in the real estate world the highest and best use. It just happened in the Chrysler building, in fact, last year. They had a fair market value reset, which says, okay, at X point in time, we're going to raise the rent by X percent on the highest and best use. And what's the highest and best use in New York City right now? It's co-ops and condos. So the rent in the Chrysler building last year went up 4 times, and in 3 years, it's going to go up 4 times again. So just think about that. If you were a tenant in that building, what would you be doing if they're raising your rent 4 times and 4 times again? Yes, you would be leaving. That's correct. So we realized that we needed to change these things, and we stripped away all of these uncertainties and ambiguities, because that's literally, I mean, we all know this. What are the 2 things that the markets despise is uncertainty and ambiguity. And at Safehold, we recognize that the problem is no one has taken this fundamental idea and modernized it to work in today's capital markets. But there's really more that makes any business really revolutionary. So some of the biggest and best companies today are being built by rethinking how things have historically been done and delivering fundamentally better solutions. Think about for a moment what Amazon has done for retail. Think about what Uber and Lyft has done for the taxi service. Think about what Venmo and PayPal has done for payment processing. Utilizing this kind of proven formula, Safehold is taking a $7 trillion real estate industry and making it more efficient and delivering a better customer experience. So let's take a peek on how Safehold has penetrated the market since our inception, literally 5 years ago this month. So again, as I just mentioned, we took Safehold public in 2017, June of 2017, in fact. And we ended that year with $300 million of ground leases. At the end of last quarter, our portfolio has grown to $5.5 billion of these ground leases. We are the only ones who are doing this. We have no competition. There is no other publicly traded company that is focused solely on ground leases. So we're kind of running the field alone. And again, it was interesting and quite fortuitous that, I came off of my last panelist who's, talking about growth stocks. This is the epitome of growth and value. And we can talk more about that in depth after the presentation. So I think it would be somewhat beneficial for you guys to take a peek and see the type of assets that we invest in, all with the highest quality, most world-class customers and sponsors. These are just a sample of the types of buildings that we've been investing in. We have over 120 ground leases in our portfolio today. And we're only focused on the top 30 MSAs or markets in America. We're fairly property type agnostic. The bulk of our portfolio consists of multifamily office, select, really high-end hospitality, but we have student housing, life science, pretty much every property type, industrial. The only thing that we're not looking at is retail. No disrespect to those folks, but I think Simon Property Group, and there's some other guys out there who do a really good job. So now that we all have a pretty good understanding of our business model, let's get to the fun part and kind of why you're all here today and understand why SAFE is such a compelling investment. So as I mentioned, 5 years ago, we took Safehold public, and something really remarkable happened. By taking a ground lease and putting it in a public vehicle, we democratized this investment. So what do I mean by that? Well, as I mentioned earlier, who are the folks who own ground leases? Royal families, churches, universities. Because quite frankly, who has $35 million to park for 100 years? Someone here may, I know I don't, but I do have $50 to buy a stock. So now, for the very first time ever, all of us can participate in an investment opportunity that was never available to us before. We can express our opinions on ground leases every day. If we like ground leases, we could buy SAFE stock. If we don't like ground leases, we could sell SAFE stock. Think about that for a moment. We turned a 100-year passive investment and gave it daily liquidity. Now that's powerful arbitrage. So Safehold was taken public by iStar. iStar has been in the real estate finance business for over 3 decades. I work for iStar. We have done more than $40 billion of real estate transactions over the course of that time. iStar has offices throughout the United States, and I think we all know that real estate is a local business. It's a relationship business. And having iStar as not only as our founder, but our manager and largest shareholder is extremely important to Safehold's ongoing successes. And I just want to emphasize, and I know there's a lot to talk about between the relationship between the two companies, but let's take a peek at what I consider to be the 3 most important investment attributes, not only that it's contained within Safe's investment, but that we all should look at if we ever to invest in any company. I think this kind of rings true for everything. So the first is this whole notion of principal safety, and that's just another way of saying, how can I keep my capital well protected? An investment in Safehold is literally one of the safest ways you can invest in real estate, because a ground lease occupies the senior most 35 to 40% of the capital structure. So let's talk about for a second what that really means. We are senior to everybody else in the capital structure. So again, somebody takes out a leasehold or a leasehold loan, they take out a mortgage on their property, things go bad and they can't pay. They can't pay their mortgage. What happens when you can't pay your mortgage? Correct. The bank will come in and foreclose. Well, the bank comes in to foreclose on the building, but now the bank is responsible for paying the ground rent. So we're even senior to the bank. And plus having a portfolio of high quality, diverse ground leases in the best locations in the United States adds an additional layer of safety. The second attribute that I want to talk about is this whole idea of cash flows. Our ground leases are structured to have 2% annual rent increases every year that compound over the life of the lease. So, for example, you're paying $100 in year 1. Next year, you're paying $102 in rent. Well, in year 3, you're paying 2% of $102, right? Compounding, we all know about it. It's a page out of Warren Buffett's playbook. I think Albert Einstein called compounding the 8th wonder of the world. When you compare the compounding rental streams from our ground leases to that of very similar high-grade long-term bonds, we generate excess returns. I'm going to talk about these cash flows in a moment, but I think they're really important. But the last attribute I really want to focus on for a moment, and that's this whole notion of capital appreciation, which is just a kind of fancy way of saying, is like, hey, how can I get wealthy from this investment and then be able to pass that wealth off to my kids and for generations to come? Well, to understand this a bit better, let me remind you what I mentioned at the beginning of the presentation, that at the end of the ground lease, at the termination of the lease, not only do we get the land, but we get the building and all of its improvements back as well. Now, I've done this before. I know a lot of you are thinking, what does that really mean to me? I'm not going to be around in 99 years, and that's cool that you get the building, but whatever. But in a moment, we're going to focus on this store of value, and you're going to understand why it's probably the most important part of this investment. So let's get back and talk about these cash flows. So take a peek at this graph for a second. The gray line on the bottom is MIT's 100-year bonds. So there are our 100-year bonds out there. They're traded in the market every day with significant volume. And as you can see, that MIT bond goes in at about 3.5% yield to maturity. But guess what? At the end of 99 years, it's 3.5% yield to maturity. That's how that bond trades. Well, we go in about pretty much the same spot, and that's that dark blue line. But with those 2% compounding rent bumps that I just talked about, that shaded area is the excess returns that we get. So when you compare our cash flows against very similar investment instruments with similar maturity risk and similar duration, our ground leases are as safe. They're in that same AAA tranche, but we generate almost 150 basis points of excess returns. Now, I have to say, in this AAA CMBS world, If you can generate 10, 15, or 20 basis points more than your peers, you would be the best performing manager on Wall Street. And our ground leases generate 150 basis points wide, and that's really remarkable. I do not think there's actually any other compounding cash flow stream in the market today that even matches this. So this is something that's super important. So that's really the first component of value within this investment. And let me now talk about that second component, which is the reversion of the buildings. And let's wrap our head around this for a second, because I know this can get a little bit ethereal. But when we IPO'd back in June of 2017, we had $400 million worth of buildings that were sitting on top of the land that we owned. Okay, 400 million. And that's not us saying that. We have CBRE come and appraise all of our properties every quarter. We're a publicly traded company, very transparent. So this is not our value. So we had $400 million worth of buildings. And as of the end of last quarter, that value has grown to $9.4 billion, right? And we're going to talk about, and it's with a 90% compound annual growth rate. So this is remarkable. Let's take a step back for a second and just look at these numbers. And, you know, a lot of us have 401ks and liquid accounts that we can't touch yet. Hopefully have some smart folks managing that money for us. And imagine 5 years ago, you got your 401k statement in the mail and it said, hey, you had $400,000 in your 401k. And all of a sudden today you get your that same statement in the mail and it said you had $9.4 million. That's a pretty good day. It'd be a good day for me. I can tell you that right now. So it's still great, but I still haven't really answered the question. It's like, well, that's all fine, but it's kind of so far out there. What does that mean to me? Well, we are presently working on ways, and we have actually executed on ways to monetize this value today, so you do not have to wait until these leases terminate. And I'm not going to go too deep into this. And again, this is something that we could talk about. But we've created these units called carats that represent this value. So like this unrealized capital appreciation of that $9.4 billion is a value. So we created a coin, a token, call it what you want, a unit, and we called it a carat, not like Bugs Bunny. It is, it's a homonym. So it could be, you have carrot like the vegetable, you have carrot like a carat gold, you have carrot like an exponent symbol, carats on a diamond. They're all spelled differently. So is this. And this is actually an acronym for Capital Appreciation Real Estate Trust. We created 10 million units of these things, and we've sold some to a group of really smart investors, some of the biggest names in prop tech, fintech, some of the largest sovereign wealth funds in the world. Kevin Durant actually was one of these curated investors, and they put a $2 billion valuation on their purchase. Now, you said to me, I would say, hey, Ian, that's all well and fine, but you just said it was worth $9.4 billion. Well, when we did this deal, it was actually worth $6 billion. But still, why would we have given a haircut to ourselves? We're saying it's worth $6 billion, and we sold it for $2 billion. And the answer is we only sold 1%, and it was most important for us to at least show the world that we can actually sell these things and do it in a way that we can do it now and not have to wait until the leases terminate. Again, this is stuff that we should talk about individually, but it's really important to know that this is the second component of value that's built within this investment. And it is probably the most important piece, because that UCA value just grows and grows and grows every time we do a ground lease deal. And it doesn't cost us $1. We just buy the land. But by definition, and how a ground lease works, we get the building back. Just think about it for a second. When you go lease a car, right? You go to Lexus and you get your shiny new car and you pay your monthly payments, right? 36 months is over. What happens? You have three choices. I know what I would do, but whatever. Most of us give the car back. So that's just, wink, wink, that's a lease. You can buy the car, right? I've done that before too. Or you could do what the folks in the car dealership really want you to do is release it. That's the best day of the car dealership's life when you do that. So this is a lease. It's not unusual. I know it's like, why would anyone give their building back? Well, you're making more money and you're doing it with less risk. And that's the whole idea. So let's take a peek at something that we can all wrap our heads around, is SAFE's overall stock performance. We've delivered over 100% to our total return to our shareholders since our IPO. And it's up until March of last year, that chart was going in the direction I wanted it to see, but obviously we've hit a bunch of headwinds with the markets in general and the specter of interest rates. And the one thing I didn't mention is that our ground leases are inflation protected, meaning I told you about these 2% rent bumps that we put in, and the reason why, and at least until about 6 months ago, the Fed said, hey, interest rates are pegged at 2% a year. But we have these CPI, what's called CPI look back. So every 10 years, if inflation has exceeded those 2% rent bumps, we get to reset the rent going forward. So again, not only is this a AAA bond, but it's a AAA bond with inflation protected with compounded growth. Now, I'll challenge anybody here. Can you tell me another security that's inflation protected and AAA? There is one, actually. Well, it's called TIPS, but TIPS does not even come close to the types of returns that we're giving. So let's kind of wrap it up here for a moment and talk about the opportunity, because again, we're running the field alone here, and we grew our portfolio from $300 million to $5.5 billion in fairly short order. It's our estimation in those top 30 markets that we are focused on, there's approximately $7 trillion of opportunity to do ground leases under institutional quality real estate. Well, if you were to take 35% of $7 trillion, which is the approximate value of the land underneath those buildings, that's a $2.5 trillion opportunity. And let me tell you something, folks, that's a pretty big sandbox to be playing in, right? And we're the only ones playing in that sandbox. It's great to be the first mover in any business. I like to call it the Hershey bar effect. It'll be very difficult, even if someone was to join and be a competitor, to even scale up to where we are today. We are really revolutionizing real estate ownership by making it better, more efficient, and offering our customers an opportunity to make higher returns and with less risk. And for the first time ever, we are making ground lease investments available to all of us, the individual investor, an investment that offers superior principal safety, growing income that's achieved through contractual cash flow streams, and the significant opportunity for capital appreciation. That's it, folks. That was it. It's okay. You don't have to clap. It's fine. It's all right. It will be the best presentation you saw while you're here, just so I can make that super clear. But I mean, we may have time for a question or two before they kick me out of here. I don't know if we do. Spencer. Okay. Spencer, the hotel operator. Yes, sir. Mm-hmm.
Instead of $100 million, they're investing $65 million.
Yep.
But they're obviously paying rent.
Yes.
Instead of paying the mortgage on the difference. So did the numbers work out? Are they really paying less?
Yeah. So let me repeat the question, because it's a very poignant one. Is that okay? Sure, you're paying $65 million to the building rather than you're paying $100 million, but you have this kind of rent anchor now, and let's compare that to a mortgage, right? So the answer is literally the ground rent is 1/500th of the value of it. It's comparable to an electric bill. It's an operating expense. It's so small. The rent payments are so small. So I'm telling you, it's like paying so if you can't pay your rent payments, you have much bigger problems. You have not been able to pay your mortgage for years if you can't pay your rent payments. It's like paying a light bill. So I just want to make that, it's a good question, but no, it's better for us if our customer, what's best for us is to be fair with our customers, because what you're saying is like, let's charge as much rent as we can. Well, that was the way ground leases were done in the past. Is like, well, I would say, hey, you want to build on my land, you're going to play by my rules. Boy, I really sounded like a New Yorker right there. But that's the way it went. It was a one-way street. And I'm like, no, when people come to see us at Safe, we wrap our arms around them And we say, hey, how can we help you? It's the exact opposite, right? This is how you build a business. It's not, you don't have one trade to make. So that's the idea. And by the way, out of the 120 ground leases in our portfolio today, over half of them are with repeat customers. So what does that tell you? It's working for them. Obviously, it's very validating to us because our thesis is playing out. And great businesses are built on repeat business, right? Someone else? One more. Sir. I'm sorry, one more time? Sure. So again, it's who's senior if the lessee doesn't pay their taxes because they're responsible. Remember, I said if they're responsible for all taxes, who gets the building? We do because they're guaranteed to pay the taxes. So what's going to happen is if they don't pay the taxes, well, they're going to put the building at risk, right? Well, the bank will come in because they have a mortgage, right? The bank will come in and pay the taxes. And then the bank will come in, and if they can't pay their taxes, with all due respect, they haven't, again, been able to pay their mortgage or other much more expensive things. The bank will then come in, foreclose on the building, start paying the ground rent, and the bank will then find a suitable replacement because the bank's not going to give up that $65 million piece of collateral because someone can't pay their taxes or their electric bill, right? Right. Okay. So fine. So if somebody owns the building outright is what you're saying. I mean, typically that doesn't happen, but let's say there's some wealthy family that owns the building outright and they're not obligated to a lender for the mortgage. Well, if they do not pay their land taxes, I mean, they're then in default of the lease because in the lease you're required to pay your taxes. And if you don't, we just take the building and we'll pay the taxes. So we again, it's the same idea as if we lease a Class A building to Spencer, and people say kind of the same thing you're saying. Hey, I only have 40 years left on the lease left. I'm not going to improve my building. Well, there's two things there. Number one is Spencer's not going to improve his hotel because he has to because it's part of the lease. No. He's going to do it for self-serving reasons because there's Mr. and Mrs. Hotel across the street that's going to take away all his business because he doesn't keep his hotel up with the latest and greatest amenities. So it's for self-serving reasons that folks keep up their building. And by the way, it's kind of the reasons why this is such a scalable business is I don't need to have an asset manager at every one of these properties. I just have to come by once a year and make sure that you're keeping the carpets clean and you're changing the HVAC system and everything is up to date and it's in the same condition. I leased it to you. So, but I think the broader idea is, look, folks, over time, what goes up in value more, the land or the building? Anybody? Why am I standing here? Right, the land is correct. So that's the idea. And when you become an investor in Safe, you can become an investor with us and you become a owner of not only one ground lease, but a portfolio of growing ground leases. And let me tell you something. Like I said, this is one of the greatest wealth creators ever invented. And now we all can be part of it, not just part of one, you're part of a portfolio of them. And if your kids and grandkids are lucky enough to have the stock, they will wake up not rich, but uber wealthy because they are going to be part of thousands of ground leases. So thanks again. Lots of fun. We could take it back to the exhibit hall. Happy to answer all your questions. And I want to thank all the folks at Benzinga for having me. Enjoy, folks.
Great job. All right. We're going to take our first break of the day. So I will meet you all back here in 15 minutes. But in the meantime, enjoy some coffee, enjoy some snacks, and thank you, SIBO, for said coffee and snacks. Stretch the legs. Yes. Good. Okay. Next speaker is a dear friend of mine, of Benzinga's, and knows more about options. He's forgotten more about options than I'd ever learned. So Chris Capre from the head of Benzinga Options, come on down, man. Let's give Chris a round of applause. You have your clicker. Thank you. Yeah, appreciate it.
Okay. My mic on? Yes. Can you all hear me fine? Okay, so my name is Chris Capre. I'm the head of the Benzinga Option School. How many of you have never heard me speak before? Put your hand up, please. Almost everybody. Awesome. Okay. I'm not as popular as I thought I was. So just a little bit about me. I am a former broker on Wall Street. I was an FX broker. So that's actually how I started in the markets. I did start with stocks and mutual funds, but this was 21 years ago. So this is before the dot-com bubble had fully burst. To some of you, that may seem like the Middle Ages. And so I've been around in this a long time. I've been on the sell side. I've been on the buy side after being an FX broker, where my specialty was in Asian currencies. I worked all three desks, Europe, New York, and Asia desk. But I ended up specializing in the Asia desk, which means that in 04 to 06, when I was doing this, the carry trade was a big thing. After that, I ended up getting a job as a hedge fund that had been hunting me while I was at the brokerage. And so I traded for them. And then I was on the buy side. And then after that, I decided to go private. And so I have been presenting with Benzinga for about a couple of years now. And then they came to me and said, hey, you seem to understand options really, really well. Let's build a school around this. And that's what we're going to be talking about today. So I've traded everything across the board. FX, commodities, bonds, indices, stocks, options, all of it. And I've looked over my trading career, and I have seen a major market crash of some sort every 2 years, or a major event every 2 years. And so there's a lot of experience that I'm bringing with you here today. There's a lot of great traders that are speaking here today, and I'm just sharing with you my particular experience and viewpoint on the market. So how many people here trade options? Okay, good. And anybody here just stocks or just commodities or, okay, good. All right, so, and anybody here, if you had to say options 0 to 3 years experience, put your hands up. Okay, 3 to 5 years? And anybody past 10 years? Okay, a few, gotcha. Okay, so the options market is kind of undergoing a massive change right now. And what I want to show you here is this right here. So this is from the OCC Options Clearing Corp. This is the total volume of transactions. Biggest April on record. If we look at all 4 months this year, April the biggest on record, March the second biggest on record, February the second biggest on record, and January the biggest on record. Options volume is exploding. And we can see nobody has to be a Da Vinci Code scientist to figure out where the actual transition is. That was in COVID. So when COVID happened, a lot of people lost jobs. In the year of COVID, about 20, 30 million people joined the market. That's a lot of new traders. And that's where options exploded. What this also means is that if you think about the stock market's kind of like an accounting book of where everybody wants to buy and sell. Doesn't matter whether you are a technical trader, a fundamental trader, a sentiment trader, a flow-based trader, all for whatever reason you make for a buying and selling decision, that's all coded in this ledger in the order book in the stock market. And with the options volume now surpassing share volume, like now options volume is surpassing share volume, which means that it is a bigger portion of the pie that's moving the market. Then you have to understand how options are moving the market, particularly how option dealers and market makers are pushing the market. So a lot of people think that market makers are like hunting your stops and things like that. And I can tell you, as someone who's been on the buy and sell side, that they're not doing the options market. So in the options market, They create a market. They try and fill buy and sell orders. And they have a way to make money, whether the market goes up or down, by collecting that spread. Think about it like this. If you didn't have to worry about the market going up or down and you can make money every single day, millions of times a day, who would take that job? Yeah. You only need about 500 million to start or a lot of capital behind you, but you can do it. So I want to talk about how do the option dealers and market makers influence the market every single day, every single second, every single option trade that goes through. Okay, so the first thing it says right there is 50% or more of all the option flows you see in the market today are done by market makers. Why is it more than 50%? Think about it like this. If you come in and say, hey, I want to buy SPYs, I want to buy 100 calls at the 400 strike, the option dealer market maker is on the other side of that transaction. Okay? You buy 100 calls, they're short 100 calls. Market maker does not want to make money based upon direction in the market. They want to collect that transaction fee because they can do it a million times a day. And so they're going to immediately delta hedge that position. Immediately, algorithmically, done instantly. So if you buy 100 calls, they're short 100 calls. They're going to take the other side of the market and then they're going to delta hedge that. Now, if 100 calls come in and they take the other side of that, that's 50-50. How could it be that option dealers and market makers have more than 50% of the total option flow? Any guesses? Gamma, could you be a little more specific? Okay. It's a great attempt. Anyone else? 99% of what option dealers and market makers are doing is that delta hedging. And they're doing it through changes in direction, time of the options, implied volatility. But they do, at certain points in time, buy what is called tail risk protection. And in the Benzinga Option School, we saw this weeks ago. So all of a sudden, we saw this big blip on the open interest strike on the SPYs when SPYs was at 420. And all of a sudden, we start to see this big blip up in 400 strikes. And we're like, what's going on here? And it was some real money macro players and option dealers looking at the market and saying, we need to buy tail risk protection. So that's why it's 51%. So it's not like every transaction is completely offset. They actually do take some positions in the market, but it's tail risk protection. That's why it's 50%. So these dealers and market makers are delta hedging constantly, all day, every day. Largest concentrations are, if you had to guess, when would be the largest concentrations of hedging flows for the dealers and market makers? Morning, yes. Anything else? Monthly expiration, very good. Very important. We're going to talk about that because that is a huge influence on the market. Anything else? Yes, that would be another one. Anything else? End of the day. Dealers want to have their books set up the end of the day. They want to make sure that they are delta flat as much as possible. So they will have to adjust towards the end of the day. Super important. So the four ways that they are hedging and the four things that they're hedging every single day: delta, gamma, implied volatility, and time. That means if any one of those four changes, they have to adjust their hedges. And I'm going to show you exactly how they adjust those hedges in buying and selling shares. This hedging is completely reflexive. We all know what a reflex is. If I blow in your eyes are going to blink. That's an automatic reflex. It's the same with their hedging activity. 100 calls come through on SPYs, long calls. They are immediately short those 100 calls. And the hedging that is associated with that is done reflexively, algorithmically, automatically. These flows, with the options volume, as we saw in this chart, growing and now surpassing share volumes, particularly in SPYs and SPX, and in many other tickers, these flows dominate and are now a bigger piece of the pie than they have ever been in history. Option flows right now are the biggest they've ever been in history in terms of the percentage share of the market. Therefore, in terms of what's moving the market, if you're wondering, why did this stock sell off all of a sudden at this? Why did it bounce? Why has it didn't even hit a support or resistance level and it just stopped. What happened? It's these option flows that are coming in because at certain points in price, the dealers are forced to hedge either by buying more shares or selling more shares. Super important we understand that. This order book, if you think about it like this, when you look at your options that you have in your account, you think of, hey, I'm long this, I'm short this, I have positive deltas here, I have negative Vegas here, whatever it is. Well, you think about your option trades. What if you all stepped back for a second and said, what if I owned every single option on SPY? You would have an aggregate of the entire book, correct? And you would know whether you are net long options or net short options. You would all know this, right? If the market maker is net long options, we call this positive gamma because they have positive gamma exposure. When you're long options, you're long call, you're long volatility, you're a long gamma. We all know this, or hopefully you know this. So if the net of all the options that the market maker has is net long, they have what is called positive gamma conditions. And that is going to have a huge impact in terms of how the flows move, which I'm going to show you typical SPX returns over like years and what was the difference between the moves when it was positive gamma or negative gamma. That has a huge impact. So it's super important we understand this. So this is a cheat sheet. If you're in my Benzinga option school, you've seen this before. Most likely, if you're not in my school, you probably haven't seen this before. So go ahead and take a picture. This is a total cheat sheet for how option dealers and market makers hedge. And let's kind of go through this here. So I feel like I'm going to strain my neck if I do this here. So I am just going to look at that thing. So let's just look at a basic example. Top line, trader buys 100 calls at a 50 delta. The dealers immediately short those 100 calls. They have a negative delta position. So what's the immediate hedge with that? Think about it like this. Just put yourself in this position. You are short 100 calls on SPY. Where's your risk? If SPYs goes up or down? Who says up? You're short a call. So who says the risk is that the market goes up? Who says down? Nobody. Okay. So if you own these positions and your risk is up, how do you delta hedge this? You buy shares. And you buy shares in proportion to the delta of the position that you just offset. So 1 call, 100 shares, 10 calls, 1,000 shares, 100 calls, 10,000 shares. If it's a 50 delta position, you can think about that as almost being the equivalent of being long 5,000 shares. If you own 1 contract at 50 delta and the stock goes up $1, you just made roughly 50 cents. That's like being long 50 shares and not 100, right? So this is what the dealer has to do immediately. They're buying 5,000 shares immediately. What's the effects for liquidity when this happens? If dealers are buying shares, they're adding liquidity to the market, right? And generally, markets don't crash when liquidity is strong. Markets generally crash when liquidity is weak. We'll talk about, hopefully we have enough timetable, we'll talk about various option positions and flows that can tell you, hey, the market is much more vulnerable right now because of the positioning. Now, the dealer position from the short 100 calls is negative gamma. They have a negative gamma position. Okay, it's important to understand that. We'll get into gamma in a little bit. I'll explain to you exactly how it works. Let's take the other one, short 100 calls. You think SPYs is going to top out at 420. You come in and you sell 100 calls at the 420 strike. Yeah, it's there right now. It's about a 50 delta. You sell it. You're short 100 calls. Dealers immediately long 100 calls. They have a positive delta trade. Now, if the market goes up, their long calls are making money, right? So where's the risk? The risk for them is if the market goes down. So how do they hedge that? They have to sell shares to hedge that. This is delta hedging 101. If you notice at the top of my screen, it says option dealer market maker delta hedging at T0. That's time 0. This is not the only hedging they do. As the price fluctuates throughout the day, they have to re-hedge that position because they basically want a flat P&L curve. They want a delta that is flat, because if they do that, then they can constantly collect those transactions without caring if the market goes up or down. Any questions on this before we move forward? Yes, sir. Anytime you add shares to the market, you're adding liquidity to market. Yes, yes. You take shares away from something, like let's just think about cars available, like used cars right now, very expensive. Why? Because they're not available. You pull things away, you take away liquidity. You add something to it, you add liquidity. The more liquidity is, the tighter the spreads get. The worse liquidity is, the worse the spreads get, the more exacerbated the flows get and the prices get. Oh no, they're buying 5,000 shares. They're bringing liquidity into the market. Yeah. Yes. Yeah. Now, to give you an idea of how this gamma can influence a sell-off, and I'm going to show you whether they are mean reverting the market or whether they're exacerbating the market. So there are times where the market goes up and the dealers are selling. They're trading against the market because they have to, because of this reflexive hedging. There are other times when the market goes up that they have to buy. So they're either trading with the market in terms of their hedging activity or they're trading against the market. Now, if you think about that, if the market's going up and the dealer comes in and starts selling shares, what's the more likely scenario for the price action? Trending or mean reversion? Mean reversion. If the market's going up and they have to sell, that's going to force the market into mean reversion. And I'm going to show you exactly what happens in these conditions when it's positive or negative gamma. And you'll see it in the charts. It will look night and day. The last one I want to just kind of point out here, we could go through all this, but I would like to go through one thing here which kind of gives you an idea of why sell-offs can get bad, because that's when the dealers are actually trading with the market. Third column, or third row, you buy 100 puts. If you're long puts, it's a negative delta trade, right? Dealers immediately short 100 puts. Now, you know from your own trading, if you sell a put, if the market goes up, you're fine. For the dealer, though, if the market goes down, they start losing money in that position, right? So how do they hedge that? They have to sell shares. This is them trading with the market. And that can exacerbate sell-offs. This is important to understand. Because if you can understand how the dealers and market makers are responding to the overall position, you can start to speculate ahead of time, hey, you know what? Based upon this, this is going to mean revert. Dealers are going to trade against this. Or based upon this, oh, dealers are going to trade with this. This is going to exacerbate the move to that side, upside or downside. Super important. Okay, so this is typical delta hedging 101. So you can see there, this is a long call. You guys have all seen, for your option traders, you've all seen this long call payoff, right? This is the payoff at expiry, right? So if the long call is a 50 delta, the dealer is going to sell shares perpendicular to that P&L curve. If the P&L curve is moving 45 degrees up, they have to sell shares perpendicular to this so it flattens it out. That's how they get the flat P&L. Does this make sense? Yes, sort of, no? Okay. Their job is to make that left line there. Like do a pointer. Their job is to take their P&L curve. They don't want this on their books. They want a flat line. Because if it's a flat line, they make money whether the market moves up or down. And they just keep collecting those transaction fees. You know, the numbers for April were what? Average was 45 million transactions a day. Is that a lot of money? It's not bad. It's not a bad business. So they want this P&L curve flat. They have to sell shares in this case to push the delta flat. So this is an example of how, if the dealer is long a call, how they're going to hedge that. My thing is not working anymore. Oh, there we go. Okay. So short call. Remember how on that last screen, if the dealer is short the call, where's their risk? The risk is to the market moving the upside. They lose money if the market moves to the upside. So how do they delta hedge that? They buy shares perpendicular to the deltas that pushes that P&L curve flat. Yes, no? I know the first time I saw this, my head was kind of exploding. So if it's happening to you, don't worry about it. It took me a while to kind of get this. 2 more, and then I'm going to show you what a typical order book looks like from an option dealer and market maker. So the dealer is long puts. If you are long a put and the market goes down, you make money, you're not worried about that. Your risk is if the market goes up. Then you start losing money. So what do? They buy shares to hedge that. And then the last one, short puts. Your risk, if you own these short puts, is if the market goes down. So how do you do that? You sell shares. Any questions on the basics of delta hedging before we move on? Yes, sir. Correct. If you think about it like in your own position. When you own a call, your long volatility, your long gamma. It's the same for the dealer. No different for them. Yeah. So whenever you are in doubt as to how this might affect the position for a dealer, just think of if you were the dealer, what would you have to do to neutralize that? Yes. Yes. Any other questions before we move on? Okay. So these are those 4 charts. The 4 P&L charts, long calls, long puts, short puts. This shouldn't be too much of a surprise to anybody. Now, this might explode your head. This is a typical dealer order book. So let me break it down piece by piece here. So the blue, I did put a little legend here, so to say, or key. The blue is the typical dealer position. This is a pretty straightforward question. Is the market generally long or short stocks? Long, right? Pension funds, are they generally long or short stocks? Okay. When you get a job, are you long or short that job? And your favorite team, if you think they're going to win, you're long, right? The market is life is naturally biased towards long, right? And the same is with the market. So you look at all these pension funds, these like supranational funds, like the Norwegian fund and everything like that. All these funds, the majority of their book is long, which means that the dealer has to take the other side of that, right? So if the green is the typical client position, let's explain this. If you are long stocks and you want to neutralize some of your risk, you're going to buy puts, right? Now, buying puts is expensive. In fact, they've shown that if you're long stocks and you buy puts, you're going to bleed a lot of your alpha out of that. Yes, you might make a little bit when the market goes down, but you're going to bleed a lot of your performance. So how do you monetize those long puts? How do you make it cheaper for you to own that downside insurance? Any guesses? Yeah, sell calls. Now, you're probably not selling the calls for the same amount that you're selling the puts because there's a natural skew in the market. If traders are naturally more long puts and they're selling calls, this creates what is called an index skew. That means the puts are more expensive relative to the calls. So you could sell a 25 delta call and you could buy a 25 delta put and they're still not going to be the same in value. So you have a little bit of negative right there, but that's the cost of the insurance, right? So the client is long the put. And this is a P&L for a long put. The client is also short the calls. This is a P&L for a long or short call. Now, the dealer is on the other side of this. So this is that blue line. The dealer is then, if the client is short the call, the dealer is long the call. And this is right here is the P&L for a long call option. At the same time, the dealer is short the put, right? So if this is them, this is your short put P&L if you own this. So this is typical dealer position, and this is typical client position, right? Now look at this from both perspectives. The yellow is what the goal is, the dealer hedge. If you are short the put, your risk is if the market falls. You start losing money if the market falls. So what do you do as the dealer? You sell shares to hedge that. At the same time, the dealer is long calls. So if the market goes up, they don't have to worry about their long calls, right? They have to worry about if the market goes down. So then what does the dealer do to that? Sell shares. So this is a typical dealer order book. This has not been the typical dealer order book for this year. But if I was to show you some charts, and we will look at some charts over the last 12 years, this was the most common book that the dealer had. And they deviated from this book, or had to deviate from this book, less than 10% of the entire year, each year. So any questions on the typical dealer book and how this may impact flows on a daily basis? No questions whatsoever? Either I'm doing a really good job or some heads are exploding. Okay. Let's move on. Remember when I was talking about gamma? So let's look at this. What you're seeing here, Squeeze Metrics, shout out to them. They do a great job of this. So what are we looking at here? We are looking at 4 quadrants here. And on the x-axis here, this is the gamma exposure that the dealers had in the market, right? On this right, everything on the right half here is positive gamma. That means the dealer was net long calls. Their net position, if they owned all the options, was net long calls. And on the left side here is what we call negative gamma. That means the dealers were net short calls. Okay? Now, on this y-axis here, this is the close-to-close one-day return on the S&P 500 in the SPX. So from market close to market close. Anything on this right upper quadrant, or anything on this right half, is positive gamma, and everything on this left half is when the market was in a negative gamma condition. Now, you should see some patterns here. So if we look at this chart, let's look at the right chart. Every one of those dots is the percent return that the S&P 500 did for that day. If it's above the zero line, it was a positive return. If it's below the zero line, the SPX lost money. So if we just look at the right side of the chart, what do you all notice? Just shout out whatever patterns you see. What's that? Reversion? Okay. Yes. Yes. Less volatility, less variation. Yes. So now we're starting to tie it together. When the dealers have net positive gamma, the market's more likely to mean revert. That means if the market rips, you probably most likely do not want to be buying that expecting a massive breakout because you're trading against the dealers. Super, super important. It also means that if the market is dipping, the dealers are actually buying those dips. So do you want to be selling that thinking that the market's going to sell off 2, 3, 4%? Not a statistical probability, very low. There's like, what, thousands of dots here and maybe 10? So if you know that the market's in a positive gamma condition, if the dealers are in a positive gamma condition, you want to be doing mean reversion. You want to be buying those levels when it pulls into support. And you want to be selling those resistance levels when it hits that. Super important. This gives you a game plan every single day. And I share this actual data with the Benzinga Option School students every single day. Hey, we're in negative gamma. Hey, we're in positive gamma. Here's where the levels and the open interest is collating. So they know if it's positive gamma, I want to be buying those dips and selling those rips. And if it's negative gamma, that's where the dealers are trading with the market. I want to be selling if the market's going down, and I want to be buying if it's going up. This is your daily weather report in the options market. Now the left side, yes, sir. Yes, when it's a positive gamma environment, the most common scenario is mean reversion because the dealers are trading against the flows due to their natural hedging. So as the market rips into resistance level, if the dealers are in a positive gamma condition, you want to be selling that. And if it dips into those support levels, you want to be buying that. In other words, because of their hedging exposure, the dealers are essentially putting a buy limit below the market and they're putting a sell limit above the market. If you look statistically, how many dots above 4%? 1. And this is over a 9-year period. How many sell-offs were below 3.5%? None. None below 4%. So if you're sitting there thinking, I can get 4%, this thing can sell 4%, myself and my option fellow traders are sitting there going, not in positive gamma. Not going to happen. Yes, sir. No, not even close. In fact, I've been studying market gamma now for, I've looked at market gamma charts all the way back to 08, and I've only seen 2 periods in the last 15 years where we've been in negative gamma for this long. We've pretty much been in negative gamma 94% of every single day this year. The only other time, the last time I saw it this much for a 4-month period of time, any guesses? Close. 08. Great financial crisis, yes. That was the last time we've had this much negative gamma. So let's look at the left side now on this here. Anything on the left side, notional gamma is negative. This is a positive return. This is a negative return. What do you see in the difference in patterns? Nothing. Should be more volatility, right? We have higher pushes up and down, right? Why? Because in negative gamma, dealers trade with the market. That means that the market is selling off. Their natural hedging activity is selling. It's pushing it further lower. And remember, if a dealer is selling, they're taking away liquidity, which further reduces the ability of the market to support itself. Super important. We also see that there's also expressed volatility to the upside. You're not going to get a 5% rip. You might get 1 in a blue moon, but look how many more are above this level, above the 2%. Remember, 2% standard deviation, right? Like S&P 500 in most days over the last 12 years did not have 2% move. COVID, yes. And this year, yes. But 95% of the days did not really move much more than 2%. Now you know why. Any questions on this market gamma and how it influences the market before we move on? Yes. So he's asking, where do you see the dealer stats? So I have paid some developers to collate all the open interest. You can actually pay for a subscription to opra.com. So option pricing, something authority, whatever it is. All of the data comes from the Oprah, right? So you can pay for a subscription and they will send it to you, and it's done once a day. It's midnight Eastern, right? Sometimes they get a little bit early, but it's midnight Eastern. I have a proprietary program that collates all that, summates all that. It lets me know, hey, what's the open interest changes on the calls, the puts, everything. And you can actually calculate gamma exposure. Maybe someday we're not going to have time today, but there's an actual formula for gamma exposure for that. Yeah, and you can calculate that. Python and can do it all for you, basically. I do share that information every single day with the Benzinga Option School members. And I'm working with Benzinga. We're building a few apps. We're starting small, but then the goal is to eventually build some apps that actually do that so that Benzinga Option School members or pro members who pay for it can see this every single day. Just like click a button in the pro and it would be there, kind of thing. That would be the goal. Yes, sir. Everything. Everything. Well, we don't monitor OTC. It's not worth it for us in liquidity wise. We monitor all the stocks though in the market that have a significant amount of options. Yes. This is just for SPX though. Yes. This is just for SPX. Yes. You can do it for each individual stock as well. Once you get below 1 million options, like total open interest through all strikes, all expiries, once you get below 1 million, the data becomes, I would say it's solid, but not as robust. Once you have 1 million options, the robustness level of the data becomes like pretty impenetrable at that point. Yeah. But this is for the SPX. You can do it for also stocks as well. Yes. Yes, sir.
Could you use live volatility for
Yeah, they're moving in the opposite directions generally throughout the course of an option. Implied volatility, like as we get closer to the expiry, gamma goes up around the at the money, and implied volatility comes down. They're moving in opposite. That's actually called Vanna exposure. Yes. So you can't actually do that. You can actually collate Vanna exposure as well. Yes. That's another app I'd like to build with Benzinga. So I'm mentioning that because I think one of the executives is back there, and I want them to hear how important that would be if we built that app. Because I know you all pay for that. That'd be huge. So, any last questions on this before we move forward? Yes, sir. Yes, absolutely. Absolutely. Because gamma is not something that's very flippant. It's pretty stable over periods of time. If we're in negative gamma, in the bull trend of like 2010 to like 2020 up to COVID, you're talking, I've looked over the last 100 years of, the market returns. It was one of the best decades on history. A lot of positive gamma in that environment, right? That didn't change much into negative. It had very frequent kind of spasms into negative gamma, but then it would revert. Because remember, volatility is mean reverting. So you see that in VIX. With the current environment, we've been pretty much in negative gamma for a long period of time. It's not common that you'll see the market spend 50% in negative and 50% in positive over like a 6-month yearly time frame. It's just not common. Yeah. So yes, those effects carry over. It's the trickiest times and some of the best opportunities is when the market flips from one day, like it started in negative gamma, and by the end of the day, it ended up in positive gamma. That's a transition, which means that there's going to be a transition in volatility as well. Also, when the market flips from positive to negative, that's a chance for it's like a window for the volatility to express itself more. Yes, it's a great question. Okay, let's move on to the next one. So it should be pretty clear how the price action is different in a positive and negative gamma environment from looking at this. This positive gamma is that typical mean reversion you see. Now, does anybody notice anything about this flip from positive to negative? Does anything kind of step out to them? Jump out? What's that? Big spike in volatility, yes. Anything else? Volume increases, yes. What about the date? Yes. Because you got to remember that when's the monthly expire for VIX? On a Friday or a Wednesday? It's on a Wednesday. It's in the morning. So that means a lot of that implied volatility Vanna exposure reduces. Dealers' books are clear at that point. So it creates this kind of, some people have called it a window of weakness. It's more of a period of non-strength where the dealers are not coming into the market as aggressively because the implied volatility effects are not there. They don't have to hedge based on implied volatility at that point in time. So OPEX, very common. Again, the order book clears itself on the option book. That's going to have a huge influence that allows the market to start expressing itself again because you've pulled a lot of options out of the market. So volatility is very likely to increase. In fact, if you looked at a weekly chart on the S&P 500 in like, say, 2020 or 2021, you would notice these like few dips in the near vertical rise from the COVID lows. They suspiciously often line up around the monthly OPEX. Go to the weekly chart of COVID. When did the COVID crash actually start? The first day after the OPEX. We were in positive gamma going into that. The market flipped to negative gamma. Market starts to liquidate. When did the COVID bounce happen? The week after the March OPEX. That is not a coincidence. Go look at 2008. You look at a lot of the biggest moves, the biggest sell-offs over the last 10, 20 years. A lot of them happen around OPEX because of these flows coming in and coming out, this hedging exposure coming in and coming out. So if you think about this, now, do you want to be long volatility in positive gamma? No, not when it mean reverts. So you don't want to be long vol. We know we want to be selling vol on those rips. We can buy the dips, that's fine, but we can buy these, but we don't want to be long vol expecting a 3-4% rise in the S&P 500. Do we want to be short vol in negative gamma? Yes, but it's a little bit trickier because there's more volatility. Volatility, another way of expressing this is just amplitude, the capacity for the market to express itself up in time, right? That's volatility, it's amplitude. But what else do we notice about negative gamma? There's one other key component here that nobody picked up. Has anybody ever heard of VVIX? What is VVIX? Vol of vol. Another way of saying that is the speed or frequency of the volatility. Volatility is amplitude, how much it can move up and down, right? Vol of vol is how fast that happens. If it's low vol of vol, a low VVIX, you could have the same level of price movement and it'll just be really slow. When you have high VVIX, it's the same price movement, just really fast. Now, what are the hardest environments to trade? High VVIX. Super important. Those are the hardest to trade because it changes on a dime. Look at the intraday charts. What have you guys noticed on the S&P 500 recently? Are the rips holding for 4 or 5 days? What happened after FOMC? One of the biggest one-day returns in the S&P 500, 3.29% from market open to close. From the FOMC low, it was even bigger. What happened the next day? Lost all of it. Why? And then some. Why? Were we in positive gamma? No. We're in negative gamma. So can you start to see how knowing positive gamma, negative gamma, dealer hedging flows, delta hedging, and all this could matter for your trades on a day-to-day basis? Whether you're a swing trader or a day trader, whatever, you could be a long-term trader. I wish Kathy would take my damn class because she would not be buying these stocks right now. I'd be like, Kathy, you're in negative gamma. The market's going to move more to the downside. Never mind what stocks you're buying. I'm not going to talk to you about that. Do not look to buy in deep negative gamma environments. In fact, negative gamma, if you've been in positive for a while and all of a sudden you see a shift into negative and it's staying, that's when you should be initiating your hedges. Because if you initiate hedges, if you are a long stock and you're buying puts in positive gamma, why? The dealer is putting a floor underneath you. They are putting a buy limit underneath the market. Why buy puts? Why waste the premium? It'll bleed alpha that way. This makes sense? So negative gamma, you need to start thinking about hedging. Also, negative gamma means generally implied volatilities are going to go up. And it's also a potential for realized vol to actually outpace implied. And that's challenging. That's problematic. When realized outpaces implied, crazy stuff happens. Okay, any questions on this positive and negative gamma? Wait until we look at the next chart. So for 2022, we have been in negative gamma, I think it's 95% of all days. We've only had, maybe more, I think we've only had 5 or 6 days of positive gamma. 5 or 6 days of positive gamma the entire year. So this should be no surprise as to why the market is selling off the way it is. This is that, by the way, this right here, that's the February OPEX. Market sells off. Why did the market start to flip off? So think about it like this. If the market's been just consistently going up, you're probably not worried about the market selling off, right? So what's another way you can collect alpha on your account? Selling puts, right? So if the market as a whole is net short puts, think about that. If you're short puts, you're saying, you know what, I'm willing to buy at this price. If it goes down to here, I'm willing to buy at this price, and I'm going to collect a premium. That's a carry trade. That's a short vol carry trade, right? If the market goes down to your price and it just stabilizes there, you're not going to freak out about your short put. You're going to be like, okay, I want to be long at this price anyways. But if it jumps that, do you sit there and say, you know what, maybe I don't want to be long at this price? So what do? You close it out. You are now exacerbating the downside. You're removing that buy limit order. The market was net short puts going into this. COVID hits. Some really smart option traders decide to flip positions. BlackRock, a few others. I think they had like a 3.5 billion long put position within weeks. Market sells off. Dealers are having to trade with this. This is the week after the OPEX. BlackRock and many of these people start to unwind that position. Market reverses. What we've seen since the COVID bounce has been mostly positive gamma with little sprinkles of negative gamma. Remember I was talking about those kind of regular pullbacks in the S&P 500? You see a lot of these are around OPEX. So you had brief windows of negative gamma, but 8.5 out of every 10 days were positive gamma. Now look what happens when we shift to negative gamma. The market cannot get off the mat because the dealers are selling with the market. Is it starting, like this is kind of pulling back the curtain a little bit, but it should start to make sense as to why the market has been moving the way it does. And it would only make sense because of option flows are now becoming bigger and bigger and bigger and bigger. The bigger they become, the more influence they have on the market. If there was no option market, GameStop would have never ramped the way it did. It would not, it could not have. Absolutely could not have. Gamma squeeze. Why does that exist? Why did it allow GameStop to rip the way it did? Because there is an option market and option dealers were forced to buy. That's how gamma squeezes happen, because they're forced to buy. And there are only two ways to create gamma squeezes: long calls or selling puts, which force the dealer to buy. Any questions on this? My clock that is marching down to 0 is reminding me my curtain call is coming soon. So any questions on this? By the way, when I was originally told I could do this presentation, they told me I'd have 2 hours. And then they told me later it was only 1 hour. So we've only actually gotten through barely half the presentation right now. Okay, I'll give you with one more head exploding concept, and then I'm gonna take some questions and we'll call it a session. So the way you can think about options, volatility, and time is kind of this standard distribution that we see here, right? If you think about it, this is like, say, the at the money price, right? If you have an option that has low volatility, then it doesn't have a chance. The probabilities of it moving up and down are not that high, right? It's not going to move that much if it has a low implied volatility to it, right? So the distribution, therefore, is going to be more concentrated towards the center. It's going to be higher up, and there's a lesser probability of moving on the wings. When you increase implied volatility or increase the time window, that probability of returns flattens. Now, this is an important thing to understand because this actually gives you an insight also into how dealers hedge. Remember, they're delta hedging. That's what they're doing all day, is delta hedging, trying to get that flat delta, right? They are hedging by changes in price, which affects the delta. They're hedging because of gamma exposure. Remember, gamma gets bigger as we get closer to option expiry. They're also they're hedging based upon changes in implied volatility going up and down. If the implied volatility goes from low to high, they have to spread out their exposure further out on the book to account for the fact that this stock could move further out than it could here, right? Same token, if implied volatility comes down, well, then they can reduce the exposure. Like they have to have this hedged. They can just reduce it now. So this is like 101 Vanna and Charm hedging. So this is happening all day for an option dealer and market maker. They are doing this hedging exposure all day, and it's all algorithmically. And this gives you an insight. When you start to see how this reflexive movement forces the dealers to buy and sell, you can start to anticipate if the market's going to keep ripping or not, if it's going to mean revert or not. I'm talking to my teacher or my students in the Benzinga option school. Hey, there's a lot of options that are about to expire. Like right now, I can tell you right now, this market is completely dominated by puts. If you look at all the open interest, sub 420, 90% of it's puts. If most of that is long puts, what happens when those puts start to close? The dealers can start unwinding those hedges, which gives the market a chance to rise. So when you start to understand these flows, you understand this reflexivity, and you understand how these options force the dealers to buy and sell, this gives you insights into how you can trade. Intraday, swing, whatever. Any questions? Any heads exploded today? Don't worry, it happened to me. My head didn't recover for months after witnessing this the first time. Yes, sir. I appreciate that. Thank you. I appreciate that. Thank you. I gotta confess, this is not an easy subject. I didn't have a mentor when I learned all this. 21 years ago, when I started, there were no online streaming conferences or chat rooms like this. Nobody was teaching this. I had to learn all this myself. No mentor, no nothing. Luckily, I did eventually get a job as a broker and a hedge fund trader, so I was on both the buy and the sell side. But options is complicated. It's there's many different layers of this onion that you have to peel back, and I think it often intimidates people, and so they often end up just staying in this small layer of the onion, which is okay, long vol, short vol, buy or sell options. What are the strategies? It's important to understand. I can tell you from 21 years, option strategies, bull call spread, bear call spread, butterflies, they have zero edge by themselves. Zero. There's not one option strategy in and of itself that has an edge. They only get an edge by how you structure the trade. How do you structure trade? Market gamma, super important. Volatility, super important. Price action, super important. Option open interest. Those are the 4 ways you structure trades. That can give a strategy an edge. But the strategies by themselves have zero edge. None. They only get an edge when you structure them right. Super, super important. And that's what we teach you in the Benzinga Option School. This is what I teach every single day. Yes, ma'am.
Based on this information that you provided, like if I were to put on the gamma, what am I exactly looking for? Or the biggest movement, when am I looking for the gamma? What is exactly that I'm looking for in alignment with like the option?
Okay. So I generally don't look at the option chain per se to understand how market gamma is going to affect it. Once I know the gamma condition, then it kind of gives me a weather roadmap for the day of like, hey, should I expect volatility to increase, be strong today, or compressed? And so that tells me immediately, do I want to be long vol or short vol? Now, there are other variables into that. For example, if realized is at a premium to implied, do you want to be short vol? No. Because that means that the actual volatility, the option market makers, the pricing of the options is actually cheap to how it's actually manifesting. So when it comes to gamma exposure, think of it more of as like a roadmap for how I'm expecting the day to go. The various concentrations of open interest at various strikes matters, and how much of that is expiring today, tomorrow. If a lot of the options, if the biggest chunk of options, let's say you have 1 million options on your book, you're the dealer, you have 1 million options on your book. If you know that the majority of these options aren't expiring for 3 weeks, where are you in this exposure? You're right here. So you don't have to worry about what is called charm, the effects of time expiring and how that affects the deltas over time, the dealer's exposure to options expiring over time. So yeah, we have to look at all these things. What's the biggest bulk of options? Are they expiring today, tomorrow? Oh, that's going to do a lot. Oh, not till 3 weeks? We don't have to worry about dealer hedging impacts right now. Then it's just based on flows for the day. What are the dominant flows for the day? Yeah, it's a great question. My exit stage left man is going to yank me off. So thank you very much. I hope you enjoyed today's presentation.
Are we on? Yeah, look at that. All right. All right. Everyone have a good lunch? Yes? We're feeling full, feeling nourished. Great. We have come to the back half of day one, and got a few more exciting things for you here. And then, of course, we have the after party after we're done, which is the best part. So let's get this show on the road here, and let's bring on our first panel of the day. And I'm going to introduce the moderator, and I'm going to have the moderator come on and introduce the panelists. So without further ado, Justin Giles, come on down. Justin Giles is the director of contributor community at Seeking Alpha. I will give Justin the mic. Before I do, quick PSA: we are going to give you all access to this stream from this room and the other room, so you don't have to like bootleg record this because we have this thing recorded. We'll just give it all to you later on, so you don't worry about that. But Justin, floor is yours.
Thanks, Spencer. Great to be here. Hey, everyone. So super excited to be here on behalf of Seeking Alpha. We have a great panel today and also a panel tomorrow, so be sure to check that out. Today we have two of our top analysts, Jay Mintzmyer and also Michael Boyd. Jay's in the shipping sector. He covers that. Is one of the best in the industry, and then Michael Boyd is in energy. Just to give you some background real quick as they come up, as Jay and Michael come up. So Jay has been investing. He's been investing for 14 years, and he's been a Seeking Alpha contributor for 11 years now, actually since 2011. He's working on his PhD from Harvard University, and he's also an established independent research provider and also is a hedge fund consultant. Just over the last 6 years, he's had a cumulative return of 883%, and year to date, he's up about 40% this year compared to the indexes, which are down around 20%. So he's had a great year. And then Michael, he's been with Seeking Alpha since 2016. So his marketplace service is Energy Investing Authority. And so he really has an interesting approach, and a lot of investors just maybe look at the earnings reports and do all that, but Michael really is boots on the ground. So he's out there meeting with companies, executives, touring facilities, and doing all that type of stuff to really get down to all the in-depth stuff. And so welcome to have them today, and we're going to be going over some questions, and then also we're going to open it up to you guys to ask them some questions. So happy to have you guys here. So first, I'll just maybe have them introduce themselves a little bit more, share kind of their journey, talk about their investment style, things like that. So if you want to go first, Jay.
All right, hey everybody, nap time, right? So I got started with Seeking Alpha back in the summer of 2011. So if you read some of my early articles, please forgive me. I was just finishing up in college, and I was learning about the markets, and I had a very classical value approach. Dabbled around in that for a while, and I realized, a guy like me doesn't really have an edge in big stocks like Amazon or Apple or Microsoft. They might be good companies, right? They might be good investments, but I don't have anything unique to say or to find out or research. So I found out the shipping sector. So who's into shipping stocks, heard about shipping stocks? Anybody know about Zim? Yeah, Zim, right? So there's the IPO thing earlier, and Zim was like one of the best IPOs ever, right? I don't think there's ever been a company that had more dividends than its IPO price in 1 year, right? But anyways, point being, I specialized in shipping. In 2015, I launched a service on Seeking Alpha called Value Investor's Edge. We exclusively do shipping and related energy infrastructure stuff. So I work with Michael Boyd a lot with his research as well. We partner up on some of that stuff. Been with Seeking Alpha then as a contributor for 11 years and been running the service now for about 6. And so fantastic journey. I'm excited to talk more about it as Justin asks some questions.
Yeah, and my name is Michael Boyd. Started a little bit later than Jay on Seeking Alpha back in 2014 is when I first started writing public research articles. Just like him, started off really broad-based, covering a lot of different topics. But around in 2016, the energy sector in general just doesn't have a lot of very good public coverage. If you don't have access to research from names like Goldman Sachs or JP Morgan or those kind of folks, I wanted to help out the smaller investor, kind of help kind of fill those gaps and kind of provide some solid research for them to kind of help people improve their returns there. So I have a marketplace research platform on Seeking Alpha, focused exclusively on the energy sector, and like Justin was saying in introductions, focused on getting out there in the field. A lot of senior interviews. I'll be heading to a midstream conference right after I leave this conference, actually. So 20 one-on-one set up with management teams there, and throughout the year, try and get out to like the Permian Basin, places like that, kind of talk to folks on the ground, figure out where the best acreage is, and kind of go from there.
Awesome. Thanks, guys. So just real quick, Seeking Alpha, on one side of our platform, we have anyone can become a contributor and write analysis on stocks they think are undervalued, overvalued. And then we also have our marketplace program, which these guys are part of, where they can run their own subscription service. And so we're just going to dive in a little bit about how they started that, how they're keeping it running, and those types of things. So first question for you guys. Starting any kind of business can be daunting, as data shows that around 20% of companies fell within their first year. Knowing this, can you talk about the process of launching your own service, what it entailed, and the research you did to kind of help you set you up for success?
I mean, you could start with me. I come from an investment banking background. I traded mortgage-backed securities for a very long time, and then kind of moved to internal audit at an investment bank. So at least for me personally, I always wanted to kind of get out there and kind of do my own thing. Like kind of going with the 8 to 5 kind of structure, it never really kind of sat well with me. I wanted to be able to set my own schedule, kind of do my own thing, especially when it comes to trading my own accounts. If I'm working in an investment bank, there's some things I can't buy. There's restricted coverage lists, all that sort of stuff. So kind of getting out there and kind of doing this, that was a big motivating factor for me personally, kind of opening up my trading activity. And if you're starting your own business, obviously there's always a lot of risks involved in that. But I guess what I always tell people is there's never the perfect time to do it. There's always going to be some sort of risks involved, whether it be family, work, savings, time, all that kind of thing. And at the end of the day, you kind of just have to kind of work on your kind of like business view. Hopefully you establish your market, and you just got to take that leap of faith and kind of get out there and start on the grind. So
yeah, I think related to that, it's really important that you have your specific niche, your specific ability, something that differentiates yourself. Whether for me, that's shipping, for Michael, that's energy. I think if you look across to most of the top platforms on Seeking Alpha, what do you have, like 160 services? Or
We have 180 services.
180 services. So if you look at the top 10 or top 20 services, where we're blessed to be in that ranking, you'll see folks that are very specialized, right? Whether it's energy, shipping, REITs, specific high yield income, things like that. So if you did want to launch your own service, your own brand, make sure that you have that audience in mind. Make sure that you have that particular niche. Make sure that you're adding value, right? I mean, there's already maybe there's already 10 people doing a crypto service. So maybe you're not doing crypto, right? Maybe you find a particular thing that you can do. Maybe it's, I don't know, I'm just making things up, but maybe it's like electric vehicles, or maybe there's something you can do better than anything else that's out there so far. And that's how you're going to succeed. I think the services that fail, and Justin would know way more than I do about the ones that fail, because I mean, I just never heard of them, right? But they're people just don't have a vision, and they don't have something unique to bring to the table.
And I'll just add, as you're going about building your subscription service, kind of guys go through a couple of stages to kind of set that up, kind of set expectations for your subscribers. Maybe you'll talk a little about that.
Yeah, I mean, as you kind of gonna go through, working with people, as you kind of like approach a business and kind of figure out, what your niche is, like Jay said, I think that I agree with him completely there. You kind of have to find your focus. But at the end of the day, it just comes down to talking with people. So, when I started with energy, I was getting a lot of questions like, hey, can you look at this stock for me? All these oil and gas metrics is just confusing to me. Like, I don't understand what, acreage is, or, how to choose one oil company from another. So when you have folks coming to you with questions, that generally means that they're going to be willing to pay you for your research if you have like a material edge in that specific area of the market.
Yeah, I think it's important to have those resources available for your members as well, whether or not it's introductory guide to the industry. We have a 7-part series that educates folks on the shipping industry. We have a model portfolio that gets updated once a month and rebalanced to top picks, the ones we drop out of that coverage, and so on. And I think just setting those expectations, like Michael says, and then offering those resources. Because, folks are going to sign up for your service and pay for it if they're getting more value out of it. Whether or not that's the stock returns, whether or not that's the education, whether or not it's the community and the engagement that you provide. So there's a lot of exciting opportunities on Seeking Alpha, and we have 180 services, and they're not all going to succeed. So it's not 100% batting average, right? But I think there's you have some stats, right, on like how many are like 6-figure services. And
Yeah, so we have 7 guys that gross over 1 million annually, and then around 50 or so that make over 150K a year. So we really have a strong subscriber base. I know we had a couple guys this year that started their second subscription service, which is kind of remarkable considering how the market volatility and stuff's kind of crashed, that they're able to still do that. And so I guess the second question for you guys, and then we'll open it up for some questions for you guys, is now that you find your niche, you find shipping energy, that's what you want to do. I guess, how do you go about building that brand, and what was the biggest challenge that you guys had to overcome?
Well, I mean, I think the big thing with building a brand is you have to have a voice. And I think that's where Seeking Alpha kind of has, that provides a lot of value, at least for us, like getting started is, you as an analyst or even, working yourselves, you might have like a great idea, but how do you get that out to people? Like, how do you expose people to those ideas? So I think that's where like the free publication platform at Seeking Alpha is wonderful. You get paid to, everybody can submit an article. It goes through an editorial process and gets approved, but everybody has a voice there. You get paid for that opportunity, and it helps you kind of build a platform and build a brand just like you would on Twitter or any place like that.
I think the best part of Seeking Alpha is the community. Every time I read an article, or even I write one myself, the best learning experience is always in the comments section and engaging with the audience and having that two-way flow of information. And I think that's where Seeking Alpha really excels. And I think a lot of other websites, the comment section is just pure spam, right? There's a lot of trolls. And if you get on Seeking Alpha and you read the comments on a serious article, like if you look at one of mine that was on Zim, for instance, you'll see a very, very engaged, thoughtful commentary section. 300 comments, and folks are asking legitimate questions, and they're really engaged. So I know that maybe didn't answer the question exactly, but I just wanted to pitch that as a big positive of Seeking Alpha. Real quick, one of the challenges I faced early on is my specialty is shipping. And shipping was in a decade-long bear market trough downturn, right? And if you look at our 7-year returns, they're pretty decent. But shipping writ large was not doing very well. So it was hard to convince folks that there was opportunity. It was hard to make that sell, whether or not it was, selling for the research, or whether or not it was selling, the idea of an investment in shipping. That was really hard, especially like in 2022 during COVID. The best time, generational opportunity of a lifetime to invest in shipping and also energy. And it was really hard to connect with folks on that. Right? Like, the common sense was that this was a terrible industry. And so I think that was the biggest challenge, is getting past that. Once people saw the returns, I think that probably helped.
That makes it easier.
I'll just open up for some questions real quick before we move on. Does anyone have any questions? Don't be afraid. All right. The third one is, so you guys covered the energy and shipping sectors, arguably the most popular one. Just joking. Was that by design, or were you guys just kind of following your passion and kind of just people felt that through your articles and stuff online?
I mean, like I said earlier, like for me, it was trying to fill a gap that I saw like in public coverage in general. Like the energy sector has been maligned for many years, whether it be through ESG initiatives or those kind of deals. Not a lot of profits in this space. If you look at bankruptcy filings, energy sector had a disproportionate share. And, if you go back to 2016, 2017, when I first started this service, a lot of my time was actually spent, digging through bankruptcy filings and seeing if there'd be any residual value left for the equity as it exited. So I think for me, like you have to kind of find that little niche area where there's value to be had, and you can provide value to a certain subset of people that are trying to look for more information in that space.
Yeah, I kind of mentioned it in the intro, but getting into shipping was about finding a sector where I could outperform and I could excel. And, shipping, most of these stocks, they're not penny stocks, but most of these stocks are anywhere from about 50 million up to maybe 2-3 billion. So they're very small caps, right? And so the institutional coverage is not very robust. There's a lot of weird trading activity going on in some of these names. There's a lot of like absolute garbage stocks to watch out for, and knowing which ones those are is very imperative before you get into an industry like shipping. So it was just a niche. It was an ability to find a sector where I could outperform. And like I said before, I mean, if our service is called Value Investor's Edge because when I launched it, I wanted to cover all sorts of deep value. I wasn't just going to do shipping. But after about 6 months or a year, I realized, right, why broaden when you don't need to? There's 50 different shipping stocks. There's no need to get into mining or, energy. And I let Michael do that, right? Michael has his own service. He's way better than I would ever be at analyzing these energy companies.
Just note on that, when you talked about just like creating your niche and that type of stuff, I guess over the years, how has that kind of progressed? Like with like energy and kind of shipping kind of has those cycles. I guess how are you kind of preparing, plan, strategize on that?
Yeah, I mean, like both of our industries are very cyclical. When it comes to kind of preparing people for that, personally, I do trade short. If we do reach the upper end of the energy sector, and I feel that value has been reached, then I'll be out there kind of pitching, hey, it's time to sell, or hey, these are short sale opportunities. For me, I think at least over time within my subscriber base, I've had members with me for basically since the beginning. So 5 years on now. So they've been through some of the peaks and troughs already in the energy sector. I think maybe the kind of prevailing viewpoint is, if a sector turns negative, then all those subscribers are going to run away. But if you've been providing value for years, I think they'll stick around because of the value that you provided in the early stages. So,
yeah, I mean, I think the biggest advantage that a lot of these services provide is that ability during a downturn to know which part of the downturn is legitimate and based on fundamentals and what part of the downturn is just regular market volatility, right? I think that's probably more important actually, to have a research service during a period of market turmoil. Sadly, that's not how human nature works. I don't know Seeking Alpha's internal statistics, but I would bet they are selling more subscriptions when markets are good than they are when markets are tough. That's unfortunate because I think when markets are tough, it's more important to have that kind of research available. I think one of the key things about shipping is it actually has 6 different subsegments. A lot of folks don't know that. So there's oil tankers, there's dry bulk, there's container ships. So each one of those has its own supply and demand cycle. So yes, it's cyclical, but they don't all move together. Now, yes, like on a really big day like today, they're all green. On a really, really terrible day, they're all red, right? But over time, fundamentals, price discovery, all that sort of thing, they move in different cycles. So even when one sector is absolutely garbage, like oil tankers were garbage last year, container ships were amazing, right? And right now, oil tankers look a lot more interesting, right? So there's different sub-segments that we can navigate through. And Michael didn't mention it, but I mean, there's energy too, right? There's refineries. And
energy is the same way, right? So you have upstream producers, you have oil and natural gas. They don't necessarily move together. Midstream pipelines are the same way. Refining is a really hot sector right now with crack spreads and how everything is going there. So they're not necessarily going to move up and down together. It's the exact same way as shipping.
Awesome. Any questions real quick?
I have a question for you guys. So you said that you don't plan on going outside of the shipping sector, but I would wonder if any of the principles that you learned so well in the shipping sector the past years, do you think they would translate to other individual securities in sectors that aren't shipping, or not as much?
Yeah, no, that's a great question. I think they would, because it's fundamental value approach is how I do these things, cash flow models, all that sort of stuff. So the skill set would apply, but I don't have that much time, and it would be a disservice to our community. It would be a disservice to my members to deviate away from where I've excelled into something I'm learning. So when I want to get exposure to a sector, I actually sign up and pay for subscription services. So I actually pay for 5 or 6 different Seeking Alpha services. Michael's is one that I've been a member on for many, many years. So when I have an energy question, I just hop on the chat or I give Michael a text or whatever, and I say, hey, what do you think about this stock? Or what do you think about this idea? Hey, can we have a call next week or something? Because I could spend a week learning about a stock, or I could call Michael and talk to him for like 5 minutes. And so why overcomplicate things?
I think there was 1 or 2 more out there. Yeah.
I mean, for me personally, the way I describe it is if you think about it like a ball game, I think probably first inning was probably like 2019. I think probably each year since then has been an inning. So I think we're probably around like the fifth inning for energy. So we're right in the middle. I think you have plenty of years there left for outperformance. I mean, obviously, it's not going to go straight up the entire time, but I think the energy sector, at least relative to the S&P 500 or whatever other sectors you want to benchmark it against, I think it's going to outperform over the next 3 to 5 years for sure.
Yeah, as you know, shipping's been really hot, right? We're up. Our models are up 39% year to date. I think the Russell's down 20%. So that it's been a pretty hot market. I mentioned that shipping has like 5 or 6 subsegments. So different ones are in different innings. For example, oil tankers are they're still warming up. They're still in the dugout. They're not even on field yet. Container ships rates are probably 8th inning, maybe 9th inning, right? But what are the valuations looking like? Has that already been priced in? So you have a company like Zim, for instance, in terms of rates and the cycle, I mean, it's probably 8th inning for Zim. But in terms of valuations, it trades at less than 1 times forward earnings ex cash. I mean, it's super cheap. So it's already kind of more than priced in. So there's kind of like 2 different questions, like where are we at in the cycle and what are the valuations? And that's where being deeply involved in an industry like this, it's been 10 or 11 years for me personally, being deeply involved in shipping and kind of understanding how those cycles work and where the valuations are at.
Awesome. Any more questions? Yeah, so I'll take that question. The tools and resources that we have are, I guess, numerous. So a couple of years ago, we just launched our quant rating system, which takes 5 factors like momentum, earnings, if the revisions are up or down, valuation, growth. And so that's just like a quick gauge that readers have really found super useful. I remember last year, our quant rating system told members to sell Peloton. It was like $80 or $90, and now it's like $20. So just factors like that have been awesome. Just other things. So Seeking Alpha, as we mentioned earlier, anyone can become a contributor. Anyone can share their investment analysis, share with the community with our global reach. We average around 200 million page views a month. So, and we have people writing from all over the world. So it really is truly a community crowdsourced investment platform. And also when you're a contributor, every article that you publish, you get 60 days of free premium. That gives you access to pretty much everything on the platform, be able to message other contributors like Jay and Michael on the site, access to the quant rating system, earnings transcripts, all that fun stuff. We publish around 100 to 150 articles a day. So we publish a lot. And so there's so much insight. My favorites are just the earnings transcript, seeing what management is really talking about, the points they're hitting on, and just, especially with the analysts, the questions that they asked, just kind of really give you insight on how the companies are performing and things like that. I don't know if you guys have anything else you want to add.
Do you mean like a resource like provided for the author themselves to like engagement? Yeah, no, that's a great question. Yeah, so Seeking Alpha breaks down the page view metrics pretty well, both in desktop and in mobile views, and you can break it down basically by day and by article you've written. So I've been on the website now for 11 years, so I think I have, 250 articles over that period or something publicly, and I can look back and it'll show me basically which ones are getting comments, which ones are getting page views. And then there's also like a notification bar that'll tell you like 5 new comments on your article, so you don't miss anything like that. In terms of like where to write on or what's popular or what's not popular, Seeking Alpha also has like an incentive program where they pay you, I think it's like $50 or $60 to write on stocks that are underfollowed. So that way, if you're just coming onto the website and you feel like you got something names, but you're not sure like which one to focus on, you can go to the underfollowed list and see which ones, first of all, have the bonus, so you make a little bit more money. But second of all, that's an indication that there's not a lot of work being done out there and you can actually provide value. Like, please, for the love of God, do not come on Seeking Alpha and write an Apple or Tesla article, please.
Just real quick too, that reminded me, before I was in my position at Seeking Alpha now, I was a writer since 2013, and just how Jay was talking about just those small cap stocks. I mean, I wrote about them, and then just by doing so, just be able to interact with their investment relations team, really talk with the CEO. I've had a number of CEOs just give me their cell phone number and say, hey, Justin, call, text me with any questions you have. I saw your article. I'm thankful for the coverage. If you have any more questions, reach out to me. So it just really opens up a lot of doors, even if you're just writing about like a lesser known stock, not the Teslas, Amazons. You can really find your niche that way too.
Yeah, and just one more quick thing. If you are kind of looking at folks like myself and Michael and thinking, I want to do that, I could do that, I could have a service, absolutely, you could. But you want to start right with writing articles and building that follower base. And maybe you already have a follower base on Twitter or something. You can, bring that follower base over. You want to, write. I would say you should probably have at least, I don't know, what do you recommend? 20 articles before you would launch a service, or
usually
something?
20 to 30 articles before launching a service.
And good engagement, right? Like 20 or 30 articles that have 50 comments. You don't want to be that kind of person that writes an article and then people will ask you questions and you never answer them in the comments, right? There's a few Seeking Alpha people who write on Seeking Alpha, they grind my gears, and they'll write this article and it's like, everyone makes mistakes, right? Like I've written articles in the past that are mediocre, but people will post comments and usually they're helpful comments or they'll ask questions and it's like a one-way flow. Like the author never comes back and doesn't engage, and that's a huge red flag to me. So if you want to build a service and you want to build a community, engage and be humble. Like I make a lot of mistakes. All you got to do is be right. What, 51% of the time, or 20% of the time if you have a lot of winners, right? So I mean, everybody makes mistakes, and be humble about that and be approachable.
I guess next question is, you guys continue to grow pretty good, rapidly, put up monster returns over the years. I guess what's the secret to not only building and growing your following, but keeping it as well?
I mean, engagement, like Jay said, comes down to that at the end of the day. And like he said, like owning your mistakes. Like I don't bat 100%. Like I've made my fair share of mistakes over the years, whether it be on a call or even in my comments section, be like, hey, you made a mistake in this, this DCF model, can you check this out? So people, I think, realize that not everybody's perfect. We all make mistakes, but you have to own up and kind of eat your own cooking. At least for me, part of it, I'm running a real money portfolio. So if, I make a bad call, I'm right there, with my folks, I made that mistake too. And I'm feeling the pain from it. So I think that's an important aspect of it.
Yeah, I think I've been hammering this, beating this dead horse, if you will, but yeah, absolutely engagement. And then providing those resources that are helpful, not only in a bull market, but also in a neutral market or a bear market. For example, we have something called the Live Analytics platform on our service. And so we cover 47 maritime shipping firms, and all those companies are included in the analytics platform. It breaks down their fleet profile, cash flow models, net asset values, things like that. So folks use that as an essential part of their day, whether for trading or for researching or whatnot. So I think most of our members probably have that bookmarked. And I've had folks tell me, yeah, I look at that thing every day. I mean, it's linked into live prices. I think it's with Google Finance, so I think it's like 15-minute delayed or something. But 15 minutes with live analytics of net asset value, price to earnings, price to cash flow, all those different things. We have a scenario editor in there where folks can plug in bull case, bear case, all those different things and see exactly what will happen fundamentally to these companies. So that's just there's more than that, but that's an example of one resource that we provide that's useful in any type of market. It doesn't just have to be a bull market.
Yeah, I mean, I do the same thing on my side. So I have, same thing hosted through Google Finance, so spreadsheets for relative valuation. So it has, the current share price, my personal EBITDA and free cash flow estimates, analyst consensus, so where the deviation is, my price targets, my personal recommendation, so buy, hold, sell. So for my folks, they might necessarily ask me the question, but they know to go into that platform like, hey, I'll run a filter here. I want to put some cash to work today. I want to buy like a midstream pipeline company. What is Michael like today based on what the current fundamentals are? And it's a great tool, and it's really kind of helpful where they don't necessarily need to ping you to reach out to you and kind of get that information that's already built into them, and they have access and they can kind of do it and access it whenever they need to use it.
Awesome. Next question is about networking, kind of what we're all doing today and tomorrow. I know it's kind of a must these days. Jay, you were at the Money Show conference a couple of days ago. Michael, you're headed to Florida for the EIC conference. I guess what has worked well for you guys, and what advice would you have for people who are trying to stand out?
Yeah, I mean, I think it's really important to kind of get out there, whether you're at an event like this where it's more meeting like the retail crowd, kind of like meeting other traders and investors, or if I go to like more of an industry conference and kind of meet with senior management and kind of discuss companies and everything like that. And that's where I think, like, at least for me, Seeking Alpha comes in handy when it comes to that. So when I met with like these management companies, we're like, hey, I'm writing for Seeking Alpha. I'm doing some research. Here are some questions that I have. And that kind of like opens the door. And then, you're having conversations with investor relations, and then suddenly you have like the CEO and the CFO talking to you. Then you have like their cell phone number, and maybe I'm in Florida or the Texas or someplace like that, and I kind of grab lunch with a couple of folks while I'm out there. So it's a great way to kind of get your foot in the door and kind of like get that kind of like access. It's not, this is not like material, non-public information, but kind of helps you kind of get like that edge to kind of understand certain facets of the business that you wouldn't necessarily get if you're just looking at a corporate presentation or reading through SEC filings and that kind of thing. Because, that's something that, Goldman Sachs or JP Morgan or those kind of folks, those analysts have that kind of access. You can kind of have that access too, with the right companies. So.
Yeah, it's absolutely imperative, and it's been rough over the last 2 years with COVID and everything. I mean, we've all lived through this together, right? So props. I don't think Jonah's in the room, but like props to people like Jonah who are doing conferences like this and bringing people together. It's absolutely imperative. For my research in particular, the biggest shipping conference, at least in the United States, if not the world, is called Marine Money, and it's a week every year. It's a week in New York City in mid-June. Sadly, the last 2 years have been canceled because of COVID. So I'm excited to head out there next month. It'll be the first time I've been out there in New York since 2019. That conference is an amazing opportunity. I have met pretty much all the CEOs and CFOs of almost every single company that we follow. My first time going out there, tickets are $3,000. So it's pretty pricey. But I was invited in 2018 to speak on a panel because I was like one of the up and coming people in shipping in terms of research. So we had a panel with folks like myself who were investors and analysts in the space. And being there at that conference and meeting those CEOs and CFOs just completely opened the door in terms of research abilities and company insights. I'm on a lot of the earnings calls with these companies, and I ask questions on the earnings call just like all the other analysts. I'm connected with almost all of them on LinkedIn. So I'll just shoot a message straight to the CEO and, hey, what's going on with this? Or, how is the market looking? They can't give me non-public information that would be illegal, but they can give me general things, right? And talk about the market, or we can set up a phone call. One of the things we do on Value Investors Edge that I think adds a lot of value for our members is we host conference calls with the company executives just for our members. So they can jump on something like a GoToWebinar, GoToMeeting. That's a platform we use, but it's basically the same as Zoom. And company executives, CEO, CFO is on, and I ask them questions, and people type in their questions right into the live chat, and I have a dialogue right with the executives. We record the recording. Seeking Alpha has an awesome transcripts team that has made up transcripts for us that we share with our members. So a little bit of a long-winded answer, but networking is absolutely imperative as a researcher, as an analyst, as an investor. Meeting each other, bouncing ideas off other traders is a great idea. So kudos, again, I don't think he's in the room, but kudos to Jonah for putting this thing on. And I hope there's many, many more to come.
I don't know if I can afford those $3,000 tickets, Jay. You got any discount codes you can send me?
Yeah, I think FinTwit conference is much more affordable.
Real quick, before we open up for some more questions, I guess, what opportunities have come maybe from publishing on Seeking Alpha? Is there anything that's maybe stood out, like a big moment for you?
I mean, kind of talking in circles, but I think once again, just kind of like being able to talk with CEOs and CFOs. I mean, I think that's a major aspect. It's really helped my research. It's really helped kind of fine tune certain aspects of my approach. So if I'm building a model and I have a question, I don't necessarily have to like guess on a certain factor. I don't have to make educated guesses anymore. I can go straight to the source and be like, hey, this is my approach. This is what I'm trying to do. What do you think about this? And that kind of thing. So definitely kind of like public company access for questions was a big thing from Seeking Alpha. And I mean, and just in general, like being able to do this for a living. I mean, it's a great way. It's what I want to do. It's my passion. Like not a lot of people kind of feel this way, but I love spending my day in like in SEC filings or in Excel, kind of like building cash flow models and that kind of thing. So it's a great way to kind of, I'm investing anyway, and I'm kind of like leveraging that and kind of turning it into another business as well. There's a subscription platform. So.
Yeah, I mean, it sounds kind of cheesy, but I mean, Seeking Alpha has quite literally changed my life. I've been involved with it for 11 years. When I started off in 2011, it was kind of just a hobby. I was finishing up college. At the time, if I look back at what I wrote 11 years ago, I don't know how much value I was bringing to the table back in 2011, but the ability just to integrate with the community. And the former CEO of Seeking Alpha, sadly, he's passed away, but he invited me to launch the service in 2015. He said, you have great engagement in your articles. We're starting this new thing called a marketplace. We'd like you to be one of the first 30 or 40 services we launch. And that just, launching the service, it really changed my life. And I think, you've heard of Zim, right? And being known, I think is, I don't know how many people have heard of me before or heard of Zim or whatever, but, that was basically us. Like we've followed that company since IPO, and having that sort of opportunity would have never happened without being plugged into something like Seeking Alpha.
Awesome. Take some more questions right now. Anyone has any?
How do you balance the people coming to first there in the middle, like people coming to all on Benzinga, crazy viral stuff, people that are in this, want to take something and bring there is something real on day one. How do you balance that? People that are here.
Yeah, so what we do in our service is we try to provide everyone the resources, but like one of our taglines is we research, you decide. So I legally cannot give anyone direct investment advice. So, but we structure the service in a way that there's something basically for everyone, right? There's the analytics platform that provides all the fundamental details for anyone who wants to use that. We have a model portfolio. We have top picks. I share all my trades in real time. Or as real time as possible, right? Sometimes there's a limit order that I don't see for a while, but as much in real time as possible. Literally, like I put an alert in the chat room. We have an announcements and trades room that says, just added 25% to whatever stock at 25.49 average price or whatever. So that's an idea for folks. They see what I'm doing trading wise. The models are more like investment focused longer term, and the analytics platform can be used however you personally see fit. So that's what I've done. We have all sorts of folks on our platform. We have people who day trade literally in and out throughout the day. We have people who swing trade, cycle trade week to week. We have folks who own companies for 4 or 5 years. So all sorts of different people.
Yeah, I mean, my service is the exact same way. I have folks that are in there kind of trading options every day and energy, and I have folks that have holding these companies for 4 or 5 years. I'm the exact same way. Personally, I tend to hold things for a couple months to 2 years. I'm very catalyst driven, story stock kind of things where I'm trying to identify something that's upcoming in the next couple quarters. But I kind of do the same thing. I put my trades out there. If I'm buying something, I ping it. I actually ping my trade in the chat before I actually pull the trigger myself. So technically, if you were super quick on the trigger, you could front run me if you wanted to. For me, transparency is always a big thing. I spent first couple years out of college at an investment advisor. So kind of that whole fiduciary responsibility has kind of followed with me over time. So it's basically the same approach that we take. And people all have different approaches, but I think that's part of the community, right? Is if you're on Jay's service or mine, there's going to be some people that have the same kind of time frame on holding period as you do, and there are going to be people that have other alternative timelines.
Any other questions? Yeah.
Ocean container shipping rates pre-COVID versus post-COVID have gone up like threefold. And maybe that contributed to some profit to these companies. Do you see now that COVID is, going almost over, but do you see those rates coming down and affecting the profitability of ocean shipping companies?
Yeah, no, it's a great question, especially if you're looking at something like a container shipping firm like Zim. Right? I mentioned earlier that in terms of shipping rates for a company like Zim, we're probably in the 8th inning or 9th inning, somewhere thereabouts. It does depend on what the valuation of the stock is, right? I would argue that's priced in. In terms of what caused the rise in rates, part of it was cyclical, just regular supply and demand, and part of it was catalyst driven because of what happened with COVID. So with COVID, right, we had the global lockdowns in early 2020, in March and April, and all these ports worldwide shut down. Everyone was locked up inside their house. People weren't building anything. And then the economy opened back up in May and June and July of 2020. And as everybody probably knows, right, Americans were buying more and more stuff. And our ports and our logistics infrastructure is not built to handle fits and starts in shipping volumes. It was built for just-in-time shipping, where everything is one ship per day, one cargo load per day, and everything's nice and smooth and steady. So when we had that big fit and start with COVID, it caused basically a logjam, so to speak, that has lasted a year and a half, and we're still struggling through it. And right now, most of the Chinese ports are having issues. China is still doing the zero COVID thing. So when China opens back up here in about, well, hopefully it's a couple weeks, hopefully it's not a couple months, but whenever they open back up, it's going to be another logjam that's going to hit the U.S. West Coast. So if that happens, it might not be eighth inning, it might be sixth or seventh inning. I just say eighth inning, to be conservative. But that's kind of what happened. It was a mix of things. It was the long-term supply and demand was way out of whack, and then it was like huge, just slamming fits and starts because of the COVID situation.
Any other questions? Yeah, sure. One of my favorites is Vermilion Energy. Look at that. But yeah, they're big on they're a European natural gas player. So if you've followed any of the issues with the Russia-Ukraine conflict and Europe being short natural gas, or natural gas prices are through the roof. They're actually based out of Canada, so they do have some Canadian oil operations as well. But the biggest chunk of their free cash flow is going to come from their European natural gas holdings. Strip futures prices for European natural gas, they look strong, not as high as it is right now, but for years. So they're going to be throwing off a lot of free cash flow there. I think if you look at the valuation, 35-40% like free cash flow on the market cap. They've shifted back to a dividend model after cutting it a couple years ago when European gas prices were in the tank. So all the extra free cash flow is going to go to deleveraging the balance sheet. Great valuation prospects there. It's definitely just a great place to be, especially if you compare it to anything else in the market. If you look at other sectors, you just don't see those kind of valuations.
Yeah, so in our model portfolios, we have 14 companies currently. There's a value model and a speculative model. But the great thing about that is there's always something I can talk about, publicly without disadvantaging our members, right? It wouldn't be fair if I came out and gave all 14 of our top picks, of course. One name I've covered publicly, and I'm still very, very bullish on it. I've actually been adding to the position this week, is a company called Danaus Corp, DAC. This company owns the actual container ships and leases them out to liners like Zim or Maersk or CMA CGM, Costco, those companies. And so their revenues are fixed for 3 to 5 years because they lease the ships out. And those lease rates are at all-time record highs, and they've already been signed. They've already been locked in. So, the daily container ship rates, they don't really matter anymore. You can easily model this company. You can set up a discounted cash flow model or a price to EBITDA or however you want to value it. And right now, oh yeah, and by the way, Danaus Corp has been a massive investor and holder of Zim shares. So right now, we don't know if they've sold all their Zim yet. I'm hoping they sold a big chunk here earlier in the year, but assuming they have their shares, it's worth about $20 per share in cash, just the Zim shares alone. They have another about $10 to $12 in cash per share as a result of operations and a result of the Zim dividend that they secured. So that's a little bit over $30 right there. The stock trades, I think it's up a little bit today. I think it's in the low 80s, like 82 or something like that. So if you take out the Zim shares and the cash, you're down to $50. And this is a company that's going to do $30 in earnings this year. It's probably going to do 27, 28, maybe 30. It's going to probably do nearly $30 next year. It's probably going to do about 25, 26, 27, 2024. All these revenues are basically locked in. They're basically 100% chartered out for 2022. I think they're like 91% chartered out for 23, and they're like 75 or 76%, I believe, for 2024. So this is a company that's already got all their ducks in a row. But the market has been selling this thing off. It's down from about 107, a yearly peak, down to mid to upper 70s during this sell-off. Because folks are thinking, oh, it's a container ship company. The U.S. consumer market's kind of weak. I don't want to be in this thing. But I think the market doesn't quite understand the valuations. They're going to report earnings Monday afternoon. So fingers crossed for that one. I'm really hoping they go forward with a repurchase program. That would make nothing but great sense. They would be buying basically $1 for about 35 cents. They trade about 35% of their adjusted net asset value. So we're really hoping for repurchase. And the CFO has also mentioned that they're looking into a stock split. So we're hoping they'll do a 4-to-1 or 5-to-1 stock split to help the liquidity. But a stock split doesn't make something more valuable, but it does help with the trading liquidity. So we're really hoping they do that and launch a repurchase program. Very long. I'm very much talking my book, but I'm bullish on this one, and I've been adding a lot this past week or two.
Thanks for sharing your top picks. I'm going to tweet right after, so I'm going to hold you to it. Just kidding. One more question here, but then we'll open up for like 9 minutes left, and then we'll open up back up to you guys. So what advice do you have for those that are thinking about getting into investment research or launching their own subscription service?
I mean, I think my advice would be just to give it a try. I think you almost, I always tell people, it's almost like I'm writing college essays again when I'm doing like research articles. I think it's a challenge for people maybe to kind of put their investment thesis into words. I think it's a great way to kind of bulletproof your thesis, and as you kind of go through writing it almost like a research paper, like you're thinking about things like, oh, this is like my bull thesis, what are the weaknesses in this, and all those kind of aspects. So I think, just getting out there and trying to write something in a kind of research note format is a great way to try and learn and kind of frame your thesis and kind of try that out.
Yeah, and don't put the cart before the horse. If you've never written on Seeking Alpha before, you're not going to start day one with a subscription service, right? You're going to start by writing an article or two, seeing if you have traction, seeing if you can build up a community. Or if you're someone like, I'm just using Jonah as an example, he has a huge online following. So somebody like Jonah could make a more natural transition to a service like Seeking Alpha. In fact, I think there might be something happening there. I don't know. I don't want to spill the beans there, but I think his sign actually says Seeking Alpha on it. So I think that secret might be leaking out. But someone like that can make the transition easier because you already have a big following. And maybe some of y'all have Substacks or something like that, and you can navigate that way. If you don't, that's totally fine. But start by writing articles, getting that feedback, building that network. And then, 2, 3, 4, 5 years from now, you could be up here on stage talking about your journey.
Awesome. Thanks, guys. Open up. We got 7 minutes left, so we got time for a couple more questions. If not, we'll just keep talking about Zim.
Yeah, you can ask anything.
Any questions?
All right. What stock do you like the least?
Just real quick, maybe. I don't know if we have the slides. Do we have the slides? If you can put them up real quick before we get to your question. I don't know if we have them. Just some stats from Seeking Alpha. If not, we'll just take a couple questions. I know you had one, and then you.
I think one of my biggest holdings that did really well, I bought DCP Midstream that sank during the pandemic. I think I bought shares at $2.30, and it's at, I think, $38 at this point. So it's a very strong business. They move natural gas around the mid-continent, and they have leverage to higher oil and gas prices as well, which is a little bit different and unique for a pipeline company where you kind of think about fixed tariffs. So it doesn't really matter if oil's $5 or $500. They earn the same fee regardless. DCP is a little bit different. They kind of have some leverage to higher prices. But, coming to mind, I think that's the one that kind of stands out in my portfolio right now. And I still own it. So,
yeah, I think without a doubt, nominally speaking, nominal dollars, life-changing experience, life-changing stock has been Zim, without a doubt. I mean, we were in there researching it before the IPO, getting excited. I couldn't even believe the numbers in the filings I was reading. I thought there must be something. It didn't even make sense. They were going to price this thing they were originally going to price this thing at like $17 to $19 a share. This was during like the GameStop peak mania that was going on. And they ended up underpricing it down to 15. They did a smaller offering. And then the first day it opened was that whole Citadel, GameStop, AMC short squeeze day. And it went all the way down to like $11. And within 13 months, they had paid out $21.50 in dividends off a stock that we bought for 11 to 14 that first trading day. So nominally speaking, I mean, that was a life-changing stock.
Between the two, Valero is actually my favorite large caps right now. I think, structurally, I don't really invest in large caps a lot personally, but I think they've position their business wonderfully when you think about where their refineries are positioned, their ethanol business, how they kind of balance their their renewable identification number obligations as well, kind of like the export business. It's a great stock. It's one of my favorite refiners. Another one that I like is HF Sinclair, ticker DINO. They recently did a merger. Yeah, so it used to be Holly Frontier, if you're familiar with that name. Yeah, so that I own that one personally. That's one of my refining names that I really like. At least for me personally, at least if you go by like enterprise value, I've met with ConocoPhillips CEO before. Energy Transfer as well is another big company in the midstream space. Enterprise Products Partners as well. So those are 50 to 120 billion dollar companies.
Yeah, it depends about the market caps fluctuate, of course. Right now, the biggest market cap company that we cover happens to be Zim as well. I have to do the math. I think it's public math. I'm going to embarrass myself here, but I think it's around 10 billion of the market cap of Zim. And I've talked with their CFO on many occasions. We've done a formal interview. We do informal conference calls and things like that. That's probably the biggest company.
Time for one or two more questions.
In a bad way or a good way? Or in a good way? Okay, yeah. Just making sure. Yeah, because I have experiences both ways. So, small cap wise, you have one. I'll think about this question.
No, it's a great question. I think in each subsegment, I don't think it's fair to list all of them, all the best companies, but in each subsegment, there's one or two management teams that really stick out, just head and shoulders above everybody else. One of the companies that has really stuck out to me as being exceptionally well managed in the dry bulk space, so it's like coal and iron ore and stuff like that, is a company called Star Bulk Carriers, SBLK. I'm actually not long at the moment. The valuation, I don't want to say it's overvalued. I think it's very fairly valued, but I don't buy things that are fairly valued. I buy, that's not what I buy. That's what I usually sell and take profits. But Star Bulk is the absolute, in my opinion, the best managed dry bulk company. The CEO is extremely well connected in the industry. He's been in shipping his entire life. The CFO team is very well put together. The president of the company is a guy named Hamish Norton. He's got a PhD in physics, actually, which is pretty cool to talk with him about like ship designs and fluid dynamics and stuff like that. He's a really smart guy. Very good corporate governance. Oak Tree Asset Management has a big position. So that would probably be the best in that segment. There's one in every sub-segment that is head and shoulders above everyone else. Yeah, very good variable dividend. They're paying out basically 100% of free cash flow to shareholders.
Awesome. I think we'll wrap it up. I'll just look at the screen real quick, roll off some numbers. So since Seeking Alpha was founded in 2004, we've had 17,000 contributors over the years. We have about 1,000 to 1,500 that are active. Last year, we covered 8,000 different tickers. That's the most of any platform in the investment industry, and I really love that. And you can think of any company in the world, go put in the ticker, and there's probably an article written about it. And then just the articles and earning transcripts a month, about 7,000, and just 200 million page views. It really is a global audience. So if you really want to have your work noticed globally, Seeking Alpha's grateful and happy to help promote you guys. So thank you for the time and for the questions. And we appreciate you, and come stop by the booth. Thanks, guys.
Sure. There we go. All right. We have entered what I would call the home stretch of day one. And my friend Luke Jacoby wants to try something real fast.
All right, guys. It's 2:30 in the afternoon. That's when, we might start to get sleepy. We may need to pick me up. I've done this twice so far today. I'm sorry. You may not like it, but I'm going to do it a third time. We need a little stretch session, okay? I do this at all of our Benzinga events. The little stretch sessions help, okay? It gets the brain going. We learn more. We trade better. So everybody who's willing to participate on our feet, okay? There we go. All right, this time we're going to change it up, all right? We're going one hand. We're going to take our left hand. We're going to lean all the way over. Okay, there we go. About 85% of the group got their left and their right correct. That's a good sign for our trading. Another 15%, that might be the group who doesn't make it. All right, right side. There we go. How about some forearms, okay? We're going to go right first this time. So take a second. Right hand all the way out. Pull the hand back. There we go. Get it loose, a little bounce in there. Left hand, loose, a little bounce in there. All right. I think we're ready for what's next. Appreciate everybody for participating. Second half of the afternoon. Let's go.
Thank you very much, Luke Jacoby, everyone. He'll be here all week. Let's bring on our next speaker, Ming Zhao. We want to... okay. All right. Yep. Sorry. Ming Zhao, founder of Atomic Vaults. Come on down. And let's give her a hand, everyone.
Spencer, chairs.
Yeah, I got you.
When I used to live in China and went to school, and we would do these like eye exercises. So I don't know if anyone used to live in China here, but
Tomorrow morning, eye exercises.
yeah, awesome. Well, it's great to be here. A little bit of background on me first. So some of you might know me from Twitter. My handle is Fabius Mercurius. A bunch of people have asked me, where does the name come from? Fabio Mercurio is like a famous quant guy. So, I really like math. Maths for the Europeans. And this talk will be a relatively quantitative session, but I wipe away all the math. So hopefully it's pretty easy to understand. And if you guys have any questions, just feel free to interrupt me at any point in time. So, awesome. So today's talk will be on the Kelly Criterion and why folks lose money trading options. All right, so we'll start with a little game. So, and you guys have some of you have already heard of this game before. So the idea is, let's just toss a fair coin. So when we toss this fair coin, there's a 50% chance heads, 50% chance tails. So we're gonna just keep tossing it until we get our first tails. And then we're gonna count the number of tosses that we made. So if we get heads, heads, tails, that's 3. If we get heads, 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 tails, that's 4. Okay, so your profit from playing this game will be 2 raised to the power of whatever n is. So, okay, how much? Now the question is, how much would you pay to play this game, given that you get paid 2 to the n, after every roll? So I'm going to do a little survey. How many of you would pay between 0 and $50? Raise your hand. Okay, a couple. How many of you would pay, 50 to $200? More than 200, 200 to 500, 500 to 1,000, 1,000 to 5,000, 10,000, more, 20,000. Really? Wow. Okay. Start shouting out numbers. I didn't see many hands raised. So how much would you guys pay? Right. So you would pay all your net worth playing this game. Okay, cool. Well, theoretically, the expected value here is indeed, the expected value here is indeed infinity. So I guess I put the answer up here. But usually people do not try to bet all of their net worth. And the idea, now the question is why? Okay, and if you bet all your net worth, how long will you have to sit here playing the game until you make it all back? And so there's this natural kind of risk aversion or utility, you could call it, that happens in the markets. And it's the same reason why, for like super positive expected value trades, we end up not betting our entire net worth. So going to second slide here, now let's put a little spin on this game. So same thing, toss a fair coin. Now, instead of counting the number of times it takes to get a tails, now we're going to say, okay, we're just going to toss it once. If you get a heads, you make 1.5x. So if you put in $100 to bet to begin the game, now you have 150. So, but if it reaches tails, if it flips over tails, on the other hand, you lose 40% of your bet. So now you're down to 60 from 100. So now let's say you can keep playing this game. We're in Vegas, so let's say this is one of the casino games out there, and now the expected return here is going to be positive because it's 50% times 1.5 plus 50% times negative 0.4, which gives you 1.05, so 5% expected value return. Okay, so now I'm going to ask the same question. What percentage of your net worth do you put up to play this game? And keeping in mind that you could always play it more than once. You can play it infinitely if you don't have a job and you spend all day playing this game. So let's take a vote again. What percentage of your net worth would you put up to gamble in this game? Who says 0 to 10%? Okay. Who says like 10 to 20%? Okay. Who says 20 to 30%? Okay. 30 to 40? 40 to 50? 50 to 75? 75 to 100? More than 100. Okay. On your margin account. Okay, so yes, on your margin account is the wrong answer. Well, okay, so the correct answer, turns out, is actually 25% for these specific numbers, and we'll get into that in a sec. And here's the reason why you don't bet 100% of your net worth on this game, even though it's positive expected value. So, oops. All right, how do I actually play these? Sorry, a little bit of technical help here. So I have graphs that are animated, and I need them played. Sorry, a little bit of... Sorry. I did do this on a Mac. Yes. All right, so unfortunately these graphs aren't animating because I did them on a Mac, but let's see, I might be able to show. Is there any way I can project from my own laptop? I actually have it right here. All right, sorry. All right, cool. 5-minute break. Let's do some more stretches. Yeah, I'm unfortunately really bad. I've been meaning to do stand-up comedy for a really long time. Bonnie, my co-founder, can tell you I'm really, really bad. He's like, Ming, you think you're funny, and you are, but in like the way that you don't want to be funny. So yeah, very, very bad. But I can keep talking about, this actually has quite a bit of explanation to it. So I'll just keep talking about leading up to the Kelly criterion. So, okay, so a bunch of you, I think I saw most of the hands raised somewhere around like the 10 to 20%. And so that's a really great guess. It turns out that, because 5% is actually like a sizable return for just playing this, simple coin toss game, it does happen that, the mathematically ideal value here in this case does end up being the 25%. And so I will have to probably click it from here, right? Oh, look at you. Oh, awesome. Yay. They are here. Okay. All right, so results of the game. All right, so for those of you who bet 50 or greater, shame on you. You are losing money. So your returns are, you have lost, so it does say returns. It should be, if you start out with 1 or 1x, what do you end up with? You end up with roughly 65% of what you started with. And this is over, I think, 500 simulations over a time period of 100. So let's say you're playing this game 100 times. So the first time you play it, you lose, if it turns out tails, you lose 40%. You just keep playing. Let's say you play through 100, and we do this in 500 different universes. So on average, the average of those 500 universes ends up being 0.65. So you lose 35% of your original P&L. So that's very bad. Green, sorry, apologies, there is a typo. It should say 25%. So that is the ideal, that was the ideal bet size. So as you can see in the green, you are making, sorry, the text might be a little bit small, 1.85x you end up with after 500 simulations. So basically you're almost doubling your portfolio at the end of this. So that's really good. And then if you bet too little, so if you bet only 5%, you end up making 17%. That's still decent after just playing this simple game 100 times. Okay, so why, right? Like theoretically, this doesn't make any sense, right? Like the expected value of the game is the same, regardless of what size you put down. So why does this happen? Oh. All right, so the reason why is because there's a difference between average and typical. So I'll give a very extreme example of what I mean by this. So let's say instead of heads or tails, you have this game where 99% of the time you're like losing $1, and then like one time out of 100 times you're winning $100. So the expected value here is still like slightly positive if you take literally the mathematical equation of expected value. But let's say 100 people play this game, 99 of them will be very sad, and you have like that one happy motherfucker who's taking home $100, and everyone else is like, well, fuck you. And basically, but if you have like one person who's making these 100 trades, you are that happy motherfucker 1% of the time. And 99% of the time you're very sad. And so what ends up happening is if you bet too large, you don't have enough capital in your portfolio to play that game 100 times before you're wiped out. So you get wiped out basically like way too early in the game. And so therefore kind of the difference between average and typical being that in the typical case, your median value is your median position is a losing position, even though there's that like, one unicorn that ends up, raising the expected value overall. So, okay, so how do you actually determine the ideal bet size going into a trade? So for the simple coin toss game, which is a discrete distribution, a discrete game, it's either heads or tails, we have this very simple Kelly criterion formula where it's basically F star here is the ideal percentage. P and Q are the probability of a win and probability of a loss. And then A and B are basically the percentage of your investment that you make back if you win, and the percentage that you lose in the losing case. And so let's just go back to our simple coin toss example, where you win, which you have a 50% chance of winning, 50% chance of losing. So P and Q are both 0.5. And then if you win, you make back 1.5. So plus 0.5. So B is 0.5, and here A is negative 0.4. You end up basically you end up with 0.5 or 0.5 over 0.4 minus 0.5 over 0.5, and you end up with 0.25. So the ideal bet size is 25%. So, okay, so now how can we go from this very simple heads, tails, coin toss game to the real stock market? What are the differences? So obviously the stock market is a much more complicated problem with many more dimensions. And so let's talk about kind of the biggest factors, the biggest differences, how the stock market is more complicated than this simple coin toss game. So first things first are the market is obviously continuous. So, let's just take Tesla, for instance. And let's say it's trading at like 780 or whatever it is currently. And let's say you have some sort of view on Tesla. You're like, maybe like by next quarter, it's going to hit 900 again. Or maybe like, really nervous about the economy, this Chinese suppliers, everything, Ukraine, everything, Fed, FOMC, like, super, super nervous, not yet priced in, is going to tank further, or whatever your bet is. So you have this continuous distribution of where you think Tesla will be in, let's call it next quarter. So it's not just heads or tails binary, but it's this entire distribution of how much you could win. You could win 1%, 2%, 3%. You could lose 15%. Okay, so how do we go from Kelly criterion, which is a formula for a binary game, to a formula for a continuous game? So, okay, so here's an example. So let's say you are trading a Tesla at the money front month option. So you're trading a call expiring June 17th, giving you roughly 1 month for the price to move up. So last time when I made these slides, and I think the price has moved a little bit, Tesla was at 815. And the at the money front month call was priced at 62.50. So that roughly represents 7%. So it would be 62.50 divided by 815. And so now let's say for some reason you have insider information, or you just have a really strong conviction in your Tesla position. And let's say, the expected value, let's say theoretically the EV of this trade is plus 7%. Okay, so basically it's a positive EV trade, very slightly. How much do you put into this bet? So let's say, a regular option, as is any option, not just Tesla, but all of them, trade on 100x multipliers. So it represents 100 shares underlying it. So now let's say you are forced to buy the one full contract of the 6250. That shows you, that is the red case. So let's say you start out with $10,000 in your brokerage app. And let's say, so now you're trading 6250 of it, you're trading 60% of your portfolio. What happens when you make, 100 of these trades that all have 7% positive expected value? Well, here's what happens. Gambler's ruin. So over, let's say you make 100 of these trades and we simulate it 500 times. In 500 universes, the average case is you lose all your money. That's quite unfortunate. And that's because you start out with 10K in your portfolio and you're forced to trade 6K each time. Okay, so now let's move on to, what if we had fractions of options? What if you could trade less than one whole contract? So if you could trade half of a contract, that is the green case, you actually end up doing not too terribly. So you end up losing roughly 25%. So you end up, if you started out with 10K, after 100 of these bets, you end up with average case 7.5K. Okay, so now let's go even smaller. Let's assume that you're allowed to trade, 1/20th of an option. So if you buy, an option representing 5 or 5 underlier on Tesla, then okay, so now you're making 11%, which is pretty good. Not only are you in positive territory, but especially in this environment, 11% sounds pretty good to me. Okay, so. Okay, so next thing. So instead of, okay, so obviously in the last slide, we assumed that you have 10K in your portfolio. So the same phenomenon can be treated a different way, right? So this Kelly Criterion ideal bet sizing problem has two solutions. One is, we make one of them, easily said, hard to do, is you just get really fucking rich, right? Like you don't start out with 10K. Why don't you start out with 5 million? Very easily said. Obviously not super easy to do, especially in a short time frame. So the only other thing you can do is to just bet smaller sizes, and unfortunately the market doesn't exactly allow for that today, as I'll get to in a sec. But here's what happens when you start out with more in your portfolio. Obviously, that ideal Kelly amount ends up shifting upward. So, okay, so if you have 50K in your portfolio and you're trading like a 6K option, then let's say you bet one, you actually make decent returns. In this particular simulation, you're making like 44% with a 7% edge. And then in the case where you're trading half of a contract each time, you're making 17%. So it's still very decent. And when you're only trading, like 1/20th of an option each time, you're actually, you're ramping up so slowly that you basically are flat the entire time. And then same thing on the right-hand side where you're trading out of a 500K portfolio. It actually does make sense for you to be trading 6K at a time. So, okay. All right, so I think this is fairly obvious at this point, but the number one reason why retail loses money trading options is because even if you have, some great insight, you can do all the research you want into the fundamental value of a company. You can have very strong conviction. You can have price action moving in your favor. All that great, but if you're like betting, obviously, stock market isn't a guaranteed game. If you're betting way out of your comfort zone every time, you're going to be getting wiped out. And so, especially since COVID, a lot of retail traders today are, they just started trading during COVID. A lot of the younger folks, especially, don't have, hundreds of thousands of dollars in their portfolio to be able to afford trading options at, a safe percentage of their net worth. So that's basically why they end up getting wiped out. The big lot sizes in options is one of like the true reasons why options are so risky. It's kind of, there's like this is the answer to the story. It's not just like options are risky, done, blanket statement. Like, can somebody please unpack that? Like, this is the reason, right? Okay, so this obviously has already been a solved problem in shares. So we're looking at like $3,000 Amazon calls. Well, good thing, we can trade arbitrarily fractionable Amazon stock. That way, nobody gets wiped out trading Amazon stocks. Okay, so the market is pretty systematically biased against the little guy today. And I actually get a lot of people on Twitter asking me, basically, what do you do with your life? Like they look me up on LinkedIn or something, and they're like, I have no idea what you do. And I'm like, well, it's kind of a secret, and I've been kind of saying, it's kind of a secret for a while. And today I'm gonna share with you guys what I do with my life. So I'm trying to build a solution to this problem, trying to make the markets more fair, not biased against the little retail guy, trying to make it a safer environment for everyone. So my startup, Atomic Vaults, is working on fractionating options for Tesla, Google, Amazon, kind of all of your most expensive and liquid names out there today. And shout out to my co-founder who helped me put together those visualizations that you saw up here. And so our mission, as I said, is basically make the market more Kelly fair, if that's a term, for everyone. And right now, our status, we are currently still pending FINRA approval, part of the reason why I've been telling everyone it's a secret what I've been working on. We're still in the process, so we haven't launched yet. Our go-to-market strategy is we plan to integrate with all the brokers that you guys are already trading on and know and love, and that way, you don't have to switch off platform or like move portfolio or over or anything like that. So we're trying to make the existing brokerage platforms a lot more attractive for the end retail, for the retail client. And in case you were wondering, why hasn't this been done before, or like, what's so hard about it, or like how do you guys do it? The approach that we're taking is we're basically taking kind of like an Uber pool analogy, so kind of similar to fractional shares, where we have multiple single orders end up in a queue, and then we handle that queue and we risk manage and we process that queue internally on behalf of the brokers. All right, so in case you were wondering, is there a formula for the continuous case? So there actually is. So I did get a lot of slack before, being people who don't read my stuff fully and just say like Kelly's like stupid or Kelly doesn't work for the continuous case. Well, Ed Thorpe, very famous guy, very famous quant, examined this problem about like 15 years ago and said, aha, yes, there is a case. We can generalize it to the continuous case. It's basically assuming a normal distribution. So instead of heads, tails, we have a normal distribution of returns, with a standard deviation, which we can get from the volatility of a stock. And so here, looking at this equation, mu is basically like the expected rate of return. Expected rate of returns based on Black-Scholes Black-Scholes, famously assumes it's log normal. Here we are also assuming it's log normal, but of course you can always make some slight adjustments to that, same way that you would make adjustments to Black-Scholes. And here, basically taking our Tesla example into account, we have mu, let's say you had your alpha of 7%. Standard deviation, last time I checked, was 0.77. So essentially, you're looking at the ideal amount of your net worth to put into a trade if given, of course, you assume 7% edge is roughly 12%. Okay, cool. So before I go into questions, I don't know, what's the appetite for math here? High, low? I'm gonna assume this is not a math PhD lecture, so we'll breeze right through this. But essentially, I have some proofs in case anyone is curious for the continuous case and for the discrete case of why this equation, why the P over A minus Q over B for Kelly criterion. And essentially, it's the idea that we take utility back into consideration. So the idea that, even for a positive expected value trade, you don't want to bet your entire portfolio because you're afraid to get wiped out. So you're going to bet a portion of it. So that is, let's call that idea, roughly speaking, your like utility function. And so your utility here is, mathematicians like to express utility in terms of logs. So the idea is we basically take the log of the expected value, and then we try to find the arg max for the log of that. And so it then requires, taking a differential of that, and then you end up with this F equals P over A minus Q over B formula. And then in the continuous case, I can whoever is interested in reading the full thing in depth later, just reach out to me. I'll send you the Thor paper, or maybe you can look it up yourselves. But essentially, he's applying the exact same idea to a continuous distribution where each event is basically like IID or identically distributed and independent, and then basically taking a derivative of the log of expected value. So, and that's it for my talk. We'll turn it over to Q&A now. Yes. Okay, so the question was, what is the advantage of trading fractional options when you can already trade fractional shares? So I would say it's the same question as if you asked, why trade options if you can already trade stocks? And so the idea here is options are obviously levered. So it's like when you have a very high conviction idea. So there's this kind of, I'll give you a very long-winded answer. I apologize in advance. So basically, why trade options, right? So you have your speculative use case, you have your hedging use case, you have your income-generating use case, selling covered calls. So essentially, fractional options ties into this all three reasons, because if you're going for the speculative case and you're saying like, I'm super high conviction, let's say I'm ex-banker and I am looking at the fundamentals of this stock and I just think like the market has totally missed something, and you're super high conviction this trade. Well, if you're that high conviction, you probably want to take a levered position, because it's going to be very capital inefficient to be trading stocks to get the same percentage of returns. And then taking that to options, if you have a relatively smaller size portfolio and you still want to take a levered position, you want to take it on a fractional option instead of stocks. And then the hedging use case, well, more sophisticated traders have various sets of hedging strategies from spreads to just hedging with puts or like selling covered calls. And in today's market, let's say the covered call selling strategy, right? If you wanted to implement that, if you want to sell a single covered call on Apple, you need 100 shares under layer of Apple to equate to that one covered call that you sold. And so to match up the risks, you can't really do that unless you're willing to also buy 100 shares of Apple. And so that's kind of the use case for options, or fractional options specifically. Yes. The question was, how do I define expected value? So the mathematical equation for expected value is you take a set of random events, and there could be different outcomes states. And so you take each outcome state and you take the probability of that outcome state, you multiply it by the returns of that state plus, let's call there's 3 states, for example. So like P1 times expected value times returns of, or R1 plus P2 times R2 plus P3 times R3 gives you the expected value of that gain. Got it. Okay, yeah. So how do you get expected value for a real trade? So essentially, everyone's going to have their own kind of like methodology. Like if you're a momentum trader, the way to get to expected value is going to be different than if you're a value investor, which is going to be different if you're a gamma scalper. So I'll talk about, like, let's say you're a value investor. So a bit about my background. I started out in investment banking, traded for Steve Cohen at 0.72. So I'm like squarely and I started out my career in long short value investing. So in the fundamental use case, basically, usually we would trade around catalyst events, so something like earnings. So going into earnings, we would have our basically our financial models. So we would say, the street is predicting revenue growth of 32%, year over year. And based on my modeling, I'm fairly confident that it's not going to be 32, it's going to be greater than 40%. So then I have some sort of probability distribution around what I think that value will be, and also what I think, how I think the street will react if I'm correct. And so it's basically, integrating over my probability distribution of what I think the metric is compared to the street's probability distribution, which probably a topic for a different talk, but also you can based on options premiums, you can actually determine what the market is implying about the probability distribution of a stock going into catalyst events. So, and you do that by basically taking butterfly spreads in the options chain across different price points, different strikes, and then integrating that and creating a implied probability curve. So you can say, like, for instance, like Tesla. I also actually write about this and happy to chat with whoever afterwards. But essentially, you can basically integrate over the butterfly spreads to say, like, hey, Tesla is trading at 780 today. A month out, the June 17th expiry options chain as a whole is implying that, there's a 90% chance or whatever that Tesla will stay in the like 750 to 850 range, et cetera. Yep. Yes. Yes. So the question was, stock returns are known for having fat tails. Does my model here take that into consideration? So the equation that I showed here in the derivation does make the assumption that there are log normal returns similar to Black-Scholes. So there are like academic papers that have made modifications to Black-Scholes that do take into consideration those fat tails. And while I haven't done it out, myself on pen and paper yet, but I'm sure there's a way to incorporate, the fat tails into the derivation. And a point of a kind of side comment on that, the fact that we have option smiles at all comes from kind of that fact. And so it's basically like, it's less, I want to say it's almost like less important that we made an incorrect assumption, but it's more important that we have like an alphabet on which to communicate. So basically this alphabet that was built, or Black-Scholes, let's call it that alphabet, that was built on the assumption of log normal returns, now gives us a medium of communication to say, well, you can read the option smile, like XYZ way, and like if the option smile is steeper than usual, or the wings are steeper than usual, or whatnot, like, and then traders are then comparing like smiles over time. And that's kind of like saying, like, based on Black-Scholes, which does have that normal distribution assumption, we can say, like, how fat are the tails relative to normal? And so similarly here, like, you can use this as kind of like an alphabet, and then adjust based on saying, like, under normal conditions, whatever normal is, you can say, like, we're 0.15 standard deviations away from, there's a 0.15 whatever downward bias towards than what the number that we calculate here. And then when volatility is higher, then you can skew that your bias away from the number that this equation would spit out. Yeah. Cool. Awesome. Any more questions? Awesome. Thank you. Great. All right.
All right, do it for the gram. All right, thank you very much. Make another round of applause, everyone. Making me regret not taking math seriously as a child, but
Hey, I mean, at least
what are you going to do?
You got your left and your right correct. We did the stretch.
I do have my left and my right. All right, so going to throw you guys a bit of a curveball for this next speaker. It's actually our last speaker of the day. He's going to be joining us virtually from Canada, I believe Montreal. Let's find out. Do we have Matt Caruso? If not, we do have him.
And really quick before you get to that, does anybody here like to drink? You know, just one drink, a couple. Okay, two hands. So you two, three. Okay, you three at 6 o'clock. We're gonna be meeting back in the exhibit hall. We're gonna have plenty of food to go around. We got an open bar. Again, 6 o'clock. We're gonna be back in that exhibit hall. You need to get the night started off. You need a toast to digest everything that you learned today, and that's part of your learning method. Again, we'll be hanging out over there at 6 o'clock, and I'm looking forward to seeing everybody.
With that being said, let's bring on Matt Caruso from Caruso. And hey, there he is. Look at that. Matt, can you hear me?
Okay.
He hears us.
He hears us. That's
we
a good
don't
start.
we don't hear him. So Matt, sit tight while we try to hear you.
We're 50% of the way there. Half your trades work. You know, you're not
Right.
doing okay. Not
We
great.
we got into the trade. Yes, we hear you. Didn't we just hear him for a second?
Yep. We just need
Yeah, can we bump him up a little bit? Yeah, just a little bit quiet though. Maybe we can bump him up on our end, or if you can turn your mic up on your end. Very nice bookshelf, by the way. There we go.
All right.
All right, Matt Caruso, the floor is yours, sir.
Real drivers of the market. It's going to really empower you to have the patience for the proper setups and help you to really decipher from the low quality buy points and the high quality buy points. I think that's something that a lot of investors newer to the business have a hard time seeing professional investors saying, oh, you know, it looks similar, but I don't really like this setup. And you know, for someone who's just, you know, learning the business and learning all the different aspects of investing, you have a hard time deciphering. So I think it really comes down to what are the main drivers of the stock market. And really, you know, these buy rules are only one part of the overall, you know, investing approach. This is kind of the core elements of every strategy. I just want to simplify it. There's really buy rules, sell rules, risk management, and portfolio management rules. We're going to focus on buy rules today and really what surrounds the actual triggering of a buy signal. But in reality, if any of these four elements are missing from your trading strategy, at some point in the market cycle, it's going to cost you a lot of money. You really need all four of these components to work cohesively, to work together in a holistic way to have really long-term success in the stock market. You could have the best buy rules. If you don't have sell rules, you won't lock in your profit. If you have poor risk management, eventually some stock's going to come around and really knock you out. And if you don't have good portfolio management rules, you're not going to maximize the returns of your entire portfolio. I mean, if you have a stock that doubles and it's 2% weighting, that doesn't really help you very much. And so it's really bringing all of these elements together to really develop high performance trading, I guess we can call it, really to do something special, to have that big outperformance, those big returns in good years, and then to be able to at least advance in poor years and not give it all back, which is just an awful experience. And trust me, I've been there. And so when you really focus on buy rules, again, you also want to get past, you know, people just think of number 3, what triggers execution? You know, when do I hit that buy button? But it really goes much further than that. And, you know, you want to stop and think, well, what stocks? There's 10,000 stocks listed, I think, just about in the US. And there's international, there's ETFs. Where do I begin? Which stocks do I buy? Which market environments do I participate in? Is this an environment I should be in? Am I buying this dip? Am I looking to get, you know, undervalued purchases? Do I wait just for these strong uptrends? What defines an uptrend? And then lastly, once you can kind of put that together, then you can find your trigger. But if you just focus on number 3, the triggering, the execution side of things, that's when in good markets you can still have great performance. As you know, if it's a hot bull market, you know, any type of real buying technique is going to work great. The problem is when you come to choppier markets, when you come to years like 2022 or even, you know, tail end of 2021, that's where there's no more room for error. And the market does not ever really provide room for error. In bull markets, you can maybe get a little bit sloppy for a little bit period of time, but if you don't, you know, shake yourself awake, that's going to cost you anyways. So really, before you can kind of even answer those questions, you want to ask yourself, what are the drivers of stock moves? I mean, what really makes a stock go up? And there's, in my opinion, there's really 3 key drivers that drive stock moves. The number one most important thing is really the fundamentals of the company. I don't care what company it is. If you don't eventually turn a profit or have a path to profitability that investors believe in, the stock is not going to amount to anything. It's just going to either languish or if they have to keep raising money, go bankrupt. So the fundamentals, and we'll take a look at actual examples of that soon. But charts don't move stocks, earnings do. The charts, although we spend so much time focusing on charts, a lot of us at least, you know, where can I enter the stock? Where should I exit? The actual driver of that company is going to be its individual fundamentals. I mean, Amazon.com is who it is today. Same with Apple, Microsoft, because they've had this phenomenal business that churns out these incredible earnings and these incredible sales. Without that, there's really no business. The chart won't lift up a bad company. The second very important element, which, you know, some people ignore fundamentals. The vast majority of people, even professionals, will ignore what the Federal Reserve is doing. And the Federal Reserve is a private bank that, you know, administers the monetary system, and they're in charge of interest rates, setting interest rates, and, you know, overseeing banking. And the Fed really controls money and credit. This impacts everything from market trends to sector rotations. And these movements, they're not as direct. They're not as easy to understand. They're second, third order relationships. You know, so the movement of interest rates will affect your stocks in a number of different ways. But the Federal Reserve is really the tide that lifts or sinks all boats. If there had to be one tool that I had to use to understand what are the general trend of things, or what are the prospects for the stock market and the economy in general, it's the Federal Reserve. They will, even if your stock has good fundamentals and they're profitable, the Fed has the power to end that. If you have a highly indebted company and it's profitable, but suddenly the interest on that debt increases significantly because the Federal Reserve hikes rates. Well, that profitable company is no longer profitable anymore. And it goes far beyond that because the stock market is a machine. And what oils that machine is really money and credit. That's the lifeblood. Because at the end of the day, we're not buying the company. If we were going to be venture capitalists, or if we were going to be, taking over a company, okay, we can look at the actual company itself. But when you're dealing with stock, now you're at a function of what are we willing to pay for these earnings at any given point in time, and that now is going to be relative to everything else in the economy. Investors have the choice between bonds, between different stocks, between cash, between precious metals, between cryptocurrency. And so the Federal Reserve and what interest rates are doing and when earnings are going to be coming for a company will affect what people are willing to pay for the earnings of a current company or what the expected earnings are going to be. Now, once you get all of that together, you have these great fundamentals, you have the Federal Reserve on your side. At the end of the day, who's actually going to lift that stock price? It's not going to be small retail investors. It's not going to be mom and pop. It's institutions that really will drive the stock move, the stock advance. So at the end of the day, it's crucially important. Even if you think you have a stock with great fundamentals and you have a stock, you have an environment where the Federal Reserve is accommodative, you need to see those footprints of the institutions. And trust me, they're there. If you're Fidelity Contra Fund with $130 billion under management, and you want to put 1% of your fund in a company, that's a $1.3 billion investment. That takes a lot of time to accumulate that much stock if it's a mid-cap company or lower. Maybe not for an Amazon, but if you're dealing with a $40 billion, a $20 billion, or $5 billion company, trying to invest $1 billion is a staggering amount of money. It takes days or weeks to put on that position. And that's one fund. So imagine multiple of these funds running similar models with a similar focus, trying to accumulate stock. It's a monumental task, and their footprints are definitely going to come through. In fact, I always say the biggest advantage of the individual investor is that we can move in and out of stocks without impacting the stock price. I mean, that's huge. Institutions may have these amazing research departments with the best research in the world, and they may have even foresight as to what earnings are going to be based on ancillary data. They can look at internet trends. They can look at satellite imagery data. There's so many ways they can get information that we can't. But it's a Herculean task to have to move in and out of these companies. So the ability for most investors to say, "Oh, I want out of the stock. Okay, hit the bid and I'm out." That's a major advantage. So if we can see the footprints of these institutions and get in as they're buying, if we're wrong, we can limit our risk and exit. The institution doesn't have that ability to do so. So understanding when they're buying is critical, and recognizing that as an individual investor, you can exit when you want to is also a major advantage. So using all of these tools together with risk management is so critical in high performance investing. So when we dig a little deeper and we go into which stocks, and we know fundamentals determine the company value, what is a company worth? I mean, it seems like a really simple question, and that's the irony of the stock market. So many things that seem so simple actually end up being very complicated. But what is a company worth? Very similar to a bond, it's the present value of all future earnings. So okay, let's boil that down to something that doesn't sound so classroom-like. Basically, if you know exactly what a company was going to earn in the next 10 years, and then after it was going to close its doors, it'd be very easy for you to say, okay, you're going to earn X amount next year, the year after that. Given current interest rates, this is what I'm willing to pay you. And that's how a bond is calculated. No one ever argues about what a bond is worth at a given point in time. That can change day to day, but at this point in time, given interest rates, it's an absolute mathematical formula as to what that bond is worth. It's the present value of all of these future coupon payments and the return of capital. So if a company, if we were able to judge with certainty what their earnings would be in the future, it'd be as simple as calculating a bond. So we know that's what we need to do, but it's not so simple. Unlike a bond, companies are dynamic. They're changing. They're always moving. They're investing in new ideas. Their underlying clients that they're selling to are changing. The economic landscape is changing. There's no guarantee that these future earnings are going to ever come to fruition. So how do we use earnings per share? It almost seems like it's meaningless, right? Well, I like the story I always like to tell is for many years when I first started trading professionally, I was a market maker at one of the big Canadian banks, and we traded a lot of precious metal companies. And the saying in the precious metal space is that the best place to find a gold mine is next to a gold mine. And statistically, that's true. If you look at all of planet Earth, and you had to dig one, if you had to find land to dig into, it would be just outside the boundaries of a current gold mine, is the highest probability place to actually find gold. And so really, in terms of earnings per share, if we want to find, who's going to have this booming earnings, who's going to have this booming sales and surprise to the upside, it's the company that's already executing well that's most likely to do so. I mean, if there's a company that's losing, clients, they're bleeding cash, they have negative earnings, who is more likely to show another quarter of 100% earnings growth next quarter? This company that's failing, or a company that's executing strongly and is just doing fantastic? It's the company that's executing strongly that is more likely to report well again. They're on a key industry trend, or they have a product that's in high demand. Management is executing well. Not only do they have this high demand, but they're actually able to turn a profit doing it, which is not always so simple, as you can see with a lot of companies recently. Even if you have a great membership base, it's still difficult to actually turn a profit, depending on how your customers' preferences can change. And so even if you do all of that and you say, okay, this company is executing so well, everything is working out, we got this very competent, smart, intelligent management, what's the risk? Well, the risk is that even if trends continue, investors can pay too much too quickly. So at the end of the day, if we overpay, it's similar to a bond. We know what this bond is worth today, but if I get so excited, I think this is the best bond in the world, which doesn't happen with bonds because there's no investor sentiment component to it, the same way, because it's more of a certainty. But if someone ran in and overpaid for a bond, I mean, they'll be guaranteed a loss. There's no real question about that. But people don't think about stocks in that way, and so they never really worry about drastically overpaying for this stock. So one of the things we have to pay attention to is, number one, that trend of earnings can fail because the future can change. These earnings are uncertain. And two, investors may just overpay for earnings, even if those earnings do come to fruition. So that's sometimes the frustrating case where, for example, a lot of companies are still bringing in great earnings even now, and they're down 50, 60%. And people are saying, well, I don't understand what's going on. They're still making great numbers. And the thing is that people just overpaid for what was possible. And there's some other factors as well we're going to look at is with interest rates, but that's a key component that people have to always respect. And sometimes what doesn't make sense will make sense in time, but in real time, it doesn't make sense. But eventually, when you finally see what kind of earnings this company will bring out 6 months, 12 months, 2 years from now, you see, oh, okay, we were paying, inadvertently, we were paying for earnings that were twice as much as they ended up delivering. Even though we thought they were good, we were actually paying for much, much more. And the more astute investors realized that and sold it down to a fair level. Let's take a look at Devon Energy, for example. It's been a very strong stock recently. And, actually, some people will even question in the first place, is it really earnings that drives a company? Well, you can see the earnings line here on top of the chart, and this is the stock price underneath. I think it's fairly clear. It's not exactly perfect at every moment in time, but this is pretty much the trend of earnings is going to dictate what the trend of the stock is. Let's take another look at NVIDIA. This has been a powering stock advance. What powered it? It was those phenomenal earnings. And in fact, the only time during this entire advance we got a significant correction right here was when earnings had a slowdown. Now, I know we're having a correction as well right now, and earnings are still at the record levels. But these institutional investors, like I mentioned, they have a lot of ways to find ancillary data to kind of get ahead of what the next earnings report will be, the next one or two reports. Like I mentioned, they can use satellite imagery to check traffic. If it's a retail company, they can look at internet trends. There's a lot of different ways that they can do this. And so as great as following this trend is, it's not as simple as just saying, oh, earnings are up, let's buy the stock, because institutions, they already realize that, okay, in the future, in the next 3 to 6 months, earnings are going to slow. But what's critical here to understand is that it is earnings that's driving these moves. Now, thankfully, because those footprints of the institutions are visible on the charts, once we identify a company with these great booming earnings and we're playing this trend and we're looking for opportunities, if we suddenly see that what the chart is telling us is that institutions are now selling this company, we have a way to protect ourselves from just sitting in a company because earnings are great, and then after, we realize 6 months later they missed earnings, and the smartest guys in the room sold 6 months prior. And that's what's happened with a lot of companies right now. Let's move on to another example. This is Peloton. I mean, it's no earnings that we had this kind of mountain here in terms of stock price. But look what earnings did. The coronavirus pandemic came around. We rocketed higher. We had 3 quarters of earnings where things stayed in. And after investors realized, even though the print came out all the way down here, investors were selling in anticipation of that. They could see that the trends were failing. the trends were fading, and they sold really aggressively into the stock price. And you had a stock price fall from $160 to below $90 before that earnings report came out. And again, that's because they always have this ability to see what's going on in the future. Here's Tesla. For the longest time, we had this initial bump up in earnings where, Elon was showing that there's some future, potential future to this company. We had this nice, strong stock rise. And then we had years of no movement because earnings just couldn't get anywhere. He couldn't sustainably get the company off the ground. Even though we had one good quarter right here, institutions, again, are very astute investors, and they can tell if it's a one good quarter for whatever reason, or is it a sustainable advance? And that's really what changed in this environment right here, and why the stock went on this towering advance, is that suddenly a sustainable trend of earnings occurred. And there's two important elements to this. Not only do you want to see consistently climbing earnings, but you want to see record earnings, or you want to see the highest earnings for many years. And that's really where these big, big uptrends come. And so again, understanding what are the actual drivers of the stock market, what gets the machine to turn. And so I think the first thing we have to understand is it's earnings, or in reality, it's the anticipation of future earnings. We know what past earnings are. We can use past earnings to help judge what's the trend, and is this a company that's executing well and has the potential to keep earning well. But it's really those future earnings is what's the main driver for these stock advances. This is Square, another great example, and really pretty much followed the earnings trend line. So once you company, and we have management that's doing fantastic, earnings are booming, estimates for future earnings are very strong. You do some channel checks, or you look online. For example, let's say it's a retail, company. I remember years ago, Lululemon was so popular, and you could, it was probably 2010, 2011 when the stock price was taking off. And I have two sisters. I had my girlfriend at the time, who's now my wife. Everyone was buying these Lululemon pants. It was just, you could just feel it. And so that was kind of confirming the fundamentals. But once you figure that out, what environment are you in? And really that comes down to the demand and supply of money. Money is the gasoline that drives the stock market. Again, we're investing in the stocks. We're not investing in the company. So it comes down to two main components. What's the cost of money? And when you figure that out, don't fight the Fed, because the Fed is what sets that cost of money. And that will be what will lift the tide or lower the tide for all of the boats and all of the stocks. That will impact, what multiple investors are willing to give to companies. That will impact how much capital is available to companies who need cash to keep sustaining or grow their business. So that really impacts the entire economy, and really specifically the stock market. Because if yields get high, investors don't need to invest in the stock market. If they can get a similar return without the risk of future earnings failing, if they can go in a bond, or they can go somewhere else with a higher rate of return, a lot of them will take that choice. They don't want that risk. And so, the Federal Reserve, the more it increases interest rates, the more it makes stocks less appealing. And so that interest rate is just such a powerful mechanism. But let's take a look really specifically at a specific example as to how that could actually impact your stock price. So the formula that dominates everything. What is $100 next year worth today? Super simple question. I mean, it seems like, for those who took Finance 101, but even if you did learn this Finance 101, a lot of people don't realize just how important it is in the stock market. So, if you want no risk and you have no opportunity cost and you have nothing else to do with the money, you can earn 1.95% with the U.S. government. That's considered risk-free because the U.S. government can always basically print money and give it to you. And so basically that $100 next year is worth $98.10 today. And you can see right here, that's simply taking the $100, dividing it by that 1.95%, you get to that $98.10. So it's really simple. That's really the underlying formula that will dictate what those future earnings are worth for your company. If you could understand, if you can price in what are those future earnings going to be worth today, you could price your company. Now, not only can those earnings change, but that interest rate can change. And for stocks, it gets more complicated. With a government bond, it's a government bond, but let's say a company wants to raise money. It's a great economy, prospects are bright. So they go to investment banks, say, okay, we can get you debt for 5%. Fantastic. And at that point, investors say, okay, great, this company could borrow at 5%. So this is how we're gonna estimate what this company's value is. Now, what if the economy sours and the economy's in this company's prospects sour? Well, if you're going to lend to this company, you're no longer going to ask 5%. You say, well, now your risk has gone up. So if you want to raise more capital now, that 5% is not going to be enough to justify the additional risk. You're not risk-free. You're not the government. Although it's in some cases, in a lot of places, the government's not risk-free either. But in that case, they're going to say, well, now instead of 5%, interest rates have gone up. So, already the Fed's raised rates. So from that government bond of 1.95 is 4% or 5. And we actually are going to have to tack on a little more than that because you're riskier. So you go from a 5% yield to a 10% yield. That dramatically changes everything. That changes what those future earnings are worth. And that also changes what kind of earnings you'll make in the future. So let's take a look. Let's take a little bit further out. What's that same $100 worth if interest rates go from that 1.95% to 5%? Well, instead of being $98.10, just that little bump up in interest rates, bring that $98.10 down to $95.20. And so that's the impact of rates changing over 1 year. Now, because a lot of these growth companies that we're looking at aren't even making much earnings right now. They're promising you, look, 5 years from now, this company in 5 years is going to be great. Actually, in 10 years, this company is the next Amazon. So we don't have a lot of earnings today, but we promise you 10 years from now, we're going to have a lot of earnings. Well, that's fine. Even if you take them at their word and they're telling the truth and they can see the future. What will a change in interest rates do to that earnings 10 years from now? So, what is $100 10 years from now worth today? Well, at 1.95%, you have to factor that money back every, sorry, this should have been 1.95, just a typo. But the answer is $82.04. But if that rates go up to 5%, that same $100 is only worth $61 because you have that 5% opportunity cost every year, compounded year after year, for 10 years. And so if I'm going to give you this money and I'm only expect these earnings 10 years from now, well, for 10 years, I could have earned 5% a year. So, by locking my money up with you, in reality, I'm as that opportunity cost. That $100 10 years from now is really only worth $61 today. Now, let's make things a little bit worse. What if what I mentioned happens? Interest rates go up to 5%, and now we thought we were going to get $100 a share, but we only get $50 a share. What happens? Well, if we do that, we drop to $30.70. So that's how a stock that's worth $82 can crash to $30 relatively quickly with higher interest rates and a change of expectations. And so everyone's looking at all of these growth stocks saying, I just cannot believe it was worth $180 9 months ago, and now it's worth $70. Can't be. There's no reason. It can't or it's worth $40. It could be because they're promising these earnings so far into the future. The Federal Reserve is raising interest rates, so interest rates for everyone has gone up. Investor sentiment has shifted. They're now wondering, are they questioning, like Peloton? Hey, you're going to take over the world of fitness. Now we're going to question that. We don't know if that's possible anymore. So you have an increase in interest rates, which over a long period of time has a big impact on what your future earnings are worth. And then after, on top of that, maybe this higher rate environment makes it a lot more expensive and difficult for you to operate. So you're going to have lower earnings as well. And now that subtle shift, that change of what Federal Reserve Chairman Jay Powell made to the interest rate curve dramatically impacted the price of your stock. So what seems so impossible is actually the right course of action. It makes a lot of sense when you understand the power of the Fed and the cost of money. That's really what drives everything. Now, take a look. I'm even talking was a growth stock environment, but that's true of the entire stock market, only maybe to a less significant degree. Let's take a look at 2018. The current environment, a lot of this is Fed driven at the moment, but just take a look at this chart and, the ability you can kind of plot the tweets right on the chart. And you can see here right at the very top, Powell pledges the Fed will act with authority if inflation spikes. This sounds familiar to today, but this is in the fall of 2018. As stocks started to fall, then President Trump was complaining and criticizing Jay Powell, and the Fed pointed to more rate hikes amid the criticism of Donald Trump. And so they were really saying, we're going to keep raising interest rates. Well, the stock market doesn't like higher interest rates for all of the reasons I just mentioned. And that led to really a 20% drop in the NASDAQ relatively quickly. And when did that bull market come into 2019? When the Fed said, well, given they didn't say that, Fed speak is very different from investor speak. But the Fed said, we'll be patient with monetary policy. We'll see how the economy does. And that means, he said, Powell, we won't hesitate to tweak the balance sheet reduction if it's causing problems. That's Fed speak for, okay, we're not going to let interest rates keep rising, and we're going to adjust. We're going to adjust our path on interest rates. And that simple change of tone went from a 20% bear market to a new bull market. So that's the power of the Federal Reserve. That's the power of interest rates. Now, when you start to bring this kind of backdrop into how you're approaching the market, doesn't this have a big impact on when you're looking for buy signals? This is a candlestick chart, and there's so many classical candlestick patterns. And in uptrends, they work beautifully. It's just every single time you get this hammer, wow, we gap higher and it works great. And then in this bear market, everything fails and people can't understand what's going on with the new investors. Well, this is what's going on. And the environment you're in is changed. The Federal Reserve sets your environment, and the fundamentals are changing because of the Federal Reserve, and stocks will respond to fundamentals. So how do you increase this investor precision? It's by understanding the real drivers of the stock market. And those are the two major drivers. So now, once we know all of this, and we've laid this out in a well-structured plan, and we're ready to do our analysis, well, when now do I actually start buying stocks? Where do I focus on? There's still 10,000 stocks. How do I know it's safe to go in the pool, even though the Federal Reserve has changed course? Because sometimes in the past, you can see in 2008, when the financial crisis happened, the Federal Reserve started to cut rates before the actual bottom happened, but it took some time for that bottom to come in. And so that final important element is that institutional investor and the footprints that they bring. So what triggers execution is institutional buying. Until the institutions are convinced that the Federal Reserve will now be supporting the economy and that companies' fundamentals are going to improve because of falling interest rates, or at least not get any worse because of climbing interest rates, that is when it's going to be time to look for these great opportunities. And so institutionals drive the stock moves. Institutions have the best research. Institutions are forward-looking. Institutions are strong hands. They're not going to be selling their stock just because of a little wiggle in the stock chart, but the charts do show their footprints. So how do we take this knowledge? How do we actually see these footprints? Well, let's take a look. This is Shopify in 2018. And on the top chart here, we can see the S&P 500. This is that sharp drop that I just demonstrated was due to the Federal Reserve, on a path to hiking interest rates. And look at what the S&P 500 did. We fell really hard. This was the lowest it had been all year. You can look back at the rest of the chart. This broke all of the prior lows significantly. Shopify was barely breaking any lows. And actually it was in late 2018 was still higher than where it was in April, which was significantly different from what the S&P 500 was doing. So I call that A-B relative strength. Looking at two different points in the chart, you can look at this point here on the S&P and this point here, whereas this point here on Shopify and this point here is showing a very different story. And so that relative strength, that chart of the stock not breaking lower with the market, that doesn't happen by chance. That's an institution who has a good forward view of the stock, is stepping in and putting its money where its mouth is and accumulating that stock. Because if the market's falling out of bed, that stock should fall out of bed with the market, because the market is really giving a good idea of what the general economy is going to be doing. So if that stock is not falling, specifically if it's a stock that is a growth stock, which will typically do much worse as the economy weakens for all of the reasons I just mentioned before, if that stock doesn't decline, that is screaming at you that there's something going on with that company and someone is buying those shares and is accumulating those shares. Again, you don't want to use this blindly, but you tie that in with what the Fed action was at the end of 2018, how Jay Powell changed course. If you look at the earnings line of Shopify, which was very strong, the booming earnings and sales, that's what then leads to this towering advance where you went from about $155 to $400 in only a few months. That's those life-changing moves. And that doesn't happen. I want to start with an example outside 2020 or 2021. That was a special kind of market, but these moves happen all of the time. And when you get that combination of a strong Federal Reserve, a helpful Federal Reserve rather, strong fundamentals and that relative strength in the stock chart, that's really the recipe for these really booming stock advances. Let's take a look at another example here. Let's take a look at 2020. So we looked at the earnings line before for Peloton, and this was a little bit different. Whereas Shopify in this example here wasn't falling with the market. Another way to look at that is, this did fall with the market. The market fell, and so did Peloton. But look how quick Peloton was able to get back to its old highs, and look how much lower the S&P 500 was from its old highs. So that was showing you, okay, although it did fall with the market, someone came in scooping up as much of these shares as possible, and this stock surged to new highs while the S&P was still way off of its highs. That's that very strong relative strength. And we went on to a 295% advance in only a few months. staggering moves. And all of the elements were really there for this advance. You had an accommodative Federal Reserve, you had good fundamentals, and that stock chart was really showing that with big money was stepping in to really accumulate that stock in the face of the general market weakness. Let's take a look here at Lululemon. So again, I mentioned this earlier. I always like this example. And so it had its first, Lululemon had a couple of runs. It had a first run in the 2010 area, and after years later, after a bit of a company reshuffle and refocus, it had another strong advance. And this was 2018, early in the year. There was a lot of stock market weakness. That did not affect Lululemon, despite some pretty sizable drops here in the S&P 500. Lululemon was actually kind of advancing over that period of time, and on good earnings, we gapped up to new highs. So talk about a significant different performance relative to the general market. And again, as the market was falling on this leg here and this leg here, institutions knew this stock, well, the market's weakening, but there's no economic problem big enough to impair Lululemon's future earnings. In fact, we see them brighter and brighter. And so they're using any market weakness as an opportunity to accumulate stock. And as soon as the market weakness ended and things turned up positive, we had this 91% advance. And again, about 5 or 6 months. And very, very powerful. These are these advances that can really, really change your portfolio. It's most important because you could have a great stock move. If it's a small part of your portfolio, it won't really dramatically help you. But again, that's another part of the process. But just focusing on this element right now, these are the underlying drivers of these significant stock advances. So investors really need that holistic system. You can have all of these great buy rules. If you don't have sell rules, well, take a look at Lululemon here. After we popped, we started a very strong down move. I could bring up Peloton, as I mentioned, as a buy, and Peloton's probably a great example of a complete unraveling of the stock after it peaks, and we came down significantly lower. And so you really need your sell rules and it's not easy. It's not as simple. If you're trying to capture these big advances, you need to be able to tell, when do I want to hold on for these more significant advances, and when is it finally time to sell? Because along those advances, you're going to now to sell. You won't be able to capitalize on these big advances. One, either you'll sell too early or you'll sell way too late. And either way, you miss out on the majority of your gains. Third, risk management. You can have all of this stuff, but if you're not positioning yourself properly, or you don't have the right sell rules in terms of risk management, you risk blowing up your entire account. I mean, I think that's why I want to kind of focus on investing precision, not just another individual buy technique today, because this environment is really showing everyone without this risk management, you won't survive in this market, not long term. The reality is anyone can make money in a bull market. Find me a professional who's been trading for 10, 15, 20 years, and that's someone who has to master all of these 4 steps, or they won't be around anymore. I've been through there myself, the boom bust phase. It's hard, it's difficult, and the best way to advance through all of these 4 different elements is that every time you make a mistake, you write down a rule. How can I improve that? What did I do wrong? Let me find a book on that subject. Let me find someone who has a complete system, so I can see how is he putting all these pieces together. Then after, I can either use that whole system or at least understand the components of that system. And that's really how you build out all of this. The last one is portfolio management. That's really the most complex element, because now most of the time we're looking at stocks individually. You're looking at that stock chart. You're looking at its fundamentals, and you're focused on that one company. But you're in a portfolio, and you have to manage risk for the entire portfolio. Now, even if you have a great winning stock and another stock gaps down horribly on earnings, and now your whole account enters into this big drawdown, you have to say, oh, my risk appetite now is diminished because I took this beating on the stock that I wasn't expecting. There was some kind of black swan event that came out. I need to adjust my overall risk exposure, because if this other company I own then also has a similar fate, I'm going to get demolished in my account. So portfolio management, there's a lot more moving parts, tends to take more experience. But once you can also get portfolio management under control, that's when you can really maximize the entire return of your entire account. And again, that's really what matters. You could have a stock that doubles, triples, quadruples. If it's 5% of your account, that's not going to really move the needle on your entire account. Whereas if you want those triple-digit returns like I had and a lot of other people had in the 2020 US Investing Championship, you need the whole portfolio to really work well. And so I want to thank you very much for this opportunity to speak here from Montreal. I wish I could have been there. Maybe next time we'll get that to happen. You can follow me at carusoinsights.com, where I have a course and I have a membership as well. And it's been a real pleasure here speaking to everyone. And I'm not sure if I can actually take questions. If I can, I'd be happy to. If not, thank you very much, everyone, for taking the time in that beautiful Las Vegas to hear my presentation.
All right, let's give Matt a round of applause, everyone. And any questions for Matt before we let him go? No. All right, Matt, thank you very much. Guys, that's a wrap on day one for our programming. Let's all meet next door at 6-ish. I think they're setting up right now. We're going to have drinks, food, and the party gets going. All right.